that the worst case scenario may not play out?
Well, I think the developments are simply that the U.S. and Iran are open to talking again and that they are making efforts to put together another round of talks. President Trump said in an interview that those talks could take place in Islamabad again, where they took place last weekend. That last round of talks in Islamabad did not end with a peace agreement. But the fact that they are looking at getting together again is creating optimism, certainly in the markets and among others who are hoping to see an end to this war, that they can come up with a deal.
On those potential talks, to what extent does that need to come with Iran essentially stopping that shipping through the strait in order not to derail the prospects of these talks?
Well, there are multiple issues that would be discussed at the talks and multiple issues that are hanging over them. Certainly the strait is one of them, and you're right to bring it up. The president said after the talks concluded or failed over the weekend that the U.S. would start a blockade of the strait. That's something that he's committed to, and it's another one of the things that he has wielded as his own sort of threats to Iran, along with that 2-week pause, the threat coming after that 2-week pause, I should say, of restarting attacks against the country. So, you know, that's got to be at the top of mind amongst Iranians, just as it is here. The other main thing that the president has said repeatedly over and over again is that talks need to lead to the Iranians agreeing not to pursue a nuclear weapon, and that's just not something that so far they've agreed or been willing to agree to.
Well, and at this point, this full naval blockage of Iranian vessels, are we seeing the impact of that? Do we have any further intel in terms of how this is playing out?
So I think what we saw overnight is that the U.S. Central Command has said that 6 merchant ships have agreed to, or rather responded to the blockade and turned around and going back to the Iranian port. And I think at the same time, as we mentioned just now, Iran is planning to not send ships through Hormuz. So while the U.S. blockade did throw a level of uncertainty into the whole situation, but it appears to be more stable than we feared that it might be. So the potential escalation appears to be drawing a line over there with the turnaround of the ships. And so far, I think through the Strait of Hormuz, traffic is still low, but the situation doesn't appear to be escalating on either side.
So what are we expecting, Wei Lun, to see on oil prices, given how there seems to be the disconnect still between futures
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 40.
There's so much noise in the world, it's very difficult to be definitive around this.
I'm worried about what the negative consequences are if this conflict continues to go on.
What the equity markets are saying is that this will not metastasize into something which is larger.
We are viewing U.S. equities as a bit of a safe haven in this environment.
The bar for bad news is obviously exceptionally high.
This is Bloomberg Surveillance with Jonathan Farrow. Lisa Abramowitz and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, stuck in talks about talks.
Following President Trump's powerful threat on Saturday evening, it was made clear to the United States that Iran wanted to talk. President Trump is willing to listen. President Trump does not bluff, and he is prepared to unleash hell. Any violence beyond this point will be because the Iranian regime refused to understand they have already been defeated and refused to come to a deal.
The White House insisting the diplomatic effort is continuing as Iran is drafting plans to introduce a toll to transit Hormuz. Investors are caught in a headline-driven market whipsaw. Oil advancing once again this morning.
This is a faith-based market. Do you believe one headline? Do you believe another headline? How do you prepare yourself for the next headline that could come down the pike? Every day this goes on, though, the upside gets smaller. Every day this goes on, inflation expectations are going to creep higher and the growth expectations are going to dip lower. And so ultimately, at a certain point, you wonder how much people's impulse to buy the dip starts to become limited.
Speaking of the whipsaw, this from Xauusd just moments ago. Check out the story. The Pentagon developing military options for a final blow in Iran that could include the use of ground forces and a massive bombing campaign, according to 2 U.S. officials and 2 sources with knowledge.
This just highlights how much we don't know about the fog of war. There was also reporting overnight about how the bulk of Iran's bombing sites and missile launchers have been damaged. There are questions about what the U.S. and Israel attacks have actually accomplished in Iran, what their capabilities are. It just doesn't take much to disrupt shipping, and this is the difficulty. It takes one ship, one dinghy, one drone, and that is the problem that people are facing this morning.
Which is why everyone is stuck between a rock and a hard place. Which way do you turn? We've talked about facing down substantial two-way risk. BlackRock, not pricing in the risk. That's the BlackRock view. CIBC, Chris Harvey, Trump. The Trump put is struck. It's time to put money to work.
Honestly, you've got Morgan Stanley saying the same thing. You've got JP Morgan saying also by the dip. You have Vinu Krishna over at Morgan Stanley coming out and actually upgrading his forecast. Right now, buy the dip has been a successful trade pretty consistently throughout the board, especially when there is geopolitics. This time, when you speak to energy strategists, we've been talking about this for a couple of weeks now, they're sounding a very different note that is much more similar to what we're hearing from BlackRock than, say, some of the more bullish streets out there.
Equity futures right now in the S&P negative here by about 0.8%. Coming up this hour, George Concalves of MUFG with markets very much on edge. Marine Corps veteran General Robert Walsh as strikes continue in the Middle East. And Michelle Meyer of MasterCard with the consumer very much under pressure. We begin this hour with our top story. The US and Iran at odds over peace talks as attacks press on. Bloomberg's Jemana Basechi joins us now from Dubai for more. Jemana, welcome to the programme. Just what is the status of talks? Where are we?
Yeah, well, it doesn't appear like the talks are actually happening, John. And if you go by what the Iranians put out yesterday, they don't seem to be in the mood of compromising at all. They set out their own 5 counter demands of what they would be looking to enter into discussions to end the war. And some of those terms are really far away from the starting point of the U.S. discussions that they had even prior to this war. But they include things like assurances from the U.S. that they'll never attack Iran again, war reparations that they're seeking to get from the United States as well. And then the other one, which is a new point that has obviously emerged over the course of this almost month-long war, is they are saying that they have a right to sovereignty over the Strait of Hormuz, which is obviously an unacceptable outcome for not just Gulf allies in the region, but more broadly for anyone involved in the energy market. So the terms are unrealistic and a non-starter as far as the U.S. is concerned, and it seems very unlikely that these direct negotiations or even indirect negotiations are actually going to yield anything. At the same time, the clock is ticking. Remember, at the beginning of the week, Trump pushed back that 5-day ultimatum. We're getting closer to that, so that coincides with around Friday evening over here in the Middle East. And at the same time, we have been reporting about extra military assets and the marine expeditionary units that are arriving to the region. There are 2 units on their way. The first batch is expected to arrive in coming days. Which means the Trump administration policy at this point is almost to simultaneously look to de-escalate while at the same time looking to potentially escalate over the coming days, given Iran are not showing any inclination to return back to the negotiating table. So I think there's a real fear this weekend that we could once again find ourselves in a situation where military operations have once again intensified. And just as a reminder, it is day 27 of this war. The strikes, the military operations are ongoing. If anything, IDF have intensified some of their attacks over central Tehran and other parts of Iran overnight. Iran has continued to retaliate against Gulf states. Some sirens went off in Bahrain, some more drones intercepted in Saudi Arabia, and even the first deaths reported in the UAE in over a week now because of intercepted missiles. So this is we're still very much in the midst of the war, and a lot of nervousness heading into this weekend, and the real possibility that this could once more escalate. And in return, Iran have also threatened to strike back against civilian infrastructure at Gulf states.
Jumana, appreciate the update. Stay close as always. Bloomberg's Jumana Basechi out of Dubai leading our coverage so far this morning. There's a lot hanging on talks over the next 48 hours.
And a real question around what de-escalation looks like. I mean, if you de-escalate, does that mean a ceasefire? Does that mean a reopening of the Strait of Hormuz at a time where Iran is saying that essentially they have ultimate control over this key passageway?
Let's get to the view on Wall Street this morning. Xauusd Goncalves of MUFG writing the impact from the war will likely turn out to be even more damaging than the tariff shock, especially considering that the US jobs market and consumers are already on shaky ground. George joins us now for more. George, good morning.
Good morning.
Let's start with Lisa's World, the auction. Soft 2-year, soft 5-year, 7-year auction coming up a little bit later. What do you think is behind the weakness in demand for US government debt right now?
Look, I think it's a repricing that's happened globally on the rate side. The US Treasury market really lagged everything else. And this sort of concern around like what is the new steady state for interest rates, and heading into end of the month, end of the quarter type environment, these auctions usually do well. And the fact that they're under pressure does kind of show that there's been some sort of kind of buyer pullback.
Mohammed Al-Arian wrote in the FT earlier this week about Gulf flows and the importance of the Gulf as a source of capital, not just a source of energy. Is something happening with those Gulf flows in respect to what we've seen so far in the auctions?
Look, it's hard to tell with public data and just where we stand things right now. In general, foreign flows could be impacted the longer this persists, and that's really the big issue here.
Is there also a question around institutional credibility? What kind of fiscal response there's going to be to this? I've noticed that a lot of the increase in benchmark rates in the U.S. have come from real yields, not at all from inflation expectations. Yeah. What's the read-through in terms of what the appetite for debt is internationally?
Yeah, absolutely. So yeah, that's a great point. The fact that we've seen real rates, especially out beyond the 5-year point in the curve. So the 10-year and the 30-year has largely been a real rate move, potentially capturing this sort of fiscal concern. We've been here before. We've seen this like in times past. When there's a risk of more supply coming down the pike, the bond market does discount it. But we've also seen the 2-year sell-off a decent amount. So we've seen a level shift higher that's also infiltrated out the curve. I think it's early days, but yes, I am concerned about the fiscal outlook in general. I'm usually more of a fiscal hawk than more of a central bank dove. But I do think that it's more inflation, and then the fear that we're going to have to like address this with more supply down the road.
The reason why we're focusing on the auctions is because it's the front lines of real concern that we're seeing that hasn't really been represented through broader markets. There hasn't been this sort of capitulation to the fear that we can represent on any given day as we try to extrapolate out the story.
Yes.
Why do you think there hasn't been that sort of fear trade, that sort of washout that so many people have been talking about?
I mean, the 2-year going from 3.4 to close to 4%. I mean, that's pretty much, I think, as qualifies as a washout. You know, I think that's a pretty big move and really repricing, realigning positioning. If your modus operandi from this point forward until we get some sort of conclusion on this conflict is to trade small and to be very tactical, it's hard to really come in with conviction.
Committing capital in this market is almost impossible. I think that's been a feature of this week, not just around this table, but for a lot of people in this market, Bramo. After what we saw earlier this week, particularly on Monday morning, this is a really difficult moment for a lot of people. Not just the economic backdrop, that's shaky enough. Things are fragile at the moment. But going into the weekend, not knowing which way this can go, when the risk on either side is so large, I'm not sure what you're meant to do in this moment.
You're meant to sit on your hands and try to take long-term positions, which is the reason why you see people not have conviction. Right now, you're talking about two-sided risk. There also is no way to get an edge. The whole idea, and this is why I say it's playing blackjack or it's playing slot machines. It's not playing poker where you can kind of gauge and calibrate the potential probabilities. How do you have any sense of that, especially if you think maybe the other guy has a better edge than you do?
Have you ever seen it like this before, George? You're an experienced guy. You've seen many markets, many market regimes. What's this one?
Yeah, I mean, it's unique. It has a lot of different elements to it. I've always thought, you know, down the line, after years of accumulating all the debt that we've had, after really kind of relying on governments to be like the real backstop of everything, that ultimately would come down to something like this. It becomes geopolitical, where, you know, like this is the new chess, you know, game that we're playing.
This is different, though. Central banks don't seem to have a role in this moment. We're used to that, and that's why I think what Jeff Curry of Carlyle said on this show just last week is so important. You can't print molecules. You can't print barrels. The central bank backstop, the anchor, isn't there for this market. This is different, no?
No, clearly. Like, I mean, look, we don't even know the full extent of the shockwaves that are still coming down the pike from the closure of the Strait of Hormuz, right? Like, I mean, like that. I think that's the unusual optimism that somehow it's all going to turn around. When you can't just turn on a light switch.
And Iran is making a major effort to formalize what essentially they're trying to set up at the moment, which is charging people to use the Strait of Hormuz. And if you think this is just a negotiation right now between Iran and the United States, you're mistaken. You've got nations across the Gulf who are not going to be interested in tolerating any of that as some kind of formalized structure over in the Middle East.
Which we've seen, for example, Saudi Arabia and the UAE saying that there are certain red lines, that they aren't going to be patient forever, as Jumana has reported, that they could join the effort against Iran. What does a ceasefire look like? What does a de-escalation look like? We keep coming back to that. How far away are we from things going back to the way that they were?
Equity futures right now in the S&P just off session lows. We're negative by 0.7%. George, it's good to see you, as always. George Concalves there of MUFG. There is a bond auction coming up later. We'll talk more about that. We'll get Lisa's thoughts on the story. 2s, weak, 5s, weak, 7s a little bit later on this afternoon. Let's give you an update on stories worldwide with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Good morning, John. The Pentagon is reportedly ramping up military options for a potential, quote, final blow in the war with Iran, according to Axios. The plan could include the use of ground forces and a massive bombing campaign.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
President Donald Trump and Chinese leader Xi Jinping planning to meet in Beijing on May 14th and 15th. Trump was due to visit China next week, but postponed his trip to focus on the war with Iran. And travelers are facing the longest wait times on record, with some stuck in airport security lines for nearly 5 hours. The partial government shutdown has left the TSA without funding for about 40 days. Republicans and Democrats remaining deadlocked over disputes on immigration policy. That's your Bloomberg Brief. John?
Yeah, hi, thank you. I've got a friend, works at Bloomberg. Got a flight at 6 a.m. from LaGuardia, and I was watching the social media account of that individual. They got there at 3 in the morning, thinking that that would be enough time to avoid the lines, and the line is incredibly long already.
The response? Delete vacation. I think I'll drive.
Right.
I think increasingly people are saying, you know what, I'll meet you in a month. Let's just postpone this
Who is going to want to fly? Use any of the airports with the lines that long? More on that story a little bit later. Up next on the program, talks about talks.
Nobody's ever seen anything like we're doing in the Middle East with Iran. They are negotiating, by the way, and they want to make a deal so badly, but they're afraid to say it.
Up next, General Robert Walsh of Academy Securities, live from New York City this morning. Good morning. Equity futures just off session lows. We're negative by 0.6% on the S&P. On the Nasdaq, we're down by 0.7. In the bond market, yields are higher across the curve. 10's up by 4. And once you've seen those two boards, you know what this one looks like. Crude higher by 3%. 93 on WTI. Brent crude this morning pushing 106. Bramo just counting down to that self-imposed deadline into the weekend.
If there is some sort of re-escalation, then all of a sudden there becomes a material risk of further oil supplies getting actually destroyed, and that the plants themselves, and that I think is the real concern. At what point are you talking about years to bring some of the supply back online?
Brent crude right now 105.61. Under surveillance this morning. Talks about talks.
Nobody's ever seen anything like we're doing in the Middle East with Iran. We are decimating. They've got no Navy, they've got no anything. They are negotiating, by the way, and they want to make a deal so badly, but they're afraid to say it because they figure they'll be killed by their own people. They're also afraid they'll be killed by us.
So here's the latest this morning. The White House doubling down, claiming peace talks with Iran are ongoing. Tehran rejecting the latest U.S. proposal and offering conditions of its own. Bloomberg's Ollie Crook joined us now from the G7 foreign ministers meeting over in France. Ollie, good morning. What's on the table into the weekend?
I think for the G7 foreign ministers who are gathering here, we just spoke to the Canadian foreign minister. This is really a fact-finding mission in their conversations with Marco Rubio, who will arrive here tomorrow morning to try to establish a few facts. Of course, there's the great question about the U.S. war aims, what the next steps are, potential coordinated response in order to dull the sort of influence of energy, the energy crisis we're feeling in ordinary times, John. The G7 would be the kind of format where you discuss potentially petroleum reserves coordinated across all of these nations. But we are, of course, not in ordinary times. I think for the Europeans also to quite have an understanding of what they envision, what the Americans envision a European role could be here. We've heard from President Trump that he'd like some help in potentially opening up the Straits of Hormuz. He's pulled back on that. Marco Rubio tends to bring sort of practicality to some of these broader initiatives from the United States. So I think that will be the focus here. And of course, trying to keep the U.S. on side on the question of Ukraine and Russia. There have been a lot of reporting recently, John, about the intelligence that's been shared by the Russians to the Iranians, potentially delivery of drones and hardware to the Iranians. So that will all be in focus here, John.
Ollie, looking forward to your coverage of the story on the ground in France. Ollie Crook there. This could get awkward for Rubio. This from the president just moments ago out on social media. NATO nations have done absolutely nothing to help deal with the lunatic nation, now military decimated, of Iran. The USA needs nothing from NATO, but never forget this very important point in time.
Okay, Marco, go negotiate with them.
Go have fun.
Have a great time, and I hope those discussions are fruitful. This comes also with Germany talking about ways to get leverage in their next negotiation with the United States. Clearly, Europe very concerned about how to deal with President Trump's United States of America.
So this is how the diplomatic chessboard is set up right now. Secretary Rubio essentially heading to France. You've got J.D. Vance, the vice president, reportedly preparing to make his way to Pakistan for talks. And then you've got military troops reportedly on their way to the Middle East. So you could have troop build-up, several different talks in several different places, and a lot of options for the president, who, according to Axios, hasn't made his mind up.
And this is the reason why markets are really getting mixed signals. It's unclear who exactly is going to win out at the end of the day. And there is a schism right now in the MAGA movement about how to proceed, how involved to get this. It is not popular to put boots in the ground. Some people saying there isn't another option to get the Strait of Hormuz open. And this is the setup heading into the weekend.
Let's get to the options. Anne-Marie joins us now from Washington for more. Anne-Marie.
Equity indices built on opinions. That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Good morning.
Good morning, Jonathan. And to make that G7 meeting potentially even more awkward for Secretary Rubio, the Washington Post is reporting this morning that the Pentagon is also weighing moving some hardware that has been used in Ukraine to the Middle East, because, as you say, they need options. And to discuss those options, we're now joined by Lieutenant General Robert Walsh of Academy Securities. He's been a friend of the show and someone who can give us some insight on actually what this could mean if the president were to send these troops on the ground. Axios is talking about a, quote, final blow. And a lot of this says to me, when you look at some of these options and some islands they would want to take, it would really be about controlling the Strait of Hormuz. Given what we know about what kind of personnel is being sent to the region, how would they actually go about doing this?
Thanks for having me today, Marie. I think, it looks like what you're trying to do is bring as many options on the table to try to escalate this, to try to end this. It's in the Trump administration's interest and the world's interest to end this as quickly as we can. The pace that we're going, the U.S. and the Israelis have had an air campaign that kind of dominates the air domain at this point in time. But now the next goal is to open up the straits. And to be able to open up the straits, they're not going to probably be able to do it by air alone. They're going to need maritime capabilities. And then when you introduce ground capabilities, taking key terrain is a key part of what the U.S. military can do with forces like coming from the 82nd Airborne or these Marine Expedition Units. In fact, one of the main missions of these Marine Expedition Units are to seize advanced naval bases and seize and control choke points. And seizing key terrain is a key military objective, even in today's style of warfare. Now, obviously, they're going to have to be protected to be able to go in there and have all the capabilities to do that. But seizing terrain or the threat of seizing that terrain can drive the behavior of the enemy. And I think that's what they're hoping to do by introducing them, drive them closer into the negotiations to try to bend to the U.S. will in those negotiations, or escalate this to try to bring this to an end.
Well, if they're going to hold some of these key assets to open the strait, how long could these kind of individuals hold it? Because the regime will likely keep fighting on. Does this mean that we're going to have to relieve some of these people and this could last months or maybe years?
I think the hope would be to bring them in, seize that key terrain so the Iranians can't use these. A lot of these locations they're using for missiles, drones, but a lot of these fast attack boats that they've used in the past, and it's hard for intelligence to know whether we've gotten them all. So sometimes you have to go in there and really look around and be able to seize things to be able to make sure that they don't have that capability. Or if they bring it out, you're right there to whack them. So I think part of that is bringing them in, and if you brought them into one of those islands, you may put them in there and protect them with air cover, maritime cover, but you may also insert them for a while. It could be go in there to seize oil, gas, refueling capabilities, shut down the piers, those locations, and you could extract out also, and then put in some type of blockade that would stop, the Iranian shipments going out, but you now have stopped them from being able to operate from those locations.
You mentioned this idea of escalate to de-escalate. Do you think this would harden the regime or it actually would push them to the negotiating table?
It's very difficult to see with this regime. You go back to World War II and what it took with the Japanese, and you go back with the Germans and how much it took to finally bring that war to a conclusion. In this case, this is even a more fanatical regime. So the hope would be that you can escalate this so much that they feel so much pain that they look for some way for an out where they can get to some type of ceasefire where they could claim domestically some type of victory, because I think at this point in time, the regime change is not going to happen by military action, not unless we marched on Tehran, which there is no intention to do that. So I think the capability now would be to try to take the military objectives that we set out and then now look to see what the people will do over time. And it may not be in the next weeks, it might be months, it might be a couple years.
Can the U.S. do this alone?
I think what the president's been trying to do, I think on the taking the straits, I think that's something that we could absolutely do with the forces that we've got lined up. But I also think keeping the straits open by escorting ships through there, having air defense capabilities, so we start escorting commercial shipping through there. The best thing we could do is to build a coalition, and I think that's what the administration's trying to do. But a lot of the countries, they all have different requirements. We saw that in Iraq and Afghanistan over rules of engagement. Everybody had their own kind of sets with what they were comfortable with. This would be some countries, like maybe the British, would like to come in and operate with us and how we operate. Others would wait till the conditions would be more set where they would have less risk, but they would be part of this coalition to open up the straits. But this actions we're doing now to escalate with the threat of using ground forces is all part of opening up the Straits of Hormuz, which is a key part along with getting the nukes and stopping the nuke growth.
Absolutely. That's where all the oil right now, this key chokehold. Thank you so much, Lieutenant General, for your time this morning. Jonathan, of course, that was Lieutenant General Robert Walsh. What's so interesting is when you talk about the Strait of Hormuz, what the Iranian parliament right now is discussing is basically making this passage for a fee. And we already know that one vessel that went through had to pay $2 million in order to get their cargo safely through the strait.
Anne-Marie, appreciate the update down in Washington, D.C., which is why we've said already this morning that this is not just about the U.S. and Iran anymore. If Iran is attempting to formalize what Anne-Marie just described, you're going to have some nations across the Gulf with a few things to say about that.
Can you allow Iran to become essentially a superpower right now with the control of one of the main waterways in this world? That is the question.
Brent crude up by 3%, 105.50 on Brent this morning. Up next, Whaley of BlackRock downgrading equities as the war takes a toll. Sometimes the price action is so volatile, your head's spinning, you forget where you are. On the week so far, through Wednesday, coming into Thursday, we're actually higher by 1.3%. Close out the week at these levels, one of the best weeks we've seen since early January. So there you go. Things can change a lot in the next 24 hours, that's for sure. Equity futures on the S&P pulling back by 0.6%. Likewise, on the Nasdaq, we're down by 0.7, down 0.9 on the Russell, with higher bond yields this morning, 2s, 10s, 30s, yields up across the curve. We're looking out for a 7-year auction a little bit later after soft 2s and soft 5s over the previous 2 days.
Those two auctions rhymed in the sense that the bid to cover auction was the lowest going back to 2024, and dealers took down the most going back to 2022. How come there is this lack of appetite for U.S. debt? Is it because of concerns about inflation? Is it concerns about the fiscal response to any kind of crisis? Or is it a sense that people just don't know where to put their money right now? So they're playing whack-a-mole with the headlines. It's really curious. Watch the $44 billion of 7-year notes sold today.
So there's a lot of reasons, and you've outlined a few. The one I'm paying attention to, this is the one I want to see come together, try to understand. There's obviously domestic internal budget pressure at certain countries around the world right now, in Asia, in the Middle East. And I just wonder how that's going to shape foreign flows in the next several months. That predictable demand that might come from those sources, how it might be shaken up by the decline in crude revenue in the Middle East because they can't get the barrels out, and the increase in crude imports for Asia struggling to get the barrels in.
A great example of that is gold. The idea that gold prices have gone down as central banks in different parts of the world have sold gold in order to raise resources. You talk about the Middle East. How much are Saudi Arabia and UAE investors really going to continue to go into U.S. assets? This has been a linchpin of a lot of the investment for a lot of the tech build-out, let alone U.S. treasuries. How much does that start to wane as this conflict is ongoing? Some people say, well, they could gain more on the other side if there is a good outcome. You know, this is going to be a question, and a real question, especially given an appetite to diversify for some of these nations away from the risk that they hold currently.
I thought the piece from Mohammed Al-Arian in the Financial Times earlier this week was really quite prescient on Gulf flows. The Gulf is a source of capital, not just a source of energy and what it might mean for financial markets in the coming weeks and months. As we can't get down to the opening bell with crude advancing, upending some of those moves in the bond and stock market. Let's get you some single names and morning movers. Yahara has more. Hey, Yahara.
Hi, John. It's a familiar pattern playing out when investors start to get uneasy about the situation in Iran, especially with conflicting signals from both sides. You start to see gold and silver sell off. Gold retreating today after a two-day bounce, and that is pulling down the mining stocks. So you have names like Hecla Mining down 3.9% in the pre-market. Moving on to memory chip stocks, they are extending their sell-off. SanDisk down 3.4%. Micron also in the red after Google introduced a new compression technique that could cut memory needs for AI models by as much as 6 times. So, of course, that is raising concerns about future demand, while others on the street are saying greater efficiency will only increase usage over time, referring to Jevons model. But today, investors choosing to price in the risk. Plus, these names have run up so much, so makes sense on a risk-off day like today. And we end on a small stock making a big move. Olaplex soaring 50% in the pre-market on some deal news. The company Henkel, a German company, agreeing to buy the hair care brand for $1.4 billion. John?
Yahara, thank you. Thanks for the update. More from Yahara a little bit later. On our radar this morning, Iran rejecting the US ceasefire plan and continuing attacks on Israel and Arab states in the Gulf. Tehran offering its own conditions for a truce, including reparations for war damages and authority over the Strait of Hormuz. Elsewhere, a Turkish-operated tanker carrying about 1 million barrels of Russian crude hit by drones in the Black Sea near Istanbul. Turkey's transport minister saying there were no casualties or spilled oil. And finally, the Ares Strategic Income Fund posting its steepest monthly loss on record last month. The fund capping withdrawals at 5% early this week following a surge in redemption requests.
This feeds on the whole private credit concern story. Just to sort of have a to be sure here, the decline that we're talking about in February was 0.68%. This isn't exactly an 8% drawdown or even a 15% drawdown or even a 3% drawdown. So at a certain point, you've got to frame it in the context that these funds just haven't really seen losses in their recent iteration. There has been a golden era for private credit for so long that no one has experienced the downtrend of the cycle. That's the reason why people are looking and saying, what exactly are we looking at? Are we looking at the end of the cycle and some sort of collapse? Are we looking at some shakeout, particularly tied to software names, which accounted for about a third of the portfolios of a lot of these private debt funds?
Also hard to really frame the amount of redemptions we're actually seeing right now and how many of them are real or not. And what I mean by that, we touched on it earlier on this week. If I know that whatever I request, I'm only going to get half, I'm likely to ask for double. And I wonder just how much of that we have seen over the past few months.
It's the reverse side of allocations to debt sales. People put in twice, 3 times as much, and that's the reason why a lot of the investment bankers say it was 5 times oversubscribed, because they know they're not going to get the allocation that they're looking for. A lot of questions around this story. When you talk to people in the market, it doesn't seem like there is crisis type of alarm bells ringing here. And you could see that by the fact a lot of people went into software names in the past couple of weeks as other people were distracted by what was going on with the Iranian war. That said, there is a fragility here. And should there be some sort of economic downturn, people point to this area as evidence of a weak spot that could potentially percolate out into the broader economy.
Without a doubt. And it's headline after headline every single morning on this program coming out of private credit. Let's turn to global markets, whipsawed by conflicting signals from the US and Iran. Wei Li of BlackRock writing, we're dialing down tactical risk for now. We turn neutral across equity markets because overall risk asset pricing is not consistent with the shock implied by energy markets. Wei joined us now for more. Wei, welcome to the program. This is something that a lot of people are talking about, a shock in energy and how to price it in equities. What suggests to you that we're mispriced?
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now we're in the heart of Egypt, your gateway to Africa and the Middle East.
Yeah, so this is how I'm thinking about it right now. The risk feels a bit asymmetric at this moment. So if we have a peace deal, then we could have a relief rally in markets, but US equities are just over 4% from the beginning of the conflict, just how much room there is for that relief rally to go. On the other hand, if we don't have tangible evidence of actions that could shorten the duration of the disruption, and right now we don't, then current risk pricing is not consistent with the doable disruption that energy markets are pricing right now. So our energy investors are telling me that we have already lost about 10% of global oil supply, 20% of global LNG supply. Now, driving this inconsistency in risk assets, especially equity asset, could be this buy the dip flow dynamics, right? So before I just came on, I was using the Bloomberg Ask B function to pull up the flows going into US equity ETFs. It's a really easy function. And actually, the flows has been going up since the beginning of the conflict, even though sentiment is clearly plummeting. And I think that has been one big reason behind the inconsistency in market pricing. And because of this risk asymmetry that I just talked about, we have flattened equity directional exposure to neutral while leaning into thematical themes. So for example, no matter what happens from this point on, as a result of the events in the Middle East, every company, every government globally is going to be very focused on energy security, energy independence, and also supply chain and infrastructure security. So these are the themes that we're leaning into whilst being directionally neutral on equities right now.
Wait, are you suggesting then there will be a premium, an additional premium in the price of commodities due to stockpiling beyond whenever this situation concludes?
Well, we already see some stockpiling activities by countries, and countries are putting in restrictions on energy use already as a result of the supply chain disruption. So, Jonathan, you may remember that we rolled out the world shaped by supply framing almost 4 years ago, characterized by mega forces. I think we're in a supercharged version of that word shaped by supply. You look at what has worked during this period of volatility. It hasn't been gold, incredibly. It was not government bonds. Real assets have actually been working better as a diversifier in this environment. I think in this supercharged world shaped by supply constraints, this is what we're dealing with right now. So macro environment is really quite different. No matter what happens from this point on, the macro environment for 2026 is very different because of the stagflationary momentum in the system, because of the existing disruption that has already taken place.
Wei, a lot of investors who've come on the show agree with you, and they say that they are taking down risk, but they're taking down risk more in Europe. They're taking down risk in Asia, some of the more exposed areas to imports of energy assets. You talk about downgrading U.S. stocks in particularly. Why don't you think that the U.S. is almost a haven from some of the turmoil because of the oil production in the nation?
I would say that we already preferred U.S. equities over Europe and Asia equities through most part of the conflict so far. So this adjustment right now that we have implemented this week is really just to flatten the directional movement across equity exposures. So we had the overweight in U.S. equities, so we flattened that, but we didn't have the overweight in European equities. We didn't have the overweight in Asian equities, which is why they were already flat. So right now we want to square the directional kind of exposures by being neutral across equities at the moment because of the blow by blow volatility coming from headlines. I think this week is the perfect example of how it is impossible to predict the next announcement. And I think squaring the directional exposures makes sense. It's just good risk management. But we are very nimble and very dynamic to look to dial up or maybe even further down risk, like what we did back in April. We're looking very closely for evidence of durable kind of policy actions. And right now, markets seem to react a lot to announcements coming from the US side, which is why we saw the last few days markets trying to rally on announcements from the US, but maybe actually the announcement coming from the Iranian side could be driving the next kind of progress, next step in this journey.
Well, you noted that a lot of the government bond space has not acted as a counterbalance to some of the risks that we've seen. It hasn't acted as a haven. How concerned are you about some of the auctions that we've been seeing, the U.S. government bond auctions that have been pretty messy over the past couple of days?
You talked about it earlier on and also cited reasons such as inflationary concern as well as fiscal concern. I think these are really big reasons for why maybe the appetite for U.S. treasuries is less compared to before. And I think also you talked about kind of petrodollar potentially decreasing and also the greater demand for real assets. Where is that going to come from? And I think they all play a role. But I would say at the same time that markets have gone through significant repricing, especially at the front end of government bonds in the US, yes, but in Europe, in other parts of DM markets too, to the extent that actually as a temporary cash buffer, they don't look too bad. So we actually prefer the front end and the belly of the US Treasury market over the long end of the US Treasury market. And the same applies to European government bonds. We actually even this week brought up the front end of European government bonds from neutral to modest overweight to reflect the very significant repricing that we have seen for ECB hikes.
Wei Li, thank you. We've got to leave it there. Wei Li there of BlackRock on rate pricing. This from the President of the United States just moments ago out on social media. I'll read it verbatim for you so you can follow at home. The Iranian negotiators are very different and strange. They are begging us to make a deal, which they should be doing since they have been militarily obliterated with zero chance of a comeback. And yet they publicly state they are only looking at our proposal. Wrong. They better get serious soon before it's too late, because once that happens, there is no turning back. And it won't be pretty. The president, just moments ago.
Who's he talking to? Is he talking to the Iranians? Is he talking to U.S. markets? This is the reason why people are looking at these kinds of Truth Social postings and inferring what could the action be on the back end of this. There have been an increasing number of Truth Social posts from President Trump this morning, including one talking about NATO, we won't forget, and then threatening Iran to get serious about talks. Hard to get a sense of what actually is going on.
Futures just pulling back following those headlines. We're down by 0.75% on the S&P 500. With an update on stories worldwide with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump declaring victory in Iran. The president saying the U.S. is negotiating and Tehran wants to make a deal, but, quote, they're afraid to say it because they figure they'll be killed by their own people. They're also afraid they'll be killed by us. Meta and Google saying they will appeal a California court decision holding them liable for a young woman's mental health struggles. A jury ordering the tech giants to pay $6 million to the woman after a landmark case centered on social media addiction. And BlackRock's Rick Rieder shrugging off speculation of rate hikes this year. Rieder telling Bloomberg, quote, small businesses, young people, and the low income are really getting hurt by current rates. Rieder's call for a cut is in line with the White House's demand for cuts from the Fed. That's your Bloomberg brief, John.
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, pain at the pump.
We're going to see prices at the pump go back down. This president is keeping them as low as he can during this short-term combat operation, and they're going to go right back down when this is over.
They're getting higher. Michelle Meyer of Mastercard Economics Institute joins us next from New York City. This is Bloomberg Surveillance.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodology. that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
These stakes are high as we get closer and closer to this self-imposed deadline for talks between Iran and the United States. The president with a statement just moments ago, they better get serious soon before it's too late, because once that happens, there is no turning back and it won't be pretty. The president of the United States just moments ago with that statement, equities pulling back on the S&P 500, futures negative by 0.75% on the Nasdaq, down by 0.8, down 1% on the Russell. Story so far this morning, yields higher. 2s, 10s, 30s. A lot to think about. Some data later this morning. Initial jobless claims at 8:30 Eastern Time. Also, I think more importantly at the moment, the supply. The weak auctions we've seen across 2-year and 5-year notes this week. The 7-year is up next.
Yeah, $44 billion being sold at 1 p.m. today. The 2-year and the 5-year note, both seeing dealers take down the greatest proportion of those debt sales going back to 2022. Uncertainty here about exactly what the level of rates ought to be, and seeing these bonds sell off after the initial auction.
Quick check of crude for you. 106 on Brent, WTI at 93. Basically everything is set off the price of this right now. You wake up every single morning, you look at Brent, you look at WTI, and you've got a pretty decent idea of what everything else is doing in financial markets worldwide.
And you blink and it changes, and then everything adjusts at the same time. Who's going to want to hold risk heading into this weekend? We keep asking that, and I'm going to keep looking for that one person who's going to raise their hand and take it on. So please call in.
Chris Harvey, CIBC. Time to put some money to work.
Vino Krishna.
Yeah. Vino too.
Yeah.
I love that Vino raised his price target.
I think it's fabulous. We'll talk to him
Just
next week.
more of that. I'm not endorsing it. I'm just saying, like, that's bold. I respect it.
There's a lot of bold moves right now.
Totally.
I think I'll be hiding.
Oil prices are up. Gasoline prices are higher. Under surveillance this morning. Pain at the pump.
As for the temporary short-term fluctuation in gas prices, the president has said once these combat operations are over, this administration is going to continue to unleash American energy dominance. We're going to see prices at the pump go back down, just as we have over the past year because of this president. This president is keeping them as low as he can during this short-term combat operation, and they're going to go right back down when this is over.
So here's the latest this morning. U.S. gasoline prices rising over 30% since the start of the war in Iran last month. Michelle Ma of the Mastercard Economics Institute writing, gas prices are up, but with historical norms, within those historical norms, and households have shown resilience through recent inflation shocks. Michelle joins us now for more. Michelle, good morning.
Good morning.
You've got really good visibility on spending in this country.
Yes.
What's the reaction so far to much higher gasoline prices?
Well, I think consumers are managing remarkably well, as I noted. Certainly gas prices are higher, and that's a necessity, which means that more of that purchasing power has to be allocated towards paying at the pump. But when you think about the bigger picture in terms of how consumers are spending, it's holding up quite well. And I think a lot of that is because we're still in the early stages. We're still in the early stages of the shock. What will really matter is the duration of the shock. How long does it go on for? Because you see over the years, right, when consumers are faced with a temporary price adjustment, they can manage through that. When it becomes a permanent price level shock, then it becomes a very different story.
The starting point matters as well. Let's take the airlines. Lisa caught up with United earlier on this week. What we've heard from Delta and what we heard from United is demand ahead of the shock was sky high.
Yes, that's extremely important. And that was for the overall economy. When you think about the momentum at the end of last year from the holiday shopping season and how that continued into early this year, consumers were out there spending. They were out there spending on experiences. We see that very clearly in our airline spending data as well. So there was a lot of growth heading in, which means that, yes, we're at a world now where there's heightened uncertainty. There are a lot of questions. There's a lot of concerns, naturally, when it comes to consumers. But it's still in the early stages.
Steve Riscido of Mizuho said what this does for him, this oil price shock, is that it reduces the option for an upside tail risk or a tailwind to the U.S. economy, that is taken off the table, but that the momentum will prevent the U.S. from falling into recession. Do you think that there is sufficient momentum to deal with oil prices should they reach $125, $150 a barrel?
So I think we need to take a step back and think about this overall cycle and consider how every year, probably right around now in the spring, the pessimism comes in a big way. And there's always a reason why, whether it was tariffs or the smaller bank crisis or a variety of other shocks that were hitting the economy that were making people feel really uncomfortable, making investors and economists feel very uncomfortable. And the U.S. economy in particular has managed through remarkably well time and again. So I think that there is this kind of dynamic nature of the economy that has allowed it to manage through a lot of headwinds very, very well. So yes, you have to think about where we're coming from, what we've learned throughout the cycle, the momentum that started in the beginning of the year, and then consider where we're going from here. If oil prices remain very high for an extended period of time and financial conditions tighten, it could create some real challenges for the economy. It doesn't necessarily mean a recessionary environment, but it's something we have to monitor. If it's a short blip, then you have to consider, again, the underlying trend and how much momentum there's been in this economy. And the conversation changes.
A lot of analysts have pointed to the labor market weakening. Do you see any evidence of that type of dynamic showing up in some of the demand on the consumer side?
So certainly the pace of job creation has weakened. The unemployment rate has inched higher. We'll see what jobless claims show. So far, they remained very, very low. So there's not that much evidence of job reductions. There's certainly evidence of a reduction in hiring rates and overall churn in the workforce. So I would argue, yes, the labor market now versus a year ago or 2 years ago is in a more challenging place, but I don't think it is a challenged labor market because you're not seeing that displacement.
What are the prospects for second-order effects from this inflation shock coming from energy? What are the chances that I can go to my employer and say, my energy bill's up, my gasoline prices are higher, I want a higher raise?
So you want to know about a wage price spiral?
Without a doubt.
So I think in this environment, it's probably a bit harder to see that play out because you have a labor market where there's you don't have the same degree of churn. You don't have that same amount of bargaining power exhibited by employees. So that does mean that the extent to which energy prices increase, it's going to be a matter of consumers trying to figure out how they navigate that, how they shift things around, how they reallocate what they're spending on in order to manage through that. It's different than in the last big energy price increase where the labor market was very hot. So we had energy prices increasing, we had asset prices increasing, and we had wages increasing. The overall economy inflated.
That explanation is the biggest argument right now for the Fed to look through this shock. That's why traditionally you look through it if the labour market's not that tight.
I was expecting you to say, don't let that discourage you from going to your boss and asking for a raise at the same time. You are correct.
I don't think you should give up on asking for a raise.
That's where I thought you were going to go with this.
Keep your leverage, all right? Xauusd, good to see you.
Great to see you.
Always is. Thanks for dropping by. Thank you. Coming up on the programme, we'll catch up with Ozan Tarman of Deutsche Bank, John Lieber of Eurasia Group, the OECD Secretary General Matthias Cormann, and the former Dallas Fed President Robert Kaplan. The second hour of Bloomberg Surveillance up next.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
It's going to take logistically and from the production perspective months to go back to normal.
The longer we go, and this I think is the key issue.
There's nothing the Federal Reserve can do. They can hike or cut all they want. It's not going to open the Strait of Hormuz.
The uncertainty in the Middle East may put them on hold for a while.
The U.S. economy can take a few more punches than the rest of the world.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Pulling back by 0.7% on the S&P 500, down by 0.8 on the Nasdaq. In the bond market, yields up across the curve, 2s, 10s and 30s. 2s this morning higher by 4 basis points, approaching 4% again, up by almost 5 on 10s at 438. And crude doing this. WTI and Brent pushing higher once again. Brent at 106, WTI at 93. The president setting the stage for talks going into the weekend and his self-imposed deadline for negotiations. The diplomatic effort continues. This from the president. They better get serious soon before it's too late, because once that happens, there is no turning back, and it won't be pretty.
The reason why people are concerned about oil prices from here is because oil production facilities would be in the line of fire given any escalation. That's what Iran has said. And the U.S. side has also talked about targeting Iranian facilities. Given that backdrop, people are watching some of these discussions, some of these Truth Social posts, the comments to understand whether there is an effort and a desire to de-escalate or escalate. If you get any clarity, good luck. Call in and let us know, because right now it has been highly a soup of uncertainty and messaging that runs in all directions.
I have so much sympathy for anyone waking up and trying to commit capital, allocate capital to this market this morning. So much sympathy. This can cut two ways in a very dramatic fashion. You've got markets at the moment itching to allocate, itching to step in. The fear of missing out greater than the fear of losses at the moment. And you can see why. You've got some signal from the administration they'd like to make a deal. I get it. But then you look at the calendar and you think about where we might be in 2 days' time, when this self-imposed deadline expires and the troop build-up that's been ordered reportedly arrives in the Middle East. Then this can go dramatically in the other direction.
This is, and I have a lot of sympathy for them too. A number of analysts have come on the show and said, we're not going to trade this. This particular set of events isn't tradable. What is tradable is the risk premium that Jeff Curry was talking about in commodities, is the concept of stockpiling key assets of national security and building up some sort of defense system. And that's what Wei Li was talking about of BlackRock. They're going to go with those mega themes rather than try to time out different postings on different social media.
Should we talk about auctions?
Please.
These are the real-world issues happening in financial markets right now. You've seen the shock in energy. We've been tracking it through fixed income as people try and price the future of interest rates, inflation, how much fiscal space have all of these different nations got for very different reasons. The 2-year was soft. The 5-year was soft. There's a 7-year auction coming up a little bit later. The traditional stable sources of demand are under question right now because domestically, internally, pressure's building abroad in places like Asia, in the Middle East. And I give some credit to Mohammed Al-Erin earlier this week, and we talked about his piece in the Financial Times, pressing, I think about the Gulf not just as a source of energy, but also as a source of capital, and trying to track that story in the coming days.
They've been the seed investors for a lot of the private credit investments, for a lot of the private equity investments, for a lot of the leveraged finance deals that have gotten done. And now there's a real question about whether they have the capacity to keep allocating, let alone the willingness. This hasn't come from increasing inflation expectations, and I think that is underpinning what you're saying. When you look at five-year break-even rates, which is the expected inflation over the next 5 to 10 years, it is the lowest in more than in almost a year. That is how far it has fallen. You could say that this is a skewed metric. Nonetheless, maybe it's better than the University of Michigan Sentiment Survey in terms of forward-looking inflation expectations, and it is not screaming inflationary spiral. So that gives you a sense of why the increase in yields is that much more interesting.
You Mitch tomorrow, right?
It is.
Okay, looking
we'll be
forward
watching
to that.
Closely.
We will, of course, on the way home, right?
Yeah,
after the show.
Exactly.
Sure. Okay. Coming up this hour, Ozan Tarman of Deutsche Bank. As war uncertainty rattles markets worldwide, the OECD Secretary General Matthias Cormann on a stagflationary shock, and the former Dallas Fed President Robert Kaplan on pricing rate hikes. We begin this out with stocks lower as crude prices push higher. Ozan Tarman of Deutsche Bank writing, energy is the dominant transmission channel into inflation expectations and cross-asset correlations, raising the question of whether duration still hedges risk assets in supply shock regimes. Ozan joins us now for more. Ozan, good morning. Good to see you.
Wonderful to be here.
You're a very connected man. You talk to a lot of people. In your conversations in different regions over the past 3 weeks, just give us an idea of what they sound like at the moment and how they've changed.
Complacency, John. That's the key word that I'm coming up with after my New York City trip. Obviously, the Monday headline helped. That whole 5 days gave us a bit of a breather. Only 2 weeks ago, I sensed that everybody's waiting for, or the moment that we keep getting, mission accomplished from the president, equities higher, oil lower. I would say 2 weeks ago in London and around, there was more bearishness. People wanted to really fade that. Now, into the weekend, into these ceasefire hopes, I do sense, especially in this city, complacency, the feeling that American assets can bear this out, the feeling that maybe 23, 24, like US outperformance may be back. So we're very vulnerable, very fragile to mornings like this, when the president raises the game again. If, for much more important than market reasons, if there's a human tragedy over the weekend, if a ship gets, 1 or 2 ship gets hit, we're vulnerable to that.
Where do you see greater complacency? Because we have repriced asset classes a lot. particularly in energy and in bonds. Where's the greater complacency at the moment?
Great question. I mean, the hurt was in especially front end of rates, especially in oil, where complacency is, especially in the US, equities and credit. Still feeling very, very resilient. Credit, wonderful to be here with Lisa, with all the worries on private credit. I think there is a merit to that. Things can get a lot wider than where they are if headlines turn more nasty.
What are you telling clients when you say you really ought to be careful about the complacency and, frankly, the ripple effects that are coming from the fixed income market?
And the 7-year auction, right? So, look, first of all, yes, it looks untradeable, but especially if one has survived this whole saga, there is a lot to be done. So I do have sympathy with those who are betting on more of a ceasefire, to tackle some good headlines to come, and because of that, us having a small pop-up. But I think the bigger risk is the wounds that we have created, the big oil supply problem. Because of that, unfortunately a cliche, but a very true cliche, it may be a war triggered by US and Israel, but Europe, Asia, UK will get hurt more. So for the moment, I'm here, Vice Chair of Deutsche Bank. I would have loved to talk about my blue hat and European outperformance, but looking forward, I do see underperformance from rest of the world, Europe and Asia. A trade that has done wonderfully for 15, 16 months. Now time to scale back.
You mentioned the front end of the yield curve and how much people have priced out rate cuts and now are pricing in rate hikes. What do you think is behind that? Because inflation expectations have not picked up in a lot of metrics over the longer term. And as John was just mentioning, the idea of a wage price spiral looks much less like a given this time around than, say, back in 2022. Why this pushback so significantly against rates?
Because people do believe that really this higher story has momentum. They do worry more about inflation. They do remember 22. They do remember the supply shock, even though there are many differences between 22 to now, supply shock versus demand shock last time around. And they don't want to let that go. They don't want to make the same mistake of 22, so they're holding on to their bearish front-end expectations. Even here, in again, Europe and UK, it may be even more justified because we're very vulnerable to those oil shocks. And even listening to Madame Lagarde yesterday, yes, she did sound balanced. She did walk a careful line. But if oil continues to even stay high, would you really rule out a summer hike, a spring hike? No.
What do you think the pain trade is right now in fixed income?
Pain trade, the absolute pain trade is for us to go back to pre-Iran. Remember those Feb 27, Feb 26? All we talked about was AI, Strini, Schumer article, something bad's about to happen.
Right.
Bull flatteners, some legendary names that we both talked to a lot. We're claiming that bond is the new gold. That coming back, you know.
So the pain trade is lower yields from here.
Everything coming lower. So bull flattener. That almost sounds like a fantasy. But be careful, in 3 weeks these things can turn. But even steepeners, all of a sudden front end coming down, maybe hearing what Lisa says a bit more, feeling that all wars coming in may change the picture a bit. We're big believers in bear flatteners again, so a bull steepener, front end coming lower could be a pain trade.
Ozan, it's good to see you. Thanks for being here.
Always a pleasure.
Thanks for making time for us. Ozan Tarman there of Deutsche Bank. Heard this a few times, that at some point it gets so bad it's good for bonds. We're not there yet.
But you have to imagine, typically bonds do well when growth falls off a cliff and it incurs some sort of recession in a region, which is the reason why Wei Li was talking about buying bonds in Europe, because things don't look great there. And if they hike rates, well, that's going to torpedo growth, and that's going to maybe be good for bonds perversely on the back end. This is, again, you keep going back to what exactly is the bond market representing? Is it inflation expectations? Are break-even rates accurate? If they are, then they're inflecting lower. They're highlighting an actually disinflationary type of impulse. Or is it fiscal that people are worried about?
Will you forgive me for making it really confusing?
I think that there's no way that this can be a less confusing moment.
I happen to think the pain trade's in the opposite direction. I'll tell you why. It's not that I think it's the most likely outcome. I just think that's where there is the most doubt right now. Just surveying the people that come on this program. Most people come on this program and say, look, I understand why rates have repriced higher, but this is why they're not going to hike, and this is why yields need to come down. And everyone I speak to in fixed income at the moment looks at the backup in yields and turns around and says, we've created a lot of value in the yield curve. I think this is the time to buy, which is why I would say, from my perspective, and I'd be interested in other people's perspectives on this too, when I think about pain trades, I'm always thinking, where is the most doubt? And the most doubt seems to be in fixed income right now, that yields can go much higher from here. Maybe they can.
The pain trade, when it comes to tradable moments in the near-term positioning, might be a bull flattener. The pain trade for the entire market, particularly risk assets, is yields going higher and blowing out a lot of people's expectations of what asset pricing looks like. That is the pain trade that is a much bigger one that could incur some sort of recession.
Not necessarily the most likely trade, but one to think about. We can argue about this in a commercial break. I'm happy to. Let's get you an update on news worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump posting on Truth Social this morning that Iranian negotiators are, quote, begging to make a deal. The president's urging Iran to get serious before it's too late, writing, once that happens, there is no turning back and it won't be pretty. The Trump administration is trying to arrange a meeting for Vice President J.D. Vance in Pakistan this weekend for Iran peace talks. CNN reporting other top administration officials could also join the meeting. Turkey is also being floated as a potential location. And Fed Governor Stephen Miron raising his rate projection for the end of the year. Miron saying, I boosted my policy rates by 0.5%, not due to oil in Iran, but due to inflation data. Miron voted against the Fed's decision to leave rates unchanged last week, preferring a quarter-point cut. That's your Bloomberg brief. John.
Yahira, thank you. Thanks for the update. More from Yahira later this hour. Up next on the program, threatening to unleash hell.
President Trump does not bluff, and he is prepared to unleash hell. Iran should not miscalculate again. Any violence beyond this point will be because the Iranian regime refused to understand they have already been defeated.
John Lieber of Eurasia Group joins us next, live from New York City this morning. Good morning.
Seismic change. Will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth. And unlock economic and social prosperity through environmental responsibility. With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
This from a Bloomberg subscriber just moments ago. What an insane time to invest. Which bouncing board do we follow? Private credit, missiles, underlying company fundamentals, economic data. You're all wrestling with the same thing. Everyone is. Heading closer and closer to that self-imposed deadline this weekend.
Which we're watching right now, the risk coming out of the market ahead of this, cash levels going up, and a sense of where are you going to hide? Increasingly the answer, not U.S. bonds, not gold, but some of the commodities that are most sensitive to this particular inflation shock.
High-stakes diplomacy taking place on social media. That's what's happening right now. The president calling out Iran, saying they better get serious soon before it's too late, because once that happens, there's no turning back. That statement coming out 30 minutes ago. And
on Monday, the statement that came out from the president completely whipsawing markets, as you and Anne-Marie were talking about. How do you treat this? How do you want to get ahead of this? How do you get an edge in a market that is this vulnerable to these type of proclamations? I would argue the longer this goes on, the more a lot of investors say the upside gets smaller, the potential for an off-ramp declines, and the potential for real longer-lasting damage increases.
How do you trade this with great difficulty? At the moment, Brent and WTI higher, taking equities down by 0.7% on the S&P. We're down by 0.8 on the NASDAQ and pushing yields higher, unlocking higher bond yields. 2s, 10s and 30s. 10s up by 5 basis points now, just short of 440. And crude at the moment, Brent and WTI. Brent crude 106, WTI 93. Under surveillance this morning, threatening to unleash hell.
If they fail to understand that they have been defeated militarily and will continue to be, President Trump will ensure they are hit harder than they have ever been hit before. President Trump does not bluff, and he is prepared to unleash hell. Iran should not miscalculate again. Any violence beyond this point will be because the Iranian regime refused to understand they have already been defeated and refused to come to a deal.
So here's the latest this morning. The White House insisting peace talks with Iran are ongoing while threatening further escalation. Tehran rejecting talks and offering a new set of conditions for a deal. Anne-Marie has more now from Washington. Morning, Anne-Marie.
Good morning, John. We have another threat, another warning from the White House this morning. The president on Truth Social saying that Iran needs to make a deal, make it fast, or it will not be pretty. He says before it is too late, because once that happens, there is no turning back. Yesterday, Jonathan, I was with the president covering him, part of the press poll. He called what was going on with this war an excursion into hell. Clearly, he is weighing his options this morning to try to understand exactly what is going on and the political ramifications as well. Domestically, John Lieber joins us, of course, from the Eurasia Group. John, thank you so much for your time this morning. I'd love to just get your reaction to early this morning, before the markets open, the president with this latest threat to the Iranians. They better get serious before it's too late.
I think he wants this war to stop, and he's recognizing that he's in a bit of a challenge. So gas prices are headed over $4 a gallon, and his approval rating is headed below 40 points. And that's not a good place for the president to be. So he knows he needs to get out of this war, and he knows that he can't get out of it alone. Because even if the U.S. stops bombing, if he's in a situation where the Iranians are the only ones who are able to get oil or other products out of the Strait of Hormuz, that's a bad outcome for the world economy. So he's got to do something to change the game right now to get the Iranians to open up the strait. And these threats, I think, are his way of trying to do that, because I don't think the Iranians are in a mood to negotiate right now.
Do you think the talk of diplomacy, potentially reports of the Vice President, J.D. Vance, going to Islamabad to maybe meet with Iranian negotiators, is that real? Or do you think that's just a distraction while the president and the DOD get their personnel on the ground?
I think it is real in the sense that there are people who are trying to set up talks or mediate talks. The Pakistanis are involved. Steve Witkoff has been involved in talking to the Iranians. But I don't know if these are going to go anywhere. And I don't know if the Iranians right now have the incentive that they need in order to show up at these talks and make a good faith effort. You also got to remember that the Iranians have zero reason to trust the United States here. They got attacked, from their perspective, they got attacked by America while they were in the middle of negotiating a nuclear deal. And what guarantees do they have that the U.S. and Israel is not going to attack them again while they're negotiating a peace deal?
It is a midterm election year. You mentioned gas prices. Also the fact that there doesn't seem to be an appetite for boots on the ground in Congress. What kind of pushback do you think we could see? You were an advisor to Senator Mitch McConnell. What kind of pushback do you think we could see, not from Democrats, but from his own party?
Yeah, I think the pushback to putting American troops at risk here is going to be enormous. And if that's what it takes for Trump to de-escalate this war, is to get troops on the ground, seize the Iranian oil, seize some Iranian territory, and potentially expose thousands of Marines to hostile fire from the Iranians, who have lots of drones and missiles that they can turn away from the UAE and Saudi and focus on American forces, which the Iranians, of course, would be happy to do. I think that's a huge problem for President Trump, and I don't think that's really a viable option for him right now. Maybe in a few weeks, he sees that as the only path out of here, but there's going to be a lot of blowback on Capitol Hill and from the American public to committing these troops, and so it just doesn't leave him with great choices.
Where does that leave the $200 billion the Pentagon is asking Congress to sign up for?
The Democrats are treating that $200 billion like the authorization for use of force in the Iraq war, which they later came to regret because that authorization of use of force had been used to create these forever wars that cost trillions of dollars and got America bogged down for 2 decades. And so the Democrats don't want to vote for it. I think that's a tall order to get that $200 billion right now. It'll happen probably eventually, maybe at the end of the year when they have to do appropriations bills. But I don't, or Republicans have the option, of course, of doing a party line reconciliation bill, which introduces a whole other bunch of complexities, because you're going to have people that want to do tax, you're going to have people that want to cut spending, and I think that's ultimately going to be a huge problem for Trump.
If the president decides to take this action, Axios outlined what potentially some of the strategic goals of that would be, this, quote, final blow. Wouldn't the Iranians just tell the Houthis, we need to create more chaos for the Americans, we need to drive up oil prices higher, while they're now engrossed with the Strait of Hormuz? The Houthis should now close Bab el-Mandeb and close the Red Sea.
They could try it. The Iranian influence in the region is waning. I think all the proxy groups are seeing that right now Iran's not what they used to be. I mean, Iran does have a lot of money coming in their coffers, But our understanding is that the Houthis are asking for money from the Saudis to stay out of this war, and the Saudis are happy to pay that for right now. That could change over time. The Iranians could make them an offer they can't refuse. But I think the Houthis right now, we think, stay out of this war because it's in their interest to not attack their neighbor.
Speaking of the midterm election, speaking of the president weighing his options, the Wall Street Journal this morning said that Trump is telling close associates he wants to avoid a protracted war in Iran. If he takes this decision to send in troops to potentially seize an island or make sure the military is there to try to clean the Strait of Hormuz so more vessels can go through it, minesweepers and the likes, won't that mean we are now running the Strait of Hormuz and this becomes a protracted environment?
Yeah, absolutely. I don't think there's any easy way to get out of this war right now. If the U.S. de-escalates unilaterally, the Iranians have proven that they control the strait, and they can let friends and family through, and they can let shipments that are going to the United States or from its allies.
Friends and family for $2 million.
For whatever the discount is, yeah, you get a nice little rate on your ship that's going through. But I think that there's just no way out of this. So you can take it by force, but then you're committing yourself to probably months or longer of U.S. presence in the region, and again, exposing a lot of American troops to missile fire, which is not going to be popular here.
We're at $4 a gallon of gasoline. What does he do if we're at $5?
I think he pauses. I think he's got to say, I'm done. I expect the Iranians to open the strait, and that's the easiest action for him to take. It's the least risky action. It's a long-run strategic loss for the United States, and it puts Iran in a stronger position than when they started this war, but I don't see what choice he has.
John Lieber, thank you so much for your time this morning. Of course, Jonathan, John Lieber of Eurasia Group. Immediate reaction from the president's truth this morning. Another warning, but he's just keeping his options open as of this morning as we head into the weekend.
Anne-Marie, thank you. Getting closer and closer to that self-imposed deadline. What he just said there about the Houthis, that's one of the only release valves that region has right now to get energy out, and that's through the Red Sea. Can you imagine how much messier it would be if the Houthis got involved?
Everyone's a mob boss now. So the Houthis can say to Saudi Arabia, you want to ship your oil through here? Fork over some dough. And that's essentially what John Lieber said they were doing. It highlights, we're in a different regime now, especially when it comes to that region. What will it take to get it back to where it was before this war?
This can't become the new status quo.
Correct.
Which is why we keep going back to this. This is not just about talks between the US and Iran. Gulf nations have got a lot to play for here. And if Iran is pushing, and I keep going back to the big push they've got right now, when you go through the 5 conditions, the one that stood out for me is the one we've heard a lot about, which is trying to formalize what is happening through the Strait of Hormuz right now, which is turning that into their own waterway and no one else's.
That's not sustainable. That's not going to be agreed upon, certainly by the United States and certainly not by Gulf nations in the region. We're watching this. The Iranians know that the pain point for the president, as John Lieber was saying, was that $5 a gallon. So when you hear all of this rhetoric on both sides, the Iranians want oil prices much higher to exert maximum economic pain. President Trump would like oil prices lower so that he has some more leeway to maneuver politically. That is the framework that you have to view all of the rhetoric coming out of all sides.
Futures lower by 0.75% on the S&P. Up next on the programme, we'll catch up with the OECD Secretary General Matthias Cormann as the shadow of stagflation looms. Plus, Danny, how's your morning movers? Memory stocks sinking as Google announces a new compression technique for AI. That conversation up next. Quite a morning already. Check out the moves. Crude, Brent, WTI pushing higher. That's setting the tone for the session so far on Brent and WTI at the moment. Brent crude at 106.40, WTI at 93. That's taking equities lower by 0.8% on the S&P 500. On the S&P, we're a bit softer off the back of that move in crude. And this move in the bond market, unlocking higher yields, up 5 basis points on twos at 394, 10s at 438. I say quite a morning already, with the statement from the President of the United States on the talks with Iran. They better get serious soon before it's too late, because once that happens, there's no turning back. It won't be pretty. A statement from the President about an hour ago. So what could happen if the talks don't go well? Well, this is from Axios earlier on this morning. The Pentagon developing military options for a final blow in Iran that could include the use of ground forces in a massive bombing campaign. That according to 2 US officials and 2 sources with knowledge.
The administration was looking for a short war, something that was clean, I put it in quotes, akin to what we saw in Venezuela. The goal is to accomplish something with the minimum amount of pain done to supply chains and to the global economy. This weekend, we'll get a sense of exactly how that will transpire, potentially, given that the deadline, the self-imposed deadline, expires early Saturday morning. If there is an escalation, does that put some of the oil production facilities in the region in the line of fire, potentially pushing back how long this gets back online and supplies can pick back up to not just months, but years?
Think about how Monday morning felt before the president put out that post. The prospect of very near-term, almost immediate escalation risk and the prospect of this spiraling out of control. We could be there tomorrow evening. That's what the market's confronting at the moment, the prospect of whether that happens or not.
Getting conviction right now in this market, good luck. At the same time, people are saying we're not going to go back to where we were before. It is getting harder and harder as the time grows on. And you're seeing more investors lean into the stockpiling trade, the commodities trade. I was speaking with one investor who said increasingly, not just gold or even U.S. Treasuries, but any commodity-related asset that could be stockpiled will increasingly be the new safe haven, and you're already seeing flows that represent that.
It's a tense moment in financial markets. Let's get you some single names going into the opening bow. 2 hours away, some morning movers with Danny Berger. Hey, Danny.
Hey, John. Looking at the memory chip stocks this morning, falling after a brutal session yesterday as well. After an announcement from Alphabet, they put out something called TurboQuant that supposedly compresses the amount of memory that's needed. So that's been hurting the memory stocks. To be fair, equity analysts at Link said that it barely makes a difference, but these stocks have been on a tear. SanDisk up something like 1,000% over the past year, so not crazy to take some of the air out of that. Elsewhere, all the energy stocks reacting to what you were pointing out in the market, that is higher energy prices and concerns about escalation. Venture Global, a U.S.-based LNG company, one of the ones that has benefited. It already closed yesterday at a July high, having rallied since the start of the war. Shares add another 4.25% in the pre-market. Finally, wrapping things up with some earnings. We heard from Jefferies. Disappointment there despite the fact their investment bank had the best quarter, the best first quarter on record. Their earnings missed, though, 70 cents. Expectation was 87, and it appears to be tied to those credit blowups, taking about a $17 million write-down on both First Brands and MFS in the UK. So shares are down 2.4% this morning, John.
Danny, thank you. Looking forward to catching up with Danny in the next hour for more on those movers going into the opening bow. We'll talk about credit in just a moment. On our radar this morning, the Iranian parliament drafting a bill imposing tolls on vessels through the Strait of Hormuz. The plan would legally recognize Tehran's oversight of the waterway and could be finalized by next week. Elsewhere, Germany mapping U.S. supply chain vulnerabilities to use as leverage in future disputes with the White House. Sources telling us here at Bloomberg the initial findings suggest ways to target U.S. tech, AI investments, and pharmaceuticals. And finally, the former Goldman Sachs boss, Lloyd Blankfein, warning of a fire risk in private markets.
If you haven't had a crisis, it means you haven't had a reckoning. You accumulate tinder on the floor of the forest, and eventually a spark will come. The longer between intervals where there's a spark that sets it on fire, the more that accumulates. So at some point, there needs to be a forcing function or a reckoning.
We have seen headline after headline over the past few months. Ares and Apollo capping withdrawals from private credit funds at 5% this week after a surge in redemption requests.
Lloyd Blankfein is not alone. You've heard Jamie Dimon, you've heard Ted Pick, you've heard a whole host of Wall Street CEOs warning about this lack of a washout that will essentially and eventually face some sort of reckoning. Is this it? That's what some people are asking. Is this the initial tremors of some sort of credit crisis that could percolate into something broader? With Jefferies, why are their shares down so much if they beat expectations but did take a hit on some of these credit portfolios? The concern here is, should there be any pressure on the U.S. economy, any decline in growth, or even just a flattening out in growth, all these companies that could get financed at levels that were attractive, say 6 months ago, are going to get washed out, and there are a lot of investors who have not been practicing safe investments, I should say, going forward, and you're going to see some sort of reckoning there.
I'm not going to go there.
Please go ahead.
And I'm absolutely going to let that go. On any other day, maybe not. Today,
right,
I'm going to let that slide. Okay, I'm sure if you're at home tracking this, you're in tears right now. I'll say this on Lloyd. I'll change the subject.
Oh, good job.
I know he's on the book tour right now, so he's doing a lot of publicity, but it's nice to hear from him. And I hope he stays disengaged with what's happening in financial markets, because that man's experience is immensely valuable.
Especially through the financial crisis. More people are saying we have not had a crisis since the financial crisis that actually was a credit cycle. 2020 doesn't count. The Fed was buying high-yield bonds, remember that, or maybe they just threatened to do so. If you can't have that kind of counter-cyclical response from central banks, what kind of washout does this look like? Increasingly, people are trying to understand that.
That was a classic. It really was. Okay. Energy price shocks fueling stagflation fears. We'll move on. The OECD predicting average G20 inflation will jump to 4% while anticipating lower than expected global growth. The organisation releasing a new outlook this morning, writing persistent disruptions to exports from the Middle East could trigger more extensive repricing in financial markets. The OECD Secretary General Matthias Cormann joins us now for more. Matthias, thanks for making some time for us this morning. Can we just start with how difficult it might have been to put together a forecast in a moment like this? How complex was it for you and the team?
Well, obviously the level of uncertainty is extremely high, and so what we do in these circumstances is use technical assumptions. I mean, the key factor, of course, here, relates to the energy supply and the energy price shock. The technical assumption that we have used as the basis for our projections is, essentially aligned with future markets pricings as they stood on 20 March. Now, the truth is we can't predict how much longer the conflict will last or how much worse it could get. We really don't have much choice but to use a baseline scenario and of course, but we've also included like a worst case scenario in our report today. There clearly is a level of quite a significant level of downside risk to our outlook today.
Matthias, the inflation component of this is the piece that we can focus on now, and then we can turn to growth. There are some people who believe the potential for second order effects is low because the economies aren't as strong as they were, and maybe balance sheets for consumers aren't as well built, resilient right now as they were coming out of the pandemic. Matthias, where do you stand on that? I remember the first time we met, you were part of the Australian government. You know these things well, how to run a treasury. Do these governments have the fiscal space to respond to this energy shock and provide the fiscal support that consumers might be looking for?
Well, debt levels across the world are elevated, and including because of some of the fiscal responses, in the wake of the COVID pandemic, but also, structural pressures on spending around the world. But, in terms of the inflation story now, the story really is, different in different parts of the world. And in terms of the impact of the energy price shock and the flow on that has, some are more directly exposed than others. Here the direct exposure, is probably more into the Asian markets and to the Asia Pacific. In other areas like Europe, for example, the price effect is more indirect. But there is an impact on global prices. When we look at the United States, in the United States, the reason we say what we're saying about inflation is there. We do actually see that the labor market remains relatively tight, and in the context of now this global energy price shock and also the delayed effects still of some of the tariff price effects, and but also the impacts on the labor market of slowing net migration. We do think that there is a combination of factors there that is likely to have a bearing on the inflation outlook in the United States.
Matthias, we've been trying to wrap our heads around the idea that the ECB and the Bank of England are now expected to hike rates several times even potentially this year in response to inflationary pressures, at the same time that you and many others are downgrading their growth prospects. At what point do you see the necessity to hike rates as torpedoing any potential growth going forward, forcing you to lower expectations further on growth?
Well, look, there's obviously now, different, factors impacting the inflation outlook, and that is going to have a bearing on the response of central banks. It is, of course, true. Our current expectation is that the energy price effect will be temporary, and as such, central banks, of course, would be able to take that into account, and there is a softening in labor markets and economic outlook in some economies around the world. But in the end, what we are saying to central banks is that they need to continue to focus, very closely on the data as it evolves, and be very prudent to ensure that inflation expectations are well anchored and that the inflation outlook, is as they would want it to be.
Do you see, Matthias, a real concern about runaway inflation globally? I mean, this ultimately is the real question. Do you think that this shock is similar to what we saw in 2021, 2022, especially because inflation has been above the targets for quite a while?
But I mean, inflation prior to this, latest shock was on a downward path, and we were certainly expecting that in most G20 economies, inflation was going to get back within the central bank target range by the end of this year or sometime next year. But this now clearly is having a material impact. I mean, we are expecting, or we have upgraded our inflation outlook for this year globally by 1.2%, looking across the G20 economies, I should say. Now, it remains to be seen. As we've said at the beginning of this conversation, we don't know what we don't know. I mean, we don't know how much longer this conflict will last. We don't know how much worse it could get. And I mean, there's significant downside risk, but there's also upside risk or upside opportunity. I mean, things could turn out better than what we're fearing.
Matthias, thanks for making time for us this morning. We appreciate it. The OECD Secretary General Matthias Cormann there following their forecast for the year ahead. Difficult to put together a forecast in a moment like this. There is so much doubt, though, around a broader inflation story. No one wants to say the T word because they're scarred by what happened several years back, but I think basically what you're hearing is labour markets aren't as tight as they once were. Household balance sheets aren't as strong as they once were, so consumer price tolerance is lower. And the argument to get second-order effects and an inflation spiral from here, it's a difficult argument to make. That's what I'm hearing from a lot of economists at the moment.
What Wall Street is saying is it's transitory, at least if you look at the trading and if you look at break-even rates. And ultimately, central bankers in the U.S. are following along with that theme, at least if you listen to half of the speech from Fed Chair Jay Powell. We'll hear about from Kevin Warsh. Probably he'll lead into that. Very different tone from the ECB. Whether that's the correct take remains to be seen.
I've just been humbled so many times since the pandemic.
100%.
Things have gone different ways, so I think we have to stay humble once more. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump insisting Iran is negotiating and desperate to make a deal. Iran publicly rejecting Washington's overtures and issuing conditions of its own. Fars News reporting Tehran wants Hormuz transit tolls. Now the latest on the deadly plane crash at New York's LaGuardia Airport. All but 4 of the passengers injured in the collision between an Air Canada plane and a fire truck have been released from the hospital. Roughly 40 people were treated for injuries. And the Postal Service is looking to raise prices to offset rising transport expenses, including the cost of fuel. The USPS will increase prices by 8% on some packages until early next year. If approved, the price hike will take effect in a month. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the programme, pressing for rate cuts.
I think the Fed needs to cut interest rates. Now, we have an energy shock and an inflation shock, so you're a bit more patient around it. There is a premium today, no doubt, for just uncertainty, which is warranted. Then I think you'll get to the other side.
That was Rick Reeder of BlackRock, in Texas, by the way. And I think the further south Rick goes, the more buttons that are undone.
Well, it is hot out there, so, I guess Godspeed.
The former Dallas Fed President Robert Kaplan joins us next to talk about Federal Reserve interest rates, and Bramo very, very interested in safe investing. So we'll talk about that too.
Yeah.
New York City.
All right,
You're watching
really?
Bloomberg TV.
All right.
Equity futures near session lows with negative 0.8% on the S&P 500. Here's a quick look of what prices are doing this morning. On the Nasdaq, we're down by 1%. On the Russell, by 1.3. Off the back of a move in crude, this is what the bond market looks like. Yields pushing higher once again. Twos very close to 4%. 393 up 5 basis points on 10s to 438. More supply yesterday. Week 2-year auction. Week 5-year auction. 7-year supply coming up later this afternoon. Make a note of that one. And setting the tone for absolutely everything worldwide, the price of this right here. Brent and WTI. Brent crude, 107. The president raising the stakes as we get closer and closer to that self-imposed deadline this weekend.
If there is an escalation over the weekend, could you see some sort of sea change when it comes to expectations around oil? They have been somewhat contained because of the expectation that supply can come back online. Should that be removed from the equation with actual oil-producing facilities damaged, that changes things.
Let's talk about rate policy. Under surveillance this morning, pressing for rate cuts.
I think the Fed needs to cut interest rates. Now, we have an energy shock and an inflation shock, so you're a bit more patient around it. Who is affected by these interest rates today? Small businesses, young people, low income are really getting hurt by this interest rate. Maybe you wait a little bit before you drop the rate. There is a premium today, no doubt, for just uncertainty, which is warranted. Then I think you'll get to the other side.
So here's the latest this morning. The former Fed chair candidate Rick Rieder calling for looser monetary policy as market expectations shift from rate relief to potential hikes. Robert Kaplan, the vice chairman of Goldman Sachs and former Dallas Fed president, joins us now for more. Mr. Kaplan, good to see you, sir.
Good to see you.
Thank you for making time for us. What should the Fed do in a moment like this?
For the moment, they should do nothing, which is what they are doing. They should let this situation continue to evolve, keep monitoring it. I think maybe we'll have more clarity in the next 3 or 4 weeks, but we don't have it right now. The markets, the debt, the credit market, the treasury market, the stock market is pricing in that this won't last very long. You start to see today, it's starting to realize maybe it'll last longer, and we don't know. And so I think the Fed is wise to be a risk manager here and not a prognosticator.
You've seen the response from the Fed, the ECB, the Bank of England. Is there a better response right now for you?
Well, so what you saw is the Fed, I thought, appropriately was non-committal and balanced the markets repricing, rate cuts into either no action or even something on the other side, but they've been non-committal. The ECB and the Bank of England are much more sensitive. Europe is much more sensitive to the price of oil and fertilizer and these commodities. And so they're a little quicker to jump. We're a little more insulated in the United States. Even with that, I would have said to the Bank of England and ECB, they would be wise to be more non-committal now too, because there's so much uncertainty. We'll have a better sense in a month, and I would be careful not to overdo it. And I've noticed even they have backed off a little bit from the stridency of their comments. They may turn out to be right, their initial hawkish reaction, but I think it's too soon to jump to that.
Rick Rieder was talking about the potential for rate cuts in part because of the weaker economy heading into this. And a number of investors are pointing to nodes of fragility that are increasingly popping up in markets. How much do you see that being a concern, and that there's perhaps a little too much complacency around the weakening that you could see in the economy going forward?
So let's go 30 days ago, before all this started. Our economic forecast was for actually a strengthening U.S. economy, strengthening global economy. We were 30 days ago calling for 2.5% plus GDP growth. Not a cyclical slowing, but a cyclical strengthening. The weakness in the labor market in that context was more about mismatches. College graduates are struggling to find jobs, and yet there's a historic amount of open jobs that are very attractive. Plumbers, electricians, technicians, people work on assembly lines. And so the war is going to dampen that strengthening. We just don't know how much. But it's clear it's going to mean lower GDP, but stickier prices too. And so, but no, we did not see a cyclical weakening going into this. This may create a cyclical weakening, but it's too soon to say that, in my opinion.
And right now, there still has been a robust capital markets, wide open for a whole host of deals. How long can that last? Should this continue to be roiling even just the front end of Treasury yields?
Yeah, to your point, equity markets are not down very much. Credit spreads are a little wider, but they're hanging in there. Again, because the market is pricing in that there's going to be a resolution, I don't know, in the next X number of weeks, not in many months. And I think the market keeps wrestling with this time frame, and oil markets are wrestling with it. I think for the moment, equity markets and markets generally are resilient. Merger activity is very active. That could change, though, if it's clear that this is going to go on longer. And yeah, we may say in hindsight the markets were underpricing the risks that this would create, but we don't know yet.
Can we stay on client activity? Lisa and I have been talking about this morning, about the Gulf as a source of capital, not just a source of energy. What are your clients doing, and how do you assess the flows coming out of the Gulf?
So the part that's challenging here, the Gulf was not only a source of capital, it was a destination for investment. There was a lot of activity looking at putting capital in the Gulf, development in the Gulf. And yes, they were investing around the world too. Listen, when we look back 6 months from now, depending on how this all gets resolved, that narrative, may resume, may even get stronger, but it depends on how this gets resolved and what the time frame is. But for the moment, we're hearing clients in every industry tell us, I had an order, we were shipping a product to the Gulf, it got canceled. We're struggling with shipping. We're struggling with not just oil, but fertilizer, helium. It's affecting semiconductors. The ripple effects are substantial. So a lot of it will depend on how all this gets resolved and when it gets resolved.
What's the haven asset that you're recommending to clients, or that they're gravitating towards given all of this uncertainty?
So for investing clients, and I'll carve out hedge funds, people who make decisions every day, for big pools of money and individuals, you want to take a long-term horizon. Sometimes the best thing to do, and history has shown the best thing to do in this kind of period, is do nothing. For havens, yeah, you could have more cash. Up until about a month ago, we would have said gold was one option. Obviously, gold has behaved in a way that's been surprising. In years past, we would have said the 10-year Treasury was a haven. It's not acting that way. And so I think our best advice is look over the horizon. Don't have a 3-month horizon. Have a multi-year horizon. Have an asset allocation you can live with. And if you can manage your emotions, try to stick with that and don't overreact to what's going on right now.
Certainly difficult to do that right now. Robert, it's good to see you. I'm still used to calling you President Kaplan. Thanks for being here.
All right.
The former Dallas Fed president, now with Goldman Sachs, on a tricky market for the time being.
Sometimes the best thing to do is to do nothing. I think a lot of people get around that. Again, haven trade, bed, go back to bed.
I'd say stretch out the time horizon, take a vacation, but you can't go to the airport right now.
That's true. Take a local vacation.
No, don't do that either. Up next on the programme, Matt Stuckey of Northwestern Mutual, Stephen Schork of the Schork Group, Ines McPhee of Oxford Economics, and Sarah Malik of Nuveen. The third hour of Bloomberg Surveillance just around the corner.
There's so much noise in the world, it's very difficult to be definitive around this.
I'm worried about what the negative consequences are if this conflict continues to go on.
What equity markets are saying is that this will not metastasize into something which is larger.
We are viewing U.S. equities as a bit of a safe haven in this environment.
The bar for bad news is obviously exceptionally high.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. The price action looks like this. Equities declining across the board on the S&P 500, negative by 0.9%, down 1% on the NASDAQ. Higher crude prices unlocking this in the bond market. Higher bond yields, 2s, 10s, 30s, yields pushing higher. On 2s up by 6 basis points now to 394. On 10s approaching 440 again. With this in the commodity market, Brent and WTI pushing much higher, up by more than 5% on Brent, very close to 108. This statement from the president earlier on this morning, Iran better get serious soon before it's too late, because once that happens, there's no turning back. It won't be pretty.
It's Thursday. We're only a day and a half away from the self-imposed deadline. And if President Trump is putting out statements talking about how Iran better get serious, it doesn't give the markets that much confidence that they're that much closer to some sort of negotiated release or negotiated conclusion. That said, taking a step back, it is such a difficult moment to understand exactly what the threshold is for there to be an exponential jump in expectations for both oil prices as well as the destruction to some of the oil production facilities. And that, I think, is what we seem to be approaching heading into the weekend.
I will say we had a massive turnaround Monday morning, whipsawed by that statement from the president, taking away the near-term escalation risk and opening the door to a diplomatic effort. But if you look at the bond market, pull it up again. 2s and 10s are very close to where they were on Monday morning before that post. That move has persisted even with the administration opening the door to talks with Iran.
I've actually been spending the morning trying to understand this and trying to understand if it's coming from inflation expectations. You're not seeing it in break-even rates, whether it's coming to the volatility in potential inflation expectations, so you need more term premia, or is it a question of just investors pulling back, selling what they can, the same kind of reaction that you're seeing in gold. And you've mentioned Mohammed El-Arian's piece about Gulf investors in particular, also Asian investors. A lot of these nations are having to raise money in order to finance and offset some of the pain that a lot of individuals are feeling. Is that part of what's behind the increase in yields, as so many investors around this table say they're actually seeing opportunities start to unlock itself, at least in the front of the yield curve?
2-year auction soft, 5-year auction weak, 7-year auction later on this afternoon, and 7-year auctions, we've had a history of this over the last few years. We've had some soft, weak 7-year auctions that have come out of almost nowhere. We've kind of set the stage for a week one later, haven't we?
The 7-year tends to be the awkward kid that comes along and never does particularly well, and everyone's just like, ugh, they're just the 7-year. At this time, following the 2-year and the 5-year, given the fact that dealers took down the greatest proportion of both of those debt sales since 2022, if it's messy, do people take a signal of what to expect down the line? And again, I keep going back to why. Is this the fiscal response? Is this inflation expectations? Or is this a structural pulling back of investors around the world?
There has been a lot of disruption, let's put it that way. A lot of disruption through the month so far. 10-year yields this morning up 6 basis points, 439. 2's up by 6 basis points, let's call it 395. Coming up this hour, we'll catch up with Matt Stuckey of Northwestern Mutual with conflicting signals over the war in Iran. Stephen Schork of the Schork Group with oil prices headed for the biggest monthly jump in over 35 years. And Ines McPhee of Oxford Economics breaking down the latest round of jobs data. We begin this hour with stocks edging lower and crude rising. Matt Stuckey of Northwestern Mutual Wealth Management writing oil prices are in the driver's seat for the near term. Breaking this correlation is likely going to require an energy flow solution. Until then, volatility is likely to remain very elevated. Matt joins us now for more. Matt, welcome. What are you advocating for going into a self-imposed deadline this weekend where we're confronting substantial two-way risk? This could break one way or the other aggressively.
Look, I think in moments like this where, the short term is so dictated by one variable, that being oil prices, I think the market's just tempting you and reminding you that you need to have a long-term plan and a asset allocation that incorporates shocks like this into that plan. It doesn't give you much, high level of conviction into what's going to happen this weekend, but it does provide some comfort and some stress testing for resiliency in your portfolio as you look out for a year or 2 years. So, right now the correlation between stock prices and oil futures is around -0.8 or so. That's incredibly high. It just kind of emphasizes how specifically honed in the market is on oil. But if you look longer term, that correlation is much looser. And eventually we do see that starting to descend down to that longer term correlation.
Matt, let's talk about the nature of those shocks, though. There's a history full of demand shocks, but more recently, it's supply shocks that seem to be popping up here, there, and everywhere. How do you build a portfolio for resiliency if you expect the frequency of supply shocks to carry on at this level, looking several years out?
Look, it's a couple of things. There's two main variables that come into portfolio construction that you need to think through. One is kind of what happens when economic growth moves higher or lower, and the other being inflation moving higher or lower. And those supply shocks that you mentioned have been impacting kind of the inflation higher or lower variable. And so in the inflation higher scenario, which we're kind of going through right now, commodities and real assets being a dedicated allocation of portfolio kind of really underscores the reason why it's there in the first place. In today's environment, we haven't seen fixed income really kind of be the ballast in portfolio that we've seen in the past. It's been commodities that have been driving it forward. And so, that is what's working in the near term. But if you look over the intermediate term, if we get past some of the disruption in the Middle East today and look through kind of how things might shake out based on the forward curve, and, maybe that's not where, the best money should be placed over the intermediates, or maybe it should be back into traditional equities and high quality fixed income. But again, in the scenario where inflation is unexpectedly high, real assets are your best friend.
Matt, do we already know enough based on how this conflict has transpired, how the world's physical market has responded, to start shifting allocations more into commodity-exposed sectors?
That's a tough one. I think that's difficult because so much is just dependent on an announcement we might get this weekend, either being more escalation or lower escalation. That tight correlation, I think, is going to be with us until there is that off ramp for flows being restored out of the Middle East. So in terms of kind of what to do here, I think you maintain your portfolio allocations. If that requires some rebalancing, I think you do that. But in terms of just kind of looking for an off ramp in the portfolio to kind of lessen some of the pain, I think that's too short term in nature in terms of overall kind of portfolio hygiene.
When we speak to commodity strategists, they talk about a nonlinearity, that the longer this goes on, the pain doesn't just get a little bit worse, it gets significantly worse all at once. Is there a time frame or is there a sense of when you'll reach a point where you will be more definitive about what a potential outcome could look like and take more definitive action within your portfolios?
That's a really good question. And it kind of underscores kind of, the risk that if this stays in place, this disruption in the Middle East, what does that mean for global commodity markets? In reality right now, we've kind of ripped a 10, 11 million barrel per day kind of hole in supply to the global crude market. Right now just through shut-ins, and there's the risk that this gets worse if there isn't flows restored coming out of the Middle East. And so you run the math on that in terms of that disruption against kind of global storage levels, and that buys you about 4 or 5 weeks worth of cushion, if you want to call it that. Beyond that, the physical market's likely to tighten significantly further, to your point about nonlinearity. I think if you get to that point, some additional hedging might make some sense, but we're just not there yet. And to have conviction on what's going to happen 3 or 4 weeks from now is really, really tough in this environment.
Matt, you have got a trade on, though, that I think is interesting, and it's in the equity market, and it's small caps. Small caps so far this month have declined somewhat off the back of what's happening here, obviously. Energy's pushing rates higher, it's pushing out rate cuts. Why the overweight on small caps right now?
Jonathan, I think that really kind of ties back to our earlier conversation about the intermediate term, and just kind of rewind the clock back to, not the start of March, but the start of January and February. What we were seeing was a sustained rotation into that area. I think continued overweight to small cap is a view that the volatility that we're seeing in the commodities markets and because of the disruption and flows from the Middle East has an end date to it. It's hard to have a conviction about what specifically that end date is, but if we have an intermediate time horizon, that helps with that view. And what we were seeing heading into this was rising earnings expectations combined with attractive relative valuations. And to us, I think that is likely what we are going to continue to lean on to support our overweight view.
Matt, looking at your overweight in equity, so small versus large, underweight large cap, and then comparing it to your overweight in IG credit and underweight in high yield. Usually if someone said to me they were overweight small caps in the equity market, guess where we are in credit? I'd say you're probably like high yield. Why the difference there, that slight nuance?
I think when we started this year, the nuance was reflected of pricing. So if we started, 2026 at near 20-some-year tights in credit spreads, the pricing there just wasn't really necessarily commensurate with the risk profile of high yield. And now I understand that there are tight correlations between credit spreads and the performance of cyclical parts of the equity market, like small cap specifically. But against a kind of more compressed earnings profile in the small cap space and a price point that was in the mid-teens, we just thought it was better to put the incremental dollar in the small cap space versus the high yield. Now, certainly we don't necessarily expect small cap performance to perform up to our level of expectations if we see spreads continue to widen out. But in terms of the incremental dollar, we thought it was better served in the small cap space.
Interesting. Matt, thank you, sir. Matt Stuckey there of Northwestern Mutual Wealth Management. Always looking through people's positions and looking for these pockets of tension, and that's a pocket of tension that jumped out to me.
Yeah, and it goes to a point that Howard Marks was making, not necessarily about small caps in any way, shape, or form, but in certain sectors, maybe equity risk is better than credit risk because you're not getting compensated sufficiently for the credit spread. And that ultimately is something that an increasing number of investors are looking at, particularly tied to AI, given the potential spread of outcomes in that sector.
That's well framed. Russell futures right now down by about 1% on the S&P, attempting to recover, just bouncing off session low, still negative by 0.75%. With an update on stories elsewhere this morning, with your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump posting on Truth Social that Iranian negotiators are, quote, begging to make a deal. The president urging Iran to get serious before it's too late, writing, once that happens, there is no turning back and it won't be pretty. Axios reporting this morning that the Pentagon is gearing up for a massive final blow of the war. Ex-Goldman CEO Blankfein is warning of a fire risk in private markets. Blankfein telling Bloomberg the accumulation of unsold private assets on investors' balance sheets is a warning that some may be overvalued and a spark could trigger a widespread markdown. And the average Wall Street bonus jumping to a record last year, rising 6% to $246,900, according to estimates from the New York State's controller, with the total payout pool rising to over $49 billion as profits and revenues soared for the banking sector. That's your Bloomberg Brief, John.
Yahira, thank you. Thank you very much. More from Yahira later this hour. Up next on the program, the Morning Calls Plus, Stephen Short of the Short Group as crude prices continue climbing. Live from New York City this morning, good morning.
The risk feels a bit asymmetric at this moment. So if we have a peace deal, then we could have a relief rally in markets. On the other hand, if we don't have tangible evidence of actions that could shorten the duration of the disruption, then current risk pricing is not consistent with the doable disruption that energy markets are pricing right now.
Copy and paste, cut it, repeat it. We've heard that so many times since this war started. Wei Li there of BlackRock on the disconnect between energy and what's happening in risk assets. Risk looks like this morning. We're negative by 0.75% on the S&P, down by 0.9 on the Nasdaq, down by more than 1% on the Russell, unlocking higher yields in the bond market, 2s, 10s and 30s. 2s really close to 4% again, up 4 basis points on the day to 392, up 4 on 10s to 438. More supply later. We've talked a lot about that 7-year auction, so look out for that later this afternoon. In the commodity market, crude, Brent and WTI higher by some 4%. 107 on Brent, WTI at 94. A couple of headlines worth going over. Done it a few times already this morning. This came from the president directly. They better get serious, Iran. Better get serious soon before it's too late, because once that happens, there's no turning back. It won't be pretty. This is the final 2 days of negotiations against the self-imposed deadline for them that the president set earlier on this week. This came from Axios. This was quite instructive. A few hours ago, the Pentagon delivering military options for a final blow in Iran that could include the use of ground forces in a massive bombing campaign, that according to 2 U.S. officials and 2 others with knowledge of the matter.
And different military strategists have talked about how the hope is to escalate, to de-escalate, to bring in troops into the region and some significant threats in order to reach some sort of resolution. That is the double-sided issue that we're facing for a weekend, which could end up with either a real upside or a real downside.
It makes it difficult to put on risk over the next few days, that's for sure. Let's get you some morning calls. First up, UBS upgrading new call to buy, calling it, quote, largely insulated from the war with Iran. That stock is up by 1%. Your second call from Bernstein, downgrading Qualcomm to market perform, believing memory issues will worsen. That name is down by close to 2%. And finally, D.A. Davison raising its price target on Clear, highlighting opportunity from the partial government shutdown. That stock is just about unchanged. We've got someone around the table with some experience of that.
Okay, I always thought it was a scam, a pay to play. You know, if you've got money to pay, you can skip the line, and it felt just really unfair to me. But sure enough,
sure felt good this week, didn't it?
I went ahead, never felt so happy about spending that money, and I totally sold out. So I understand the upgrade.
I can't wait to see the chart, just how many other people have
100%
have done the same thing. Let's send back to our top story. Oil prices whipsawing as the US and Iran offer conflicting comments on ceasefire discussions. Stephen Short of the Short Group writing the following: the gap between market optimism and ground truth is dangerous. The market is pricing a panic, not a new normal. Stephen joins us now for more. Stephen, welcome back. I've heard this a lot. We've all heard this a lot. the disconnect between the physical market and the paper market. What explains it, one? And two, how do you think it's going to resolve?
Absolutely. So the physical market that's being most affected by the conflict, of course, is in the Asian markets. So that's where we're seeing the disconnect. We're seeing, well, you'll see analysts will talk about predictions, pie in the sky, $130, $140, $150 oil. Potentially, that's where we could go. You know what? We're already there in the Asian markets. So there's the disconnect. The money that's being traded, the quotes that we see here on Bloomberg are for NYMEX WTI for ICE Brent crude oil. These are markets that are based in the Atlantic Basin. And as we just saw yesterday with the EIA weekly update on petroleum, the Atlantic Basin is well supplied with oil. So the contracts we are looking at are depressed because they're in a market area that is secondary to where the real action is. So it's that massive disconnect on the physical side. Interestingly enough, when we look at the CFTC data, the commitment of traders, we're seeing a tremendous amount of selling by producers. And Jonathan, there is the disconnect. Because when you look at speculators, hedge funds, they own 11 Brent crude oil contracts for every one contract they are short. They are massively long. On the other side, the physical guys, the producers, are selling into this rally. So therein is the catalyst for that disconnect.
Stephen, just explain that for people who don't follow your world. Why would they be selling into this rally?
Absolutely. You're a producer. So ideally, you're selling into it because you are taking advantage of these prices. So now we're looking at Brent crude oil in the 105, 106, up to $110 range. WTI in the mid $90. Yeah, got it right up there on the screen there. Thank you. And so what that's telling us is the physical guys are taking advantage of this. Could the prices go higher? Absolutely. But the guys that know the best, selling physical cargoes, they're more than happy to lock in their production at this point. And therein lies a problem and a potential trap if we do get a resolution sooner rather than later. With the funds being long 11 to 1, there are no longer any natural buyers left in this market. So if there is a panic to liquidate your positions, it's going to be a mass run to the exits, and you'll see a significant downdraft on a massive squeeze. Yet to be seen, because I do think militarily it gets worse before it gets better. But therein is our game plan right here. We have funds, Wall Street, we'll just say, massively long oil. Producers, the guys that actually touch oil, are selling into this rally. And we have a bifurcated global market where the real shortage is in the Asian basin, whereas we are focused on prices that are priced off of the Atlantic basin.
Stephen, this is fascinating, and it explains why the price of physical oil in Dubai actually fell significantly over the past couple of trading sessions. And it goes against what a lot of commodity strategists have been saying, which is that this huge gap between the physical and the paper market would close to the upside for the paper market. Do you think it is too early to say that that is going to be the path of travel, that frankly some of the more dramatic statements coming out of commodity strategists is overplaying how much upside is left?
Absolutely. And let's keep in mind, and I've said it before on the show, that can we go higher? Can WTI Brent go up to that $150 range? Absolutely. Can it stay there? Skeptical, because what, of course, that means for economic degradation. But to your point with the physical market in Asia coming off, it's coming off because access to that physical oil is really difficult. So if you don't have the product, you really can't charge a premium. What we are seeing now is a shift to the Gulf Coast. We're seeing what it takes, the premiums of bringing West Texas oil down to Houston to get to the Gulf Coast. Tremendous amount of, from sources, tremendous amount of Asian buying going on in the Gulf Coast at this point. So there is that real demand shift. Now we're shifting away from Asia, or where the oil is, because we're running out of it for all intents and purposes, and where we have plenty of it in the Atlantic Basin. This is where the buyers are going. So that physical demand is migrating now from the Asian markets into the Gulf Coast markets, the Atlantic Basin markets, ideally to bring that oil, U.S. oil, North Sea oil, back into where the demand is needed, to the refineries in South Korea, Japan, so forth.
There's a question about non-linearities right now, and I've seen a lot of investment firms talking about this, that if you start to get destruction of oil production facilities, that changes the game, and you could start seeing the more significant numbers of 200 and beyond. How closely are you watching that, especially as we head into this weekend?
Absolutely. It's a concern, and what we're seeing, not just on the oil side, but look what's happened in Qatar, where 17% of their natural gas or LNG production has been shuttered and could be offline for the next 3 to 5 years. So we are going into an area of really uncharted waters at this point. I'm reticent to call $200 oil mathematically from a quantitative probabilistic modeling. I've mapped it out. Yes, theoretically, we could get up to $238 oil by the end of this year. But I really think that argument is moot. And I'll go back to history, because back in 2008, when oil was at 140, 145, nearly $150 a barrel, all the smart people on Wall Street were mapping out $200. Absolutely, we're going there. Well, you know what happened before we got there? We hit the Great Recession. So at this point, can we get there? Yes, potentially, but there is really no staying power, because the demand destruction will be so significant that we'll see a worldwide contraction in economic growth. And as the saying goes, high prices are the cure for high prices. You make those prices high enough, you'll either get the supply to meet that, or you'll get the demand destruction to pull those prices lower.
Stephen, it's good to see you. Thanks for breaking it down. Stephen Schork there of the Schork Group, heading into a weekend with substantial two-way risk, and just some illumination there about the air pocket we could hit to the downside if we get a resolution to this war.
It was refreshing to hear that. I was surprised by the fact that physical oil prices out of Dubai actually have contracted over the past couple of days. It's not clear exactly how this is going to break, which continues to add to the uncertainty heading into the weekend.
Not clear who's getting through the strait and who isn't at the moment.
That's true also, and what supplies look like.
Equity futures right now on the S&P 500. Near session lows. Up next, we'll get you some data. Jobless claims in America set to cross. Innes McPhee of Oxford Economics will be with us around the table to break it down. This is how we're set up 60 minutes out from the open and bout. The cash open just around the corner. Futures pulling back on the S&P 500. We're negative by 0.8. On the Nasdaq, down by 1%. In the bond market, yields pushing higher throughout much of this morning. 2s, 10s, 30s up by, let's call it 2 to 3 basis points right now. 2s at 392. Heading into the data just seconds away. Crude setting the tone for everything. WTI and Brent. Brent crude 107 and higher by close to 5%. With some jobless claims data, let's get to Mike McKee for more. Morning, Mike.
Good morning, John. A bit of a rise in jobless claims to exactly what was predicted, 210,000 for the week ending last week on March 21st. However, that's still a very low number, so it doesn't really suggest any kind of change, just a little bit of volatility. The continuing claims number, 1,819,000, is down from 1,851,000 2 weeks ago. So not much change on the labor side of the Fed's mandate, and it doesn't appear that companies are reacting yet to anything that's happening over in the Middle East. However, we are seeing, and I wanted to bring this back up, I know you talked to the Secretary General a little while ago of the OECD. The inflation side of the Fed's mandate is starting to show cracks. The OECD predicting 4.2% inflation for the U.S. this year. That may not be completely accurate, since we don't know how long this is all going to go on, but it's something that people should be considering when they're filtering through what the Fed is going to be saying over the next couple of days. And the rest of those countries, here's a point that people are starting to make in the economic circles. The rest of those countries could be in trouble, because not only are oil prices going up, but the dollar's going up. And as the dollar goes up, their currencies buy less, and oil's priced in dollars. So it's a double squeeze for the rest of the world, and that could lead to demand destruction that leads to lower growth here.
That's the 1-2 punch. Stateside, Mike, this is what I hear a lot. Let's work through it together. Inflation, ultimately, by the time we get to the end of the year, will be closer to 3 than 2. That will constrain the Fed. But the Fed doesn't have to worry about an inflationary spiral and so-called second-order effects, because we're told, Mike, that this labour market is not as tight as it once was. Then I look at claims at 210 and a 4-week moving average of around the same number. Mike, and I wonder just how tight this labour market is. How tight is it?
We don't think it's all that tight, but the biggest issue is that we have lost a lot of population because of the crackdown on immigration, and that seems to be leading to a situation where employers need fewer workers because the economy is not putting the pressure on them at this point. And so we don't see the unemployment rate rising as you would think it might in this kind of situation. But nobody knows for sure. This is one of those things we'll be looking back on 5 years from now and have a better handle on exactly what's going on. But as I think Jay Powell said in his news conference the other day, economy's still performing relatively well. There are all these clouds on the horizon, though. That's the big question is, does the OECD's forecast come true? And do we see the rest of the world slow down and the U.S. economy slow down? No sign yet, really.
Mike McKee, thank you, sir. It's one of the biggest differences between now and, say, 2022. Back in 22, unemployment was around, what, 3.5%? Now it's closer to 4.5 than it is to 3.5.
And the fiscal impulse was different then, too, with money printing in a much more significant way. That said, this explains why it's so confusing, this moment. Because on one hand, you could say, well, inflation is picking up. And even before the potential oil price shock, you saw that yesterday. Mike was talking about import prices and how much they increased versus expectations. On the other hand, things are still good and actually might have even been improving during the remainder of this year had it not been for what we're seeing in oil.
Claims at 210 is good news. That's good news for this labour market. No other way of talking about it. So that's the labour market. That's how the stage is set. This is how the stage is set for diplomacy right now. The president, heading into the weekend, a self-imposed deadline for talks between the US and Iran. And this line from him this morning: they better get serious soon before it's too late, because once that happens, there is no turning back. And it won't be pretty. Anne-Marie's been tracking the story down in D.C. Anne-Marie, how is the stage set going into this one? That self-imposed deadline, only 2 days away.
That self-imposed deadline is just days away, Jonathan, and the president is out with another warning to the Iranian regime, another threat that you better get serious when it comes to diplomacy, or it's not going to be pretty for you. At the same time, there's also reporting this morning from Axios that's talking about the Pentagon is preparing these potential options for a, quote, final blow. And the details, if you look at in that story, really go towards the heart of what the United States wants, would be opening up the Strait of Hormuz, potentially getting some assets on the ground in some of these key islands that are in the strait that the Iranians need to control the strait. Also interesting, in the last hour, we heard from Pakistan's foreign minister, and he said that there's unnecessary speculation in the media regarding these talks, and he pretty much crystallized what is happening in terms of the back channel. He said individuals like Pakistan, as well as Egypt and Turkey, are the ones that are acting as intermediaries, and it is through Islamabad that the United States shared that 15 points. So they are acting as this intermediary, but he didn't go on to say anything of the likes that there would actually be talks in person. So really where we are at this moment is a fork in the road. The president needs to decide, does he continue diplomacy after Friday, or potentially could we see another escalation on the ground?
Anne-Marie, Lisa and I have been talking about this all morning. It's not just about the US and Iran. One of the conditions in a report that came out yesterday that Iran is demanding is the sovereign right to exercise authority over the Strait of Hormuz. What are the nations across the Gulf saying about what Iran is demanding?
Yeah, that's absolutely dead on arrival for nations across the Gulf, as well as allies in Europe, as well as the Asia Pacific. We have seen Iran already do this. Remember, the strait is open to, as John Lieber said it earlier, family and friends. It's not open to everyone else, which is why you are seeing some vessels go through, but obviously not the normal flow. And what Iran's parliament right now is drafting is basically a new toll. If you want to come through the Strait of Hormuz, which is an international body of water that we have been using for years, companies have been using and countries have been using for years, they're now saying you have to charge a fee. And we have seen some tankers pay this fee, one reportedly $2 million. So that is what Iran is doing. And when they talk about one of these demands, and their 5 points, according to Iranian press TV, was this demand, that is not going to work with this administration or other allies around the world.
Anne-Marie, appreciate the update. I know you've got to run. Anne-Marie down in Washington, D.C., cabinet meeting coming up for the president later on this morning. Let's talk to Innes McPhee of Oxford Economics. He joins us now. Innes, welcome to the programme. Labour market data's OK. The threat of escalation still very much on the horizon. Walk us through how you're tracking the damage, how this is turning up in the data that we've seen so far.
Thanks, John. Well, I think, the first thing to say is that we're going to see this really have an impact on inflation, first of all, flow through to real incomes. On the positive side, we're obviously going to see more output from the oil sector in the US. But really, we're going to start to see that impact on the economy, or that impact on consumer demand, start to bleed through, I would say, really in the second half of the year. Now, elsewhere, outside of the US, in Europe, for example, the impact is going to take a little longer because, of course, gas prices are much more impactful there. That's much more the driving force of the economic impact. And that won't really start to have a big impact on energy prices that firms and households pay until around the winter. So much more of a sort of Q4, Q1 impact for the European economies.
How fragmented is the global economy right now when it comes to growth outlooks in response to this oil price shock? There's a feeling on Wall Street that the United States market is pretty insulated based on its own oil production and its self-sufficiency versus, say, Asian economies in Europe that are much more exposed and have greater downside risk to growth. Do you agree with that? Do you see that kind of shaking out in a significant way?
Absolutely. Just from a high-level perspective, what we're really seeing is a lot of the cracks starting to develop in the global economy. A lot of the typical sort of vulnerabilities that you might expect to be corrected through a recession or some sort of economic downturn. So we look around the global economy. Obviously, you've got the US, which at a household level is very divided in terms of economic prospects. This shock will only serve to reinforce that. We all know that around 4% of the bottom half of consumers in the US have 4% of their disposable income is spent on gasoline prices. That's offset to some extent for the US by being a net energy exporter. For Europe, it's much more of a gas story, and some of that liquefied natural gas and that being a large input in terms of the energy mix there and what firms pay in terms of energy costs and their structural competitiveness versus the US and others. Even for Asia, this is going to be a significant shock, I think, as well. Just remember that, Qatar and the region is a major producer of helium and other gases that are quite critical in the production of semiconductors. And so you're looking at supply chain issues all around the world that are going to have differential impacts. And this is going to be quite a nuanced shock that's going to play out over the following quarters.
Ines, how much conviction do you have around any kind of forward-looking projection right now? We're talking about, we have no idea how long this goes on, but an increasing number of people say once you've reached a certain point, the risks become significantly greater. It is nonlinear. What is that point for you as you look out and assess the landscape?
Yeah, I think it's a great question. Look, there's a huge amount of uncertainty. It ultimately comes down to the duration of the shock, how long we see supply down from the Strait of Hormuz. That will determine the energy price shock and therefore the hit to real incomes and the impact on businesses. In terms of the non-linearity, I tend to think about it and putting the question in a slightly easier way in terms of what's the oil price that really starts to have a major impact on the economy, and what's that point at which you start to get those non-linearities. We think that's around $150 a barrel. If you see that sustained for some period of time, that's when you start to see a really significant hit on the global economy. And then potentially a lot of the second round impacts through wealth effects, through asset prices and so on, that might well then mean that you're moving towards more of a recessionary scenario than simply a significant hit to growth.
Ines, we're often in different financial capitals. Can you draw on your experience in conversations with clients over the past few days? Is there a difference between how they're approaching this in, say, New York and what they're telling you over in London?
Yeah, it's funny you say that. I was in New York a couple of weeks ago, and I think really the focus there was actually on AI, believe it or not, and really the longer term structural impacts that might have on business models. Whereas in London, over the past week, clients have really been focused on Iran, the impacts of energy, the impacts that would have on demand, on firms' hiring practices, and on the labour market. So I think, over the last couple of weeks, anyway, in my small sample, there's actually been quite a different focus either sides of the Atlantic.
Ines, it's good to see you. Thanks for making time for us. Ines McPhee there of Oxford Economics. We've experienced a similar thing.
Yeah, look for the edge you've got, right? I mean, essentially people in New York are saying, we have no way of analyzing this, and typically you buy the dip, so just ignore it for now and focus on what you can, which is AI and private credit, and that's what we're going to focus on. And frankly, it has been completely not on the agenda to talk about the war. Is it complacency, or are they right? We shall see.
The longest first quarter ever continues. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Recapping that data we just received, jobless claims coming in exactly in line with estimates at 210,000 for last week. The 4-week moving average now sitting at 210,500. Continuing claims ticking down by 8,000, coming in at 1.82 million. A private credit fund managed by Ares saw its steepest monthly loss on record in February. It's the latest domino to fall in a broader sell-off across public debt markets, which Ares uses to assign prices to its assets. The firm recently capping withdrawals at 5% of the fund's net assets. And in sports, the New York Yankees defeating the San Francisco Giants 7-0 last night to kick off the 2026 MLB season. The rest of the majors will open today with the Mets hosting reigning National League Cy Young winner Paul Skeens and the Pittsburgh Pirates. That's your Bloomberg Brief, John.
We've had a Greenland crisis, Yahara, thank you. We've had a Venezuela crisis, had a private credit crisis, had an AI disruption crisis, had a crisis in the Middle East, all in the first quarter of the year.
I'm having a crisis. That's how I feel about this, and I think everyone does. It feels like people are becoming benumbed a little bit in New York. It's just enough crises already.
Right? It continues. Up next on the program, Sarah Malik of Nuveen, still expecting 1 to 2 rate cuts this year, plus Danny drops by. She's got some morning movers for you. Energy stocks up on the president's latest warning to Iran.
Markets, the debt, the credit market, the treasury market, the stock market is pricing in that this won't last very long. You start to see today, it's starting to realize maybe it'll last longer, and we don't know. And so I think the Fed is wise to be a risk manager here and not a prognosticator.
If in doubt, do nothing. That's the message coming from the Fed right now and from the Dallas Fed president, the former one, Robert Kaplan, now with Goldman Sachs, joining us a little bit earlier on the program. Equity futures right now in the S&P very close to session lows going into the cash open. We're down by, let's call it 0.9%, down 1% on the Nasdaq 100 with some single names and morning movers. Danny has more. Hey, Danny.
Hey, John. With the price of oil nearly up 5% this morning, worth checking on the oil majors that are doing better, but not huge gains. They have been gaining for most weeks since the war broke out. We're around 1% higher for the oil majors, Exxon, Chevron, ConocoPhillips. That one's doing the best, above 1%. Elsewhere, it's also the memory chip stocks that have been under pressure both yesterday and today. Google comes out with a new compressor that they say reduces the need for memory, but a lot of the analysts point out that this really isn't that big of a difference. Lynx equity analysts saying, whatever. It's only going to make a tiny difference for need for memory, but these stocks have had a huge run up, so not surprising to see some of the air come out. SanDisk down 3.6%, Micron down nearly 3%. Finally, some earnings from Miller Knoll. They make high-end office furniture. This one was really telling of the time. So they miss estimates. Essentially, they say, look, we're dealing with higher tariff costs, but that's fine. We've already taken measures to mitigate that. That we can deal with. The issue is the war in the Middle East. They're taking an $8 to $9 million charge because they're getting less shipments and logistic costs are now higher for them. So those shares off 20.5% in the pre-market, John.
Danny, thank you. Looking forward to the show alongside Matt Miller going into the opening bound. That kicks off in about 10 minutes' time. Let's talk about the Federal Reserve. BlackRock's Rick Reeder doubling down on his view the Fed should start cutting rates once again.
I think the Fed needs to cut interest rates. Now, we have an energy shock and an inflation shock, so you're a bit more patient around it. I think you need to get there because I think
rate cuts in late 26 with the risk of a delay into 2027. Sarah joins us now for more. Sarah, welcome to the program. You call this a shock, not a structural inflation cycle. What's the difference between the two?
Well, we're definitely in a period of uncertainty here. So the difference between a shock and structural inflation is going to have to do with the length of this war. Typically, about 3 weeks past the beginning of a war is where you get to peak uncertainty and the market bottoms. We are about there now, but if this war continues to ramp up, that's where the risk will increase from shock to structural inflation. If you look at oil prices, if they increase by $10, that's about a 10 basis point drag to US GDP and a 40 basis point increase to inflation. So that what we don't want to see is oil prices get to about $125 and stay there for an extended period of time, because that's going to bring back and increase the risk of stagflation, which will be a period of higher inflation and, of course, lower employment. And we saw that with last month's payrolls, which came in at minus 92,000. So that's the risk going forward. I don't think we're there yet. I think rate cuts can be still on the table for later this year.
Well, let's attack the stagflation. This is important. We live in a nominal world. If inflation rises and nominal growth is good, earnings should be okay. Sarah, what's the outlook for earnings and how insulated is that revenue stream for some of these big companies in America?
Second quarter earnings outlook, which will start in a few weeks, those earnings still look strong, up low teens year over year. I think we can get to that level. There's going to be a lot of uncertainty around that. Remember, those earnings are going to be, partially before the war started. So that's going to be a bit backward looking. What we're going to be focusing on is what are companies saying about whether they'll pull back because of the risks of higher inflation and uncertainty around the war. The good news for the U.S. markets was that we came into the markets with strong earnings growth and a fairly strong growing economy. But the bad news is that we also came into this year with markets at a premium after multiple years of a positive run. What we have seen, though, is the market has been volatile during this period, but not a tremendous amount of downside yet because of this war, as a lot of buyers have been stepping in. We've seen that from retail buyers, foreign buyers, and target date strategies. So we're in a buy the dip environment in the U.S. The question is, though, if this war continues to ramp up week after week, I think eventually we're going to see some form of capitulation for the markets.
Sarah, do you think that there is complacency right now when you talk about the risk markets that have been well bid and people have been buying in? Or do you have more comfort right now in the bond space where people seem a lot more concerned?
I think the bond market is telling us more of a signal than the equity markets. We've dealt with a lot of uncertainty year to date. You all were just talking about it between this war, Venezuela, what's going with AI, what's going on with private credit. There's a lot to be concerned about. I am a little surprised that equities are sort of just, walking right by it. People are still coming in to buy. That's a sign of a lot of cash on the sidelines that wants to get into these markets and rely on that earnings growth. I don't think today is the day where I'd be stepping in to buy equities. I would wait to see, are we going to get more clarity around a ceasefire for this war? Because markets day to day are going to trade on whether we think we're getting a ceasefire in the near term or we're not. Today, of course, we do not see a ceasefire coming anytime soon.
Sarah, what is the signal right now from bond markets? Is it worries about an inflationary spiral? Is it worries about some sort of fiscal impulse needed to respond to some sort of cost of living crisis? Or is this just buyers stepping back from around the world as they look to pad their own consumers' balance sheets?
Well, bond markets are worried about are two things. One is that inflation is going to spike and it's going to be more structural. And secondarily, that'll lead to the Fed having an inability to cut rates, and because we'll end up in the stagflationary environment where the Fed's hands are tied. But that is not my base case scenario. I do think that we will get to a period where this war either causes the economy to slow enough where the Fed needs to cut rates to support the economy and consumers, or they look, and even if we have an extended bump to inflation, we realize it was oil price driven. Once we're past this war, oil should settle back into the $70 to $80 range. The Fed can look at that and say, okay, we'll get past this period of inflation like we did during the COVID pandemic. We can put a rate cut in near the end of this year, another one in early 2027, and go from there.
Sarah, it's good to see you. It's always great to touch base. Sarah Malik there of Nuveen, breaking down this market. This is how the stage is set heading into the weekend of this self-imposed deadline. We're in the talks phase. It's always a tricky moment. You've got both sides trying to anchor to the extreme and build leverage as we go on. And this can break either way. And that's what's difficult for financial market participants, just knowing that you're facing substantial two-way risk, something we keep talking about as we inch closer and closer to that deadline.
Yeah, and all sides are trying to use the market to get more leverage. I mean, that's the other aspect of this that also is giving people some agita. This idea that not only do oil prices move in response to an actual escalation, but Iran wants oil prices to go higher, and the rest of the world is looking for lower energy prices to stave off an economic crisis. Who's going to win? It is a very uncomfortable position.
It's going to be quite a morning tomorrow morning as we count you down, literally counting down the hours to the end of that deadline. The president, of course, with great discretion to push it back even further and say the talks are continuing. We'll keep monitoring the latest headlines for you. Tomorrow we'll catch up with Russ Kostrick of BlackRock, Joe Davis of Vanguard, Michael Gapin of Morgan Stanley, Mona Mahajan of Edward Jones, as we count you down to a pretty big weekend potentially for the war between Iran and the United States. Your equity market near session lows. We're down about 1% on the S&P 500. Bond yields are higher and crude keeps on gaining, up by around 5%. WTI, $94. Brent crude, $107. From New York City this morning, good morning. This was Bloomberg Surveillance.
It's going to be a lot of stress on the market.
Investors always hit the sidelines when you have uncertainty.
It's risky not to take risks.
The market is being very calm about this whole situation.
There's a lot of other themes that people are going to have to sort of roll their sleeves up on again.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, in the green for the year, the S&P 500 wiping out losses since the start of the war as the White House is playing up the prospect of further peace talks, and crude is coming off its fourth straight day, closing below triple digits. WTI trending close to 96 this morning.
This is a FOMO market right now. Everyone doesn't want to miss out on potential gains, as Bank of America strategists put it this morning. Strong rallies suggest that the upside remains the greater concern. This is in stocks. The downside is in oil prices. As you see right now, polymarket odds of the conflict ending this month are 75%. That is the highest level going back since the start of this conflict. People are ready to just move on.
The White House playing up talks about talks. Let's get to the latest reporting from Bloomberg. The US and Iran in discussions about holding another round of face-to-face negotiations for a longer-term ceasefire.
And it could be as soon as this weekend, according to Reuters. And one individual speaking to Reuters said no firm date has been set, with the delegations keeping Friday through Sunday open. So another weekend where everyone will be working. But to Lisa's point, it's not just FOMO. The market is really starting to price in either there's going to be an off-ramp of peace and a cessation of hostilities for good, or the United States is winning right now. That is how the market is looking at this conflict.
I don't think the market's looking at anything. This market's moved on. Based on the price action of the past few weeks, this market has moved on. Bank earnings later on this morning will move on. JP Morgan later this hour, later this morning, Wells Fargo and Citigroup.
And it's fascinating because yesterday Goldman Sachs disappointed with one aspect of their earnings, the fixed income currencies commodities trading. And that sent the shares lower by almost 4%. That said, all the other financials were actually up on the day and the best performing of the day. So people looked at this and they said, this is a Goldman Sachs issue. This is an expectations issue. This is not a banking issue. And it's really something where the bar is still very high for the other players.
Company story of the morning is not in the financials. Let's talk about the airlines. Check it out. American Airlines and United. Scott Kirby of United, according to our sources here at Bloomberg, approaching American about a tie-up. Just think about that. Sprint and JetBlue couldn't get it done. And we're talking about American and United?
Well, so antitrust regulators might be more amenable to tie-ups, but probably not this one. That said, this is fascinating on a number of levels. First of all, Scott Kirby, the CEO of United, used to be the president of American Airlines. He knows this airline pretty well. Number two, there is going to be a period of distress. This is what a lot of different airline executives have talked about. If oil prices remain high, who are the winners going to be, and how much can you ultimately see some tie-ups get explored in this market?
Obviously, the regulatory environment is more amenable during the Trump administration, but this kind of tie-up is just potentially too big, especially with this administration ahead of the midterm elections is trying to talk about affordability. Not only are they thinking about this, Reuters said Scott Kirby approached President Trump directly at the end of February when he was there for a meeting to talk about Dulles Airport. He said, you know, I might make a play for American. I'm sure he pitched it in a way that Trump said, I love a big deal. Maybe this can happen. But I'm not sure if the DOJ or the Department of Transportation is going to greenlight this.
We'll have more on this story later this hour. American in the pre-market higher by some 5%. Coming up this hour, we'll catch up with Brian Levitt of Invesco, with stocks are raising the year's losses. We'll speak to the French Minister for the Economy and Finance, Roland Lescure, as Europe faces an energy shock. And Gerard Cassidy of RBC reacting to the latest big bank earnings. JP Morgan later this hour. We begin this hour with our top story. The US and Iran weighing another round of peace talks as the Strait of Hormuz blockade enters day two. Bloomberg's Jumana Basechi joins us now from Dubai. Jumana, welcome back to the program. Just how is that blockade holding up so far this morning?
Yeah, well, I will say, John, actually, it's become a bit of a side story this morning insofar as the evening was rather uneventful. So the blockade went into effect at around 6 p.m. regional time, around 5 p.m. in Iran. And what we saw overnight was an attempt from several ships to get through the straits. And there's one that we've been monitoring throughout the course of the morning. This is a U.S. sanctioned vessel that has links to China that has been making its way through the Strait of Hormuz. We understand now that it has passed through the strait and is on its way to the Gulf of Oman without any incidents. So, you know, this is perhaps the first example of a vessel or ship that's trying to make it through the straits under this new naval blockade introduced by the U.S. But I should say it's unclear whether it stopped at any Iranian ports, so not a real test per se. But I think the real story this morning is that there have been numerous reports overnight suggesting that we may be in for another round of discussions. And these are mediated discussions, of course, between U.S. and Iran. Reuters reporting that it could happen in Islamabad towards the end of this week. Remember, you have to go back to what President Trump said over the weekend. He did actually describe the talks as having gone well. There are a few outstanding points. He says the nuclear file is still going to be a focus. And again, other outlets reporting overnight, New York Times suggesting that there's still ongoing disagreement on the extent of enrichment that the U.S. are willing to allow, whether it's low enrichment or no enrichment. The Iranians are saying that they want to push for a 5-year timeline on the suspension. The U.S. want to see a further timeline of 20 years. Whether the two can actually bridge the gap between them, is a big question before we go into this next round of potential discussions, yet to be confirmed by both sides. But I will say that as far as the ceasefire is concerned, it is still holding up. And there have been multiple diplomatic channels being worked over the last 24 hours. The Iranian foreign minister had a call with the Qatari PM. He also had a call with the Saudi foreign minister as well, clearly moving in the right direction from the Iran Gulf perspective. And then let's not forget that the ceasefire in theory ends in a week's time. So if they want to get something done, then it would probably have to happen in the next couple of days, yet to be confirmed, though, by both sides.
Jumana, good to see you. Good to catch up, as always. Bloomberg's Jumana Basechi leading our coverage out of the region this morning. Brent at 98, WTI at 96. To Jumana's point, the talks are ongoing. And so long as the talks are ongoing and the back end of the futures curve is behaving, this market seems to be comfortable with deploying just a little bit more capital and adding to the rally we've seen so far.
Yeah, it seems like a rush in, frankly. And a lot of people are talking about how the pain trade is to the upside, because ultimately that's what it's always been. And they want to forget about this. And they're getting a sign. Maybe they can start to do that.
Here's the view on Wall Street so far this morning. Brian Levitt of Invesco writing, if the futures market is correct and oil prices are around 80 per barrel in 12 months' time, that outcome would likely not be a deal breaker for the U.S. economy. Brian joins us now for more. Brian, good morning.
Hey, good morning.
You are our FOMO guy. We always introduce you as our FOMO guy. If you're sitting this out, what are you missing out on?
I think the specter of April 9th, 2025 looms large. I think a lot of investors are contemplating it, where the administration backed off from its worst impulses on tariffs, and you had one of the best up days in the market you've had in years. And so this whole time, investors have been very cautious about missing this. And if we were to have said on February 27th at the close of the market that this conflict was going to begin, I don't think most people would have thought that the worst you'd see is 10% down in the Dow, dollar barely moved, credit spreads barely moved, 5-year inflation expectations up a bit, but not a ton. Market's going to price out the rate cuts, but without much incidence. So it's been a market that obviously has been a little volatile around events. It's always volatile around policy uncertainty, but it's a market that's just wanting to look past it, at least to this point.
We've had a total reset. We've wiped out the losses since the war started. We're positive on the year so far. Where are you comfortable, just thinking about the risk reward at the moment, given the reset we've seen, where are you comfortable being within the equity market?
So I'll take two questions there. One, are stocks going to continue to outperform bonds? We think so. You would be in a much worse environment with regards to spreads, inflation expectations, policy tightening, if we didn't think stocks were going to outperform bonds. Now, in terms of market leadership, that's a tough one, because coming into the year, all the leading indicators globally were in expansion, and that's small cap, that's emerging markets, that's value. And they, for obvious reasons, have given you a little bit of a slowdown signal here because of $4 gallon gasoline, so that gets you back into mega cap and quality. So which one is it? That's a very big challenge over the short term, right? Because we just don't know the duration of this. So I hate to use the word diversified, but I'd say, risk back to, neutral, where you want to make sure that you have some higher quality mega cap in the portfolio, but also diversified into things like emerging markets that are likely to outperform as this improves.
So you're not alone. BlackRock also yesterday, Jean Boivin was saying that he also liked emerging markets with the assumption that this conflict ended. It's funny. It feels like taking a driver's ed class where they tell you everything that you can go wrong and all the kids just ignore it because they try to just get past it, just get me in the car, I want to go where I want to go. You hear Fatih Birol saying that prices are high, but they're not reflecting the severity of the problem. I agree there is a disconnect. We will see a convergence. At what point do you have to hedge against the chance that this is not over?
Yeah, so what I've been telling investors is that, look, we're not military strategists the same way we weren't molecular biologists in 2020, although we certainly tried to play them on television. So I watch what the market is telling me. And, look, when this started, people said, well, if this goes on more than a couple of weeks, we're in trouble. Well, it's now 6 weeks. Well, if this goes on 3 months, we're in trouble, right? So look at what the market is telling us. And, to come back to the same things, you're just not seeing breaks in the credit market. You're not seeing the bond market in disarray. So I wouldn't be thinking about it necessarily from the duration of it. I would be thinking about it from what the market is telling us. And the market is telling us that we're likely to see this come to a conclusion sooner rather than later.
A number of strategists have said that the market is also suggesting that tech needs to really take the leadership again, because that is going to be the area, to John's point earlier, that it might be most immune to inflationary pressures that are more likely, frankly, at $100 a barrel than $130 or $140 a barrel. So do you agree with that type of positioning versus earlier this year?
Yeah, that's what a slowdown would tell you right now. That's what $4 a gallon gasoline will tell you, no rate cuts. So you're back to an environment where you're looking for growth in what's likely to be a slower growth world. But that can change fairly quickly. If you look at the backwardation in the oil market and you're back around $75 a barrel, if the Federal Reserve comes back into play, you could see back that rotation to the broader market. So, that's a little bit of the frustrating part of it. And, we said coming into the year, this is the broadening market. This is the great global expansion. I remember talking to the team on Friday, February 27th, and said, don't talk to a pitcher during a no-hitter. This is great. And then we got the curveball that is the Iran war. So, yeah.
Brian, how much of this, though, is Trump conditioning for the financial markets? I was thinking yesterday at the close, would we be here if it was a different president, if we had a different commander-in-chief?
That's an excellent point, and he's done a very good job of getting the markets calmed at certain times and anticipating a better outcome than what we might have otherwise feared. So we'll see. I mean, it's not clear that we would have been in this under all administrations, but it's also not clear if we'd be willing to, walk away with a negotiated deal as quickly. So you have both sides of that. I think Trump, on certain days, has done a very good job with the power of the mic, the bully pulpit, being able to suggest that something's in the works when it's not necessarily. There's still that risk of that, no doubt. But I would still come back to the fundamentals of the market suggesting corporate America's in reasonably good shape, the global economy's in reasonably good shape.
It's kept you anchored, and you've been right to stay constructive around all of this. Brian, it's good to see you, as always. Thank you, sir. Brian Levitt there of Invesco. Bramo talked about the Bank of America Fund Manager Survey, some highlights of that. Expectations for growth, down the most since March 2022. Expectations for inflation, the highest since May 2021. The title of the piece this morning, bearish and long.
Yeah, well, I mean, this
right.
is
Doesn't that tell you about how investors have thought about the last month? Bearish and long?
They don't feel good, but they keep buying, kind of like consumers. They don't feel very good, but they keep on going out and buying clothes and going out to restaurants. The other thing is this Bank of America Fund Manager Survey was taken over a period when the conflict was probably more severe, number one. And number two, it is a fantastic contrarian indicator. So if you want to get long, here's your confidence.
Get long bonds as well. Check out this headline that crossed the Bloomberg terminal just moments ago. The UK receiving a record £148 billion of investor bids for a 10-year debt sale. That 10-year yield moved almost 70 basis points through the month of March and got to the highest level since 2008, and a buy's come in. You saw a similar move in Japan just yesterday. 20-year debt sale, the strongest demand since 2019. So yields have backed up. Bob Michael at JP Morgan talked about it multiple times over the last month. Investors were ready to step in. They're stepping in.
I thought that the Japanese bond sale was really notable, given the fact that you saw the greatest amount of demand versus the supply being sold since 2019. These yields are attractive to people. People want income, and they're getting it. And I think the UK really highlights that.
The latest headlines on the bond market for you this morning. Let's get you some top stories elsewhere with your Bloomberg brief. Yahira's back with us for more. Hey, Yahira.
Good morning, John. The U.S. and Iran are considering a second round of talks before their two-week ceasefire ends next week. The New York Times reporting that during the talks over the weekend, the U.S. proposed a 20-year suspension of all nuclear activity, while Iran renewed a suggestion for a halt of up to 5 years. The Chinese president making his first remarks on the Iran war, Xi Jinping describing the international order as crumbling into disarray and vowing to play a constructive role in the Middle East. And United Airlines CEO Scott Kirby is considering a merger with rival American Airlines. Sources telling us here at Bloomberg, Kirby has pitched the idea to senior government officials. A merger would create the largest airline in the world. That's your Bloomberg brief. John.
Yahira, thank you. Thanks for the update. More from Yahira later this hour. Up next on the program, working towards a deal.
We've been called this morning by the right people, the appropriate people, and they want to work a deal. There's no fighting. Right now we have a blockade. So now Iran is doing absolutely no business.
Up next, we'll catch up with the former Deputy National Security Advisor, Victoria Coates. Live from New York City this morning. Good morning. Busy morning of bank earnings coming up. Later this hour, we'll hear from JP Morgan. Then in the next hour, you'll hear from Wells Fargo. Following that, we'll hear from Citigroup. Three big names reporting throughout this morning. Tomorrow, Bank of America and Morgan Stanley. In the equity market, your scores are shaping up as follows. Equity futures pushing higher by 0.2% on the S&P 500. Under surveillance this morning, working towards a deal.
We've been called this morning by the right people, the appropriate people, and they want to work a deal. They would like to work a deal. There's no fighting. Right now we have a blockade. They're doing no business. I didn't like seeing boats come out if they were doing business with Iran, but if they weren't, no boats came out. So now Iran is doing absolutely no business, and we're going to keep it that way very easily.
So here's the latest this morning. The U.S. and Iran weighing another round of peace talks before the two-week ceasefire expires next week as the U.S. blockade of the Strait of Hormuz enters day two. Bloomberg's Tyler Kendall has the latest and joins us for more. Good morning, Tyler.
Hey, John. Good morning. Well, diplomacy is still very much on the table as people familiar with the matter tell us that the goal is to hold another round of face-to-face negotiations ahead of next week's ceasefire deadline, because President Trump went on in those remarks to say that the timetable in Iran has not changed. Now, the White House maintains that this weekend's past negotiations did not yield results because of Iran's nuclear ambitions, though senior administration officials have repeatedly said they think that that is an issue that can be breached. And that comes on the heels of multiple reports yesterday that the U.S. had proposed that Iran accept a 20-year moratorium on its uranium enrichment during the talks in Pakistan. That would mark a shift from previous U.S. demands regarding a potential permanent ban on the program. And the New York Times had a little more detailed reporting saying that Iran had proposed a 5-year suspension. That's giving us a little bit of insight into how the dialogue went this weekend. And even with the prospect of further dialogue to come, of course, there is still that risk of escalation on the table. President Trump yesterday threatened to eliminate any Iranian attack boats that come near the U.S. blockade and knew overnight Saudi Arabia is urging the U.S. to end the blockade altogether amid concerns that regional ports could be threatened. Now, John, President Trump also said yesterday that today we may get further details on which countries have reached out to the U.S. to help with the blockade, but he didn't provide any further information other than that.
Tyler Kendall with the latest. Tyler, we'll catch up with you in the next hour. Let's build on this conversation with the former Deputy National Security Advisor, Victoria Coates, writes the following. Closing the strait will remove Iran's last economic lifeline, and they are not going to be able to tolerate that for very long. Victoria joins us now for more. Victoria, welcome back. The Iranian government is very, very good at stretching out negotiations, extend and pretend, extend and pretend. Is there any reason to believe they're willing to give up or will be willing to give up their nuclear ambitions?
Well, good morning, John. Good to be with you. That's the big question here. And yes, as President Trump frequently says, Iran has never won a war and they've never lost in a negotiation. So you do always have to watch that. Their long game, what they'd like to do is stretch this out for a couple of years, at least through November of this year. Their hope is that the Republicans will lose the midterms, the administration will be distracted by a hostile Congress, and then eventually a Democrat will get elected in 2028, and that will be, sort of their lifeline. But I don't think they can survive this blockade. Their internet has been essentially shut down for 1,800 hours. Their stock market's been closed since early March. Their commodities market has been closed from the same time frame. So if you shut off their ability to export oil on top of all that, you're facing a really, really dire economic situation inside Iran that I don't think is fully understood at this point.
When it comes to the blockade, why is the U.S. willing to have the blockade on Iran, but 3 weeks ago lift sanctions on their crude that was at sea?
Well, I think this is a real shift of approach. And the idea is to break the paradigm, break this historic leverage over the Strait of Hormuz that Iran has exploited at various times to essentially hold the global energy market hostage, and that we can't go on this way, that this regime is intolerably hostile to not just the United States, but to all of its neighbors in the region. And so if we can sort of turn this around on them and make this more painful for them than it is for our partners and allies, eventually we can break that. And the other thing I'd quickly point out is that we see a race toward alternative infrastructure in the region, not just the Saudi petrol line, the east-west line that's running now about 7 million barrels a day. UAE has a group of pipelines. They're looking at ports in Oman down below the strait that could be serviced by these pipelines. I think that Iran really has an asset of diminishing value here in the Strait of Hormuz.
I'm glad you brought up that pipeline, because the Wall Street Journal overnight was saying how Saudi Arabia is pressing the United States to drop the blockade because they're concerned that Iran will go after their ports elsewhere, maybe get the Houthis involved when it comes to Bab el-Mandeb, and then hurt all those exports that are moving through the east-west pipeline. Do you potentially think that the Iranians are willing to go there?
Well, this has always been a concern, but I've found it very interesting. I mean, we're now in, I guess, close to week 6 of this conflict, and the Houthi have literally done nothing. They could have started taking pot shots at shipping through the Red Sea at any point. I think they launched one missile at Israel and it was intercepted. So you've really had an extremely muted response from the Houthi, who may be rethinking their life choices as partners of the Iranians, given what's happened to Iran over this period. So they remain a concern. You've got to keep an eye on them, but they really haven't done very much as of now. I find that very interesting.
There also is a question of what China is doing through all of this. There were reports about Xi Jinping talking about how the international order is crumbling into disarray. There has been reporting that China is providing certain weaponry to Iran. How difficult does it make the meeting between Xi Jinping and Donald Trump in the middle of May?
Well, it certainly ups the ante, as it were, on that summit coming up in May. And I found the timing of that quite interesting as well. China was asked very early in this conflict if they were going to cancel that meeting, given that they're supposed to be such good friends with the Iranians. And they said, no, we would like to see Mr. Trump. Maybe that is not entirely surprising. The president postponed it a month, but he's going to go. And I thought Chairman Xi's remarks at the visit of the Emirati Crown Prince itself also a telling development, that he wanted to host that high-level Emirati delegation at a moment when the Emirates are engaged against the Iranians. He said, the rule of law is so very important. You can't descend to the law of the jungle. Well, that's fine and well, and maybe he should respect that himself as he's starting to take looks at things like Taiwan. So I think, China has been really muted. They really don't have the capability to project power the way the United States has, both in the Caribbean and in the Gulf. And so I think that we will have high stakes for the meeting next month, but I think President Trump does hold a lot of cards.
Victoria, it's good to see you, to get your thoughts and an update. No doubt we'll catch up with you again soon. Victoria Coates there, the former Deputy National Security Advisor, on the situation between the US and the rest of the world right now. In just a moment, we'll catch up with the French government. We need to talk about the relationship between the US and the Europeans, the transatlantic divide that's opened up over the last 6 weeks.
Yeah, Xi Jinping was speaking in a meeting with the Spanish Prime Minister. So one of the European contingencies that has made themselves even closer to China, arguably, than the U.S. With respect to France, how willing are they going to be to join the effort? How many contingency plans do they have to really support their economy as oil prices take a huge hit out of GDP?
And this comes at a time when Emmanuel Macron is saying he's going to have this conference about reopening the Strait of Hormuz, but we haven't yet seen material impact of the Europeans in the region.
We'll talk about objectives for that conference in just a moment. Coming up, we'll catch up with the French finance minister, Roland Lescure. With Europe under pressure from the war, plus Yahira has your morning movers. Check it out. United CEO pitching a massive airline merger. The latest report on that in just a moment. Live from New York City, you're watching Bloomberg TV. The stocks advancing in yesterday's session, wiping out the losses since this war started on the S&P 500. On the Nasdaq, 9 consecutive days of gains. On the Nasdaq 100 this morning, positive once again, up by 0.4%. We've got a morning full of bank earnings for you. JP Morgan about 15 minutes away. Moments ago, numbers from Wells Fargo with the latest. Danny Berger has more. Hey, Danny.
Hey, John, it looks like a miss across the board. Let's start with the big number of net interest income. That comes in at $12.1 billion. That is a slight miss. The expectation was for just under $12.3 billion. The hope was it would be a Wells Fargo, at least with their outlook, aided by a lack of Fed rate cuts. But again, net interest income coming in with a miss. The other thing we were looking from this bank was following U.S. regulators' asset cap removal last year. Can they sustain momentum and add to some of their business? It seems that instead, we have a miss on both investment banking and total average loans. First quarter investment banking fees come in at $796 million. The estimate was for far greater than that, $835 million. Total average loans, that comes in, again, that's slightly higher, 996. So that is the bright spot for total average loans. Another sore spot for them is expenses. This is something Wells Fargo had missed big on last quarter and said our expenses are coming down. We're having fewer severance costs. Instead, a slight higher amount for expenses coming in at $14.3 billion. The estimate was for $14.23 billion. The other thing we're looking out for is any drop in credit quality. Their provisions for credit losses, that is also slightly higher than expected, coming in at $1.14 billion. Again, that is only slightly higher. $1.13 billion is what we are expecting. The CEO, though, putting in the statement that credit performance remains strong despite those higher than expected numbers when it comes to credit provisions. Their headcount is down, but John, expenses are higher and a miss on net interest income and a miss on some of the growth engines that should have been there for Wells Fargo, like investment banking.
Driving the stock lower in the pre-market. Danny, thank you. Stay close. We'll get to JP Morgan later on this hour with Danny Berger. That stock is down in the pre-market by 2.6%. The way things are stacking up this morning, Wells Fargo first, JP Morgan at about 15 minutes time, and then we'll hear from Citigroup, Bramo, somewhere around the 8 o'clock hour.
Yeah, and a lot of what will determine the reaction in markets is how high the expectation is. Just to sort of give a frame of reference, Wells Fargo shares were lower by more than 6% heading into this so far this year. So already taking some of the heat out of that, JP Morgan's going to really be the biggie to understand whether they can capitalize on the capital markets boom that we've seen so far this year.
A slight miss on Wells Fargo. Some major news coming out of the airline sector we need to stay on top of as well. Let's get to your morning movers. Yahira has more. Hey, Yahira.
Hi, John. Exactly. One of the biggest ever airline deals could be on the table. We're reporting that United CEO Scott Kirby has floated the idea of a merger with American Airlines to senior government officials. So you are seeing shares of American up 5.25%. United also up on that news. We're also seeing shares of the satellite firm Global Star soaring in the pre-market, up 13.7%. Also on some potential M&A news on our reporting that Amazon is close to buying the company as it tries to compete with SpaceX and its massive Starlink network. We are also seeing shares of Bloom Energy soaring up 13.5% after expanding its partnership with Oracle in a deal that could deliver 2.8 gigawatts of power to Oracle's massive AI data center network. John?
Yahira, thank you. Thanks for the update. Still thinking about that American United tie-up. What's Kirby up to here? Is he anchoring us to the extreme so we can go after something else a little smaller? Where's this going?
Well, he wants to get assets. He actually was speaking to us earlier this year, and he was talking about how any kind of downturn, he is ready to pick stuff up. And does that mean entire airlines? Well, we shall see. I'm not going to talk about it. But this really is a question of what can get done given all the attempts in the recent past.
The latest on United Airlines and American. JP Morgan numbers, I believe, just crossing as well, Bramo. They're coming a little bit earlier than expected. Let's get into some of that. We just heard from Wells Fargo. Slight miss there on Wells. Heard from Goldman, driven lower yesterday, driven by a miss on FIC. The numbers elsewhere pretty decent. What are you seeing on JP Morgan?
Right now, a beat pretty much across the board. FIC sales and trading, let's start with that, given the fact that Goldman Sachs missed. It came in at $7.1 billion. The estimate was for $6.65 billion. Equity sales and trading revenue came in at $4.48 billion versus the estimate of $4.3 billion. You could see pretty much across the board talking about how performance was strong, talking about beating estimates on earnings per share as well as revenue. So a real question here about what they could accomplish that Wells Fargo couldn't when we just saw those results.
Equity sales and trading, to Bramo's point, upside surprise. Decent upside surprise from Goldman. The miss was on FIC. There is no miss on FIC when it comes to JP Morgan. Some commentary from the JP Morgan CEO, Jamie Dimon, as well. We'll get to those comments in just a moment. Danny Berger has some details for you right now. Hey, Danny.
Hey, John, I'm looking at record quarters for equity trading. And again, this is important considering Goldman had a huge quarter too. Can JP Morgan beat it? They did not beat Goldman, but again, at $4.5 billion, just there under, it is a record. And again, that FIC number, even more important, considering that Goldman Sachs lost, that also looks to be something of a record for them. The last record was $5.8 billion. And this exceeds their estimates at $7 billion. The other really important thing for JP Morgan was the fact that they missed on their investment banking in the last quarter's results. They said it's because the pipeline has been delayed. So you should see that show up. And it has indeed showed up. Investment banking revenue, $3.1 billion. The estimate was for $2.7 billion. It's a standout for them. We'll see how the advisory numbers come in. But we're also getting some commentary from Jamie Dimon as well, saying that he hopes regulators prioritized well-designed regulation. Keep in mind, that's part of the reason why we're seeing their investment banking outperform, saying that the U.S. economy remained resilient in the quarter and several tailwinds are supporting this resiliency. Contrast that with what we heard from David Solomon, warning about concerns of economic and wider stress coming from geopolitics. Instead, we have a CEO of JP Morgan saying that there are tailwinds supporting this economy. And we're also looking to see any commentary on credit. Jamie Dimon saying that they have ample amounts of capital and liquidity and that consumers are still earning and still spending. So again, a beat across the board for JP Morgan, a record for their equity trading, a record for their FIC trading, and you have an investment bank after a blockbuster quarter from M&A that also beats something we wanted to see from JP Morgan considering they missed last quarter.
Danny, thank you. Finding ourselves saying beat quite a few times whilst looking at JP Morgan, FIC, equities, investment banking. The commentary is important from the JP Morgan boss, the CEO and chair, Jamie Dimon, at a time when we've just seen a massive energy shock. The economy is still resilient. There's tailwind supporting this economy. Consumers still earning, still spending.
And right now, they have ample liquidity and they see credit quality as hanging in there. All of this with the beats in the capital markets. Key question has been, and it will be on the call, how much is the backlog potentially going to get shrunk as ongoing uncertainty continues in the Middle East? The markets may be moving on, but regulators and policymakers certainly can't do that.
This is an important headline from JP Morgan, just to wrap things up here. They see full year net interest income of about $103 billion. They had seen about 104.5. That number just crossed in seconds ago.
Yeah, so a little bit lower than what they had previously been seeing. Still, nonetheless, $103 billion is nothing to sneeze at and still would be, I believe, a new record. So it's not as if people are going to be crying about that. Nonetheless, how much are banks going to try to guide conservatively, given the fact, and I guess that's conservative, more conservatively based on some of the uncertainties?
There are many tailwinds here for this economy. The JP Morgan boss cites a few of them: fiscal stimulus, AI-driven capital investment. There is a key headwind we need to talk about as well, which is why we're even having this conversation, which is the shock in the Middle East and what can be done about it. We understand this morning, according to headlines, that France and the UK is co-hosting a summit this weekend to discuss safeguarding international shipping. I'm very pleased to say we can have that conversation right now around this table, because joining us is Roland Lescure, the French Minister for the Economy and Finance. Minister, good morning. It's good to see you.
Good morning.
Thank you for being here, and welcome to New York City. Let's talk about the objectives for this meeting. What can we hope for over the next week?
Well, we can hope for de-escalation. I mean, you know that France wasn't part of the conflict, as we are not a belligerent, we're not even warned that it was going to happen, but now we are where we are. And we feel, with others, the UK and others, we can be part of the solution. We need de-escalation first, we need those talks that are happening, and which hopefully will keep on happening between Iran and the US to move towards some kind of solution. But if we do have de-escalation, we feel that a coalition of the willing, countries from all over the place that have a part in the problem, because as you know, this Strait of Hormuz story is affecting us all economically in Asia, dramatically, and in Europe as well, that we can help pacify the strait. That strait is the knot of the economic impact of that conflict. If we can undo that knot, we know that we'll all be in a better place. So whatever we can do, once there's de-escalation, that's important, to help make the Strait of Hormuz more free, we will do. And that's what's happening on Friday.
What does that actually mean in reality, whatever we can do? Does that mean you'd have a military presence in the Strait of Hormuz? What does that actually mean in practice?
Well, look at what's happening in the Red Sea, and it has happened for a while. There was Houthis there. They were making passage dangerous for ships. And we had, and we still have, coalition of partners that are just making it safe, just preventing, deterring attacks from the Houthis. And, we are in there, the Spanish are in there, there's a few countries in there. Obviously, the Strait of Hormuz would be probably a bigger deal to do, but we can do it, provided, again, that we have the escalation, we have some path to a lasting ceasefire. That will require major headway on nuclear, on ballistic capabilities of Iran that have to be gone. But once we have that, there's a case for non-belligerent country to be part of the solution to pacify the strait, which again is the knot of the economic impact.
We have to talk about consequences as well. I'm not sure how well understood the energy mix story is in France. At the European level, it's been a bit of a mess in places like Germany, particularly the UK. That's been highlighted so many times. Can you briefly describe the energy mix in France, how different it is and how insulated you might be?
I remember Rahm Emanuel, when Barack Obama came into office, that said, you should never let a good economic crisis go to waste. Well, this is what France did in the 70s, when we had an oil shock then. France decided to embark on a major nuclear program that allowed us to go down from 90% hydrocarbon in our energy mix to 60. So 40% of our energy now is coming from nuclear. It's carbon-free, it's cheap, and it's completely sovereign. It doesn't depend on anyone else. And because we don't want this economic crisis to go to waste, we've just announced that we're doubling down. So we're going to bring that energy mix from 90 to 60 to 35 by investing again in nuclear, as well as hydro, as well as renewables. At the end of the day, we have a convergence now of three major driving forces that we have an interest in investing. Geopolitical issues. We have to be sovereign. We have to be more independent of what's happening elsewhere. The environment. I think climate is coming back because it's been on a bit of a back burner for a while, but because we see we're depending way too much of one region of the Gulf and of hydrocarbon, it's coming back, but also jobs. By doing this, we're going to create hundreds of thousands of jobs because building a nuclear power station, building wind farms and solar farms are helpful for the jobs on the ground.
This is all expensive, and it takes money at a time where the amount of debt globally has reached record highs, has surged dramatically since the pandemic. How much fiscal headroom do you have?
Well, it's all going to be about priorities. We can't have it all. And today we have one priority, which is sovereignty, which has two pillars. Defense sovereignty. We will have doubled defense spending in France between 2017 and 2027 by the time we get there next year. And energy sovereignty. So that means we have to save elsewhere. We have to save on our health spending, we have to save on our retirement spending, and it's a big debate in France. We've done so. We've managed to get a budget through, and I can tell you it wasn't easy with Congress that looks, as I said to my Italian colleague, a bit like an Italian Congress, lots of different groups having to discuss and muddle through, but we did. And we're going to have to do it again. But most importantly, I think there's a presidential election taking place next year. And the candidates are going to have to make that choice. Do they want priority on sovereignty, defense and electricity and energy to make France, and at the end of the day, Europe, a stronger place? Or do we still want to be kind of stuck in the past of things we have to change and reform?
Do you expect growth to have to go down because you're saving in these other areas to preserve the sovereignty with respect to energy, with respect to defense?
Well, we entered that crisis on quite a strong footing. I heard Jamie Dimon saying that the US economy is resilient. So is the French economy. It was pretty strong getting into that crisis. So we will have a slowdown in the short run. But again, what we're doing is investment. At the moment, when someone wants to put a data center somewhere, not in the US, they look at France. Because we have carbon-free, ample and cheap electricity, and they need that. So at the end of the day, this is investment in the French economy, in the European economy, but it is attracting investments, including from the part of US investors who want to diversify. We're having, the Magnificent Seven looking at France to invest. We're having US banks looking to invest. And we have French and European companies also looking to invest. So again, short-term resilience, but a bit of a risk. Long-term, we need to invest in the future. That's the only way out. Growth is the way out.
When you look at the long term, when will France finally stop buying Russian fossil fuels?
Well, we're committed to that. We're already committed to stopping gas import. There's no new contracts. This has been decided at European level this year. And any gas import is going to be stopped by January. So we are on the path. The only thing we wanted to do is to make sure that this was done respecting international laws. We are a law-binding country, and the EU is a law-binding country, so we did it respecting some contracts that were still in the go, respecting European decisions, the sanctions decision as well. And this is all taking place the way it should be, respecting international law, which Russia doesn't.
A final question, an important one. You've used the word belligerence to describe others. The US might be in that group in your mind. You can confirm that if you want to. The other question and the other answer you've offered is the word sovereign. This is important with regards to the future of a relationship with the US. Just what is the transatlantic relationship, given the way the discourse has evolved over the last month?
We've been friends for 250 years. And this is going to go beyond the ups and downs, and there are some of the somewhat interpersonal relationship or somewhat disagreement on the short-term way of dealing with such and such problem. What gets us together is much stronger than what divides us. And I can see it every day when I talk to US and French and European companies. We need those companies to keep on working together to give us the right example of what we need to do. When we disagree, I'm going to chair a G7 meeting this week. Sometimes we don't agree on everything with our finance colleagues. We address it in closed rooms. We are allies and friends, and this needs to go beyond what's going on in the ground. We have the solutions to the problem together, and we need to make sure that everyone understands this. We're stronger together than divided. Despite sometimes the somewhat short-term disagreement, we need to look beyond that and make sure we do.
Minister, it's good to see you. Thanks for your time.
Thank you.
Enjoy New York.
Thanks to the
I
three
know
of
you're
you.
heading back to DC as
will.
well, so enjoy America. Equity futures right now in the S&P 500 positive by 0.1%. Lots of bank earnings out there and stories elsewhere. With your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. A U.S. sanctioned tanker linked to China made its way through the Strait of Hormuz despite President Donald Trump's naval blockade. Rich Starry, a medium-range tanker earlier known as Full Star, was blacklisted by Washington back in 2023 for helping Tehran evade energy sanctions. And on those bank earnings, we are seeing JP Morgan shares falling 2.6%. The bank cutting its net interest income forecast for the full year. Still, JP Morgan reporting a strong first quarter, fixed sales and trading revenue rising 21% compared to a year ago. Wells Fargo shares also lower about 0.8%. The company reporting net interest income for the first quarter that missed estimates. Wells Fargo still seeing its full year net interest income at about $50 billion. That's your Bloomberg brief. John.
Yahira, thank you. Thank you very much. Up next, bank earnings in focus.
Most of the volatility, I think, is positive. I think the companies understand how to make a dollar when you have these topsy-turvy markets. This uncertainty can pass just like it did last year. So I still think there's a very good road ahead.
The numbers from JP Morgan were good. The guide was a little softer than expected. Gerard Cassidy of RBC joins us next. The quarterly numbers were good. The guide was soft. JP Morgan down in the pre-market by 2.6%. With the details, Danny has more. Hey, Danny.
Hey, John. It is that net interest income guide. The confusing thing and the details that we will want is the fact that JP Morgan is actually reverting to an old guidance. In the quarter prior, it had told us that for 2026, net interest income would be $104.5 billion for the year. In January, it had said it would be $103 billion. It's gone back to that forecast. So there's going to be some question marks about what's changed in the outlook for JP Morgan to cause them to do that. Now, otherwise, it was a really bright earnings, and that's why you saw originally shares surge higher before you had this new forecast, because everything beat. It was a record quarter for equities. FICC came in for a second best quarter, the best one being during COVID trading times, and that was a number that Goldman Sachs had missed on. Its investment bank also really strong. Its advisory fees surging 82% year over year. Again, this is a bright spot for JP Morgan after seeing some of its deals pipeline pushed into the first quarter. So it is that one sour spot. Now, keep in mind that it's not exactly trading at high valuations coming into this. JP Morgan and the rest of the big banks are down on the year, but still there's some disappointment. It's about that guidance. And again, to Jamie Dimon's point, he's pointing out resiliency in the economy. He does talk about risks and uncertainties and around geopolitical stress. But saying that there are many pillars supporting them, including AI-driven capital investment.
Danny Berger with the latest. Danny's with us all morning breaking down these results. Citi is up next. Jared Cassidy of RBC spent the morning with us as well. Jared, welcome into the program. We used to beat and raise from JP Morgan, not beat and cut. What's behind the cut?
I think, John, what we're seeing is that there was very strong loan growth, both by JP Morgan and Wells Fargo, but both of them experienced a slight decline in the net interest margin. So there was a compression in the spreads, and I think that's probably attributing to the lower guidance on the NII for JP Morgan for the full calendar year 2026. But as you pointed out earlier, John, Wells Fargo held their guide for net interest income. So it's a question of volume versus spread, and the spread came in a little tighter for both those banks.
Gerard, I'm struck by the fact that even though it's beat pretty much across the board, the shares are lower. Do you think that this truly is net income interest, or just simply buy the rumor, sell the news?
I think it's the latter, and I think you bring a good point. It's a little surprising that the stock is down that much on these results, and even the outlook. The outlook, though, the net interest income, as you guys just pointed out, has been moving around between the 103 to 105 billion. It's not a significant lowering to suggest why the stock is down. And also, as you guys pointed out, the capital markets numbers for JP Morgan were very robust this quarter as well.
We heard Goldman Sachs' CEO yesterday blame the analyst essentially for their miss in FICC, saying that they just simply had expectations that were way too high. It's their fault. Do you expect similar commentary from JP Morgan this morning?
I'd be surprised, because I was looking at our numbers and consensus compared to JP Morgan's numbers, and generally they came in better than expected, including FICC. So it's going to be interesting to see what others report. Citi, as you know, reports later this morning. Then we'll, of course, receive Bank of America and Morgan Stanley later in the week. And if everybody beats expectations on FICC, then Goldman had a tougher quarter. They didn't indicate yesterday that there was any trading losses or anything, which is what we suspected. But when questioned on the call about the softness there, that once again, it was more due to the rates business and mortgages being partially offset by better commodities trading and currency trading for Goldman yesterday.
Jared, it's good to see you. You're going to be sticking with us through this morning. Looking forward to catching up some more. Jared Cassidy there of RBC. I've never enjoyed that. Blaming the analysts, blaming the media. Just own the results.
Well, it didn't seem to work.
And own the outcome.
Well, it didn't seem to work, because ultimately you saw the shares respond heading lower. A question, though, here of how much the optimism has been overbaked in some of these book-to-loan values in some of the banks. And that, I think, is maybe what we might see in some of the post-results trading.
JP Morgan down by close to 2% in the pre-market. Just not what we're used to, Bramo. Usually when you see beats like that on a quarter from JP Morgan, the headline that leaks a couple of minutes later across the Bloomberg terminal, and you see it cross, it's the guidance for net interest income, and usually it's higher than it was before.
And $103 billion isn't nothing. But yes, the idea of guiding lower is something unusual.
Stock is down by close to 2% in early trading. The conversation continues. In the next hour, we'll catch up with Eric Johnson of Cantor, Rachel Ziemba of CNAS, Amy Gower of Morgan Stanley, Sonal Desai of Franklin Templeton. The second hour of Bloomberg Surveillance is just around the corner.
inflation is now too high.
We live in a world of higher, more volatile inflation.
There's still a number of unknowns.
Uncertainty breeds conservatism in terms of spending and hiring.
There's damage that's going to persist.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price section of scores look like this. Equity futures firmer by about 0.1% on the S&P. On the Nasdaq, up by a third. The Nasdaq, 9-day winning streak. The S&P within 2% of all-time highs. In the commodity market, first thing you look at still, most mornings, crude, Brent, WTI, below triple digits. 99 on Brent, WTI at 97. Holding us back just a touch today, these numbers from JP Morgan. Quarterly results were good. The guide was a little soft. The stock is down by more than 1%.
Yeah, the guide a little soft, bringing us back to where we were in terms of the guide from January. $103 billion versus $104.5 billion. Still massive numbers and beats pretty much across the board. You got FIC outperforming. You had equities trading and sales outperforming. You had net interest income for the quarter outperforming. The commentary from Jamie Dimon of JP Morgan, interesting, saying that ultimately this is a difficult moment. There are fiscal stimulus and AI-driven capital investments that act as tailwinds. At the same time, the headwinds of energy costs and geopolitical conflicts still loom large.
The economy is resilient. We've heard that from Jamie Dimon and JP Morgan a few times. Consumers are still earning. They're still spending. The risks, they're complex. They include wars and energy prices.
And what we see, depending on these results and what the CEOs are saying in the C-suite, is very different than what you see in the polls. In the polls, you see everyday consumers are concerned about where gas prices are, north of $4 a gallon when it comes across the average for the United States. At the same time, they are still going out and spending, which is why you have executives saying we do see this consumer to be resilient. They might not be happy about it, but they're still spending.
Things have been pretty mixed so far. JP Morgan, Goldman Sachs, we've heard from Wells, Citi, the next to go. Then we'll hear from Bank of America and Morgan Stanley in the next 24 hours.
One of the difficult aspects of this is they are potentially preparing for difficulties down the line, not seeing it yet. You're also not hearing concerns about private credit or any kind of serious credit deterioration that is at least making itself manifest in the balance sheet. So how does an investor deal with this when the unknowns are still a complete black box? The crystal ball that people look at is completely cloudy. So how, as an investor, do you game this out? I would say look past it. It's a FOMO market.
And it's very difficult when you really don't understand what is going to happen in the Middle East. We're supposed to have the end of this ceasefire, potentially talks just before then. But what's on the table right now is what's been on the table. It was on the table in February before Trump decided to escalate and start striking Iran. So this could, as Victoria Coate said, this could drag on for months, especially given the Iranians are very aware that there's a midterm election in this country. Then the president after that only has 2 more years.
We have thrown so much of this equity market. Private market jitters, AI disruption, a major, and I mean major energy shock, and we are within 1.5% of all-time highs on the S&P 500. Futures this morning positive by 0.1%. Coming up this hour, we'll catch up with Eric Johnson of Cantor as big bank earnings roll in. Rachel Ziemba of the Center for a New American Security on hopes for a U.S.-Iran deal. And Sonal Desai of Franklin Templeton as the Fed weighs its next move. We begin this hour with stocks looking for direction following J.P. Morgan's first quarter earnings. Eric Johnson of Cantor Fitzgerald writing the U.S. economy and corporate earnings are quite strong and can handle a short-term spike in oil and short-term supply shocks across different inputs. Eric joins us now for more. Eric, good morning. Good to see you.
Good morning.
Just to add to that, I've talked about what we've thrown at this equity market, private market jitters, AI disruption, an energy shock. And to your point, the negative supply shocks elsewhere as well across labor and goods. And here we are very close to all-time highs. What's anchoring that for you?
So I would say a couple of things. Even though price is only down, call it 1.5% from the all-time high, as you said, if you look at the multiple, that's down very significantly. So the peak was about 22.8 times forward earnings. We entered this year at a little over 22 times forward earnings, and now we're just above 20. And that's because earnings estimates have, over the last 6 months and over the last, 2 to 3 months have surged. So by going sideways, the market has actually been correcting the multiple. So if you look at a multiple chart and you said that was a stock price chart, you would say, wow, we're still very oversold. So I think that has created that sort of entry point, making it look attractive, even being 1.5%, from the highs.
How sticky do you think that multiple compression is?
So I think that 22.8 probably was not correct and was too high. But the earnings growth rate right now, and most of it is really, it's due to AI, right? It's due to the build out. But you're seeing a growth rate that's likely going to persist in this mid-teens range. And if you look at it versus history, you've got mid-teens growth. You've had debt levels that, looking back over the last 50 to 75 years, corporate debt is very low. CapEx, of course, has gone up of late, but also relative to history is also on the lower end. So a 20 multiple, while I still think is on the higher end, I think is something that could be sustained and potentially move a little bit higher from here as the year goes on.
Does that mean that you think that big tech has to lead on any kind of rally, any kind of upside, given the diminished expectations for growth due to the conflict in the Middle East?
Absolutely. I think this earnings season is going to be a very positive earnings season for mega cap tech relative to their stock prices. And so, mega cap tech has gotten hit hard. The multiples have gotten hit hard. And a lot of this earnings estimate revision higher has actually been from tech while the stocks have been getting hit. So I think as you look to this earnings season, I think you're going to see, growth rates in cloud that are going to be very attractive. I think the commentary about the outlook for that growth rate over the coming years is also going to be quite favorable. So yes, I think you need mega cap tech, and I think you'll get it.
John's been talking about this for quite a while. How much room do they have to keep increasing their CapEx spending, given the fact that there are some concerns by investors of exactly what kind of return they're getting, and frankly, the fact that they're becoming more asset heavy in terms of their overall model?
I mean, there's still a very large mismatch between the demand for compute and the supply, and there's likely going to be continued issues in terms of just building it, like actually just being able to physically get all the pieces to build the data centers to meet the demand. And so that's probably going to elongate the cycle. And so I think that in the near term, I don't really see any change to that CapEx outlook.
There's also been concern from some individuals, especially on the Federal Reserve, that maybe they can't do anything. They have to sit on their hands because of what is going on, given the inflationary shock of the energy story. But you actually think the Fed is going to cut this year. You still think that?
I do. So the market's only pricing in a 40% chance of one cut. I think we're going to see multiple cuts. And I think it's really with, I think core inflation. So presumably the end of the war will be there sometime in the next, coming weeks and months. And so as we get to the back half of the year, I think that the headline inflation numbers are going to be looked at by the Fed as old news. And they will have already seen the starting of the move lower in oil, and I think it's going to go a lot slower than people, hope for, but is on the move down. And that core inflation is going to really be what is going to be moving lower, and will be the rationale for the Fed to cut. And I think that this AI, surge in, you look at Anthropic's revenues, right? There's likely going to start to be headwinds, or continue to be headwinds for the labor market. And I think that's going to be for years to come.
And you think we'll see that this year, AI impact basically layoffs?
I think some of that impact in the back half of the year, but we're also going to be lapping tariffs, which I think is going to be very important for goods prices. I think the owner's equivalent rent is just on a downtrend, and based on the current data, should be on a downtrend for the next year plus. And then I think wage growth is certainly going to be under pressure due to that AI dynamic. So I think if you put that all together, we'll be looking at core inflation rates in the back half of the year that are going to be enough for the Fed to cut. And of course, you're going to have a head of the of the committee that is going to be quite incentivized to cut. He's only one vote, but is going to be quite incentivized to cut. And I think that could have significant influence on the committee.
Just extend that a few steps further. You've got AI disruption leading to layoffs in the labor market, and the Fed chasing something they can't affect. Cutting interest rates. For a jobs market they can't change, right? How far are they going to chase that? Because arguably them cutting interest rates will just accelerate further AI investment, no?
So historically, the Fed has been much more sort of backward looking, and I think one of the changes that they want to make is becoming much more forward looking. And I think with Warsh in there, leading, I think he's going to be much more forward looking. Now, what is the impact going to be? that's where it gets very, murky. And likely the impact is not necessarily going to be there, but ultimately the goal is going to be to spur, demand beyond what it would be otherwise. That's going to be a tricky.
I'm struck by the fact that it feels like this market's saying mission accomplished. I feel like this market is collectively on some sort of aircraft carrier with a huge banner saying mission accomplished, we're moving on. And at the same time, oil prices are going to be materially higher. I just wonder at what point higher inflation starts to really bleed into the calculus in a more sustained way.
So one of the interesting things, if you look at a chart of oil prices over the last 15, 20 years, oil prices today are the same as they were in 2008. Okay, that was during the spike in 2008, to be fair, but the same as 2008. Wealth since 2008 has gone up by about sixfold, like 600%. And so the impact, while oil clearly has an impact on a certain segment of the consumer and a painful impact on that segment of the consumer, if you look at the consumer broadly, consumer spending is not really being impacted because of this wealth creation that makes oil prices on a relative basis such a small part of the consumer's spending. And even though we've seen a surge in oil prices, and of course rate of change is super important, but we're also the same price. If you look at 6-month oil, it's the same as it was in 2024, same as it was in 2023, below where it was in 2022. So I think as long as we are here around oil prices, the economy and earnings can definitely handle it. Now, to your point, the market, I think, is saying that we are pricing in a very high probability that it is mission accomplished and that we're not going to see a further move higher in oil. And I think in war, you can assume nothing. And so that is something, until we have a deal, it still remains a risk, even though, I think the odds have certainly gone down that this is going to be extended and that the ceasefire will be broken. I think that those odds are definitely moving lower, but they still exist, and you can assume nothing.
This stock market has taken a lot of comfort from the futures curve in the oil market. Eric, it's good to see you.
Yes, great to see you.
Thanks for breaking it down. Thank you. Eric Johnson there of Cantor Fitzgerald. Within 1.5% of all-time highs on the S&P 500. Equity futures this morning positive again by about 0.1%. With an update on stories worldwide, with your Bloomberg Brief, Yahira has more. Hey, Yahira.
Hi, John. Starting with bank earnings, shares of JP Morgan and Wells Fargo both lower in the pre-market. JP Morgan cutting its net interest income forecast for the full year, with CEO Jamie Dimon seeing, quote, an increasingly complex set of risks ahead. Wells Fargo posting net interest income that missed estimates. Meanwhile, we are seeing shares of CarMax plunging 6.7% in the pre-market. The used car retailer reporting fourth quarter results that beat Wall Street estimates, but said it will spend $500 million in fiscal 2027 to support longer-term growth. And California Congressman Eric Swalwell is resigning from his seat after suspending his campaign for governor. Swalwell is facing allegations of sexual assault by a former staffer, with the House Ethics Committee set to launch an investigation. Texas Congressman Tony Gonzalez is also resigning after admitting to an affair with a former staffer. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for the update. More from Yahira in about 15 minutes' time. Up next on the program, putting the ball back in Iran's court.
The Iranians, I think, did make some progress. They moved in our direction, which is why I think we would say that we had some good signs, but they didn't move far enough. The ball really is in their court.
Up next, we'll catch up with Rachel Ziemba of the Center for a New American Security, live from New York City this morning. Good morning. Stocks higher for 8 days out of the last 9. Up again this morning. Futures positive by 0.2% on the S&P. On the Nasdaq up by 0.4. The enthusiasm continues on the prospect of further talks in the Middle East. And the earnings keep rolling in as well. This from JP Morgan. Trading revenue up 20% from a year earlier. This stat from Hannah Levitt here at Bloomberg. Traders at JP Morgan posting their highest ever quarterly revenue in the first 3 months of the year. The stock is slightly lower. We're down by close to 0.9%. The guide, net interest income for the year ahead, just slightly softer than what they were guiding towards just before.
Yeah, there was this feeling back in February, a long time ago, when everyone expected the expansion to surprise to the upside in the United States. And so any enthusiasm that was baked in during that period had to be retrenched a bit back to where it was earlier this year. Still $103 billion of net interest income. Not a terrible haul.
The JP Morgan down by 0.9% in the pre-market. Up next is Citi at some point in the next hour. And the Savannah's this morning putting the ball back in Iran's court.
The Iranians, I think, did make some progress. They moved in our direction, which is why I think we would say that we had some good signs, but they didn't move far enough. The ball really is in their court. We've made clear where we're willing, again, to be accommodating, and we've made clear where we absolutely need to see the nuclear material come out of the country of Iran. We can start to wind this thing down. I'd much rather wind this thing down with a big, successful negotiation.
So here's the latest this morning. The US and Iran waiting a fresh round of talks before the ceasefire ends next week. Bloomberg's Tyler Kendall joins us now for more. Tyler, what is the potential for a much bigger, successful negotiation?
Hey, John, good morning. Well, at this point, it seems that potential is ramping up as we get indications that diplomacy is still a viable option on the table. People familiar with the matter telling us here at Bloomberg News that the goal is that there could be a face-to-face negotiation ahead of next Tuesday's ceasefire deadline. President Trump indicated as much yesterday, too, telling reporters that Iran had reached out to the U.S. for talks, but also maintained that the timetable for a deal with Iran has not changed. Now, this White House has repeatedly maintained that the reason why we didn't see a resolution to the last round of talks has to do with Iran's nuclear ambitions. However, we're getting multiple reports from different outlets that the U.S. has actually shifted its asks when it comes to Iran's program. Outlets including Axios, the Wall Street Journal, and the New York Times now reporting that the U.S. had asked Iran to agree to a 20-year moratorium on uranium enrichment, different, of course, from a previous demand of a permanent ban, though, of course, we still need to get additional details on what else was in this ask, including further restrictions. Now, John, at this point, even as we have the potential for more dialogue, there is, of course, the potential for more escalation. New overnight, Saudi Arabia asked the U.S. outright to end its blockade amid concerns that there could be real retaliation in ports in the region. President Trump indicated yesterday we could get some more details today on which countries may be willing to help when it comes to securing the Strait of Hormuz. But as the French economy and finance minister told you all earlier on the program, it appears clear that our allies need to get more signs of de-escalation before they commit any other assets to the region.
Tyler, good to see you as always. Tyler Kendall there down in Washington, D.C., in the nation's capital. Joining us now is Rachel Ziemba of the Center for a New American Security. Rachel, welcome to the program. Anne-Marie and Victoria Coates were talking about this in the previous hour. The American strategy has changed. They've gone from lifting some sanctions on some Iranian crude to ultimately blockading all Iranian crude. Rachel, what do you expect to be the outcome of this shift in strategy?
Yeah, well, the U.S. government, thanks for having me, John. The U.S. government is really hoping that this blockade will bring Iran to not only back to the table, but make more concessions. I would note that the Iranian response to the U.S. 20-year moratorium has been to come back with another 5-year one, which I think is similar to what they were offering back in February before this war. So we'll see how much movement we've seen. But ultimately, what this means is that oil flows, is that the oil flows from Iran, if this blockade is effective, could fall. That could be 2 million barrels a day further offline that was going to China. Taking, outages from the Gulf from 10, 11 million barrels a day to maybe 13 or so. So it would just increase the outage that we're seeing here. But the U.S. government is hoping that we get to a resolution. But right now, we're seeing a few sanctioned vessels making their way through the strait. Will they be stopped by U.S. military when they get further out into the Gulf of Oman? We'll see. I think that will be one of the stories for today and the next few days.
Rachel, speaking of that blockade, if the United States does take over a tanker, is it clear to you where exactly they would bring it?
No, it's not. we are in uncharted territory. There was a point earlier this year before the war where the U.S. was, I called it at the time, they were using, kinetic force to implement financial sanctions. They did it with Venezuela, a little bit with tankers going to Cuba, a couple Iranian tankers, but a lot of them just sort of spent time out at sea. Some of the Venezuelan ones eventually came to the United States or went to Caribbean ports. It's possible some of these could go to Oman, could go somewhere else and get processed, could go to friendly countries in Asia. But it's not clear to me that CENTCOM has been charged to stop these vessels. It's not clear that they have a guidance about what to do with them after the fact. This is really a point of leverage that the U.S. government is trying to impose on both Iran and China, right? China has been the buyer of first and last resort for Iran. It's also been the primary buyer of the Russia sanctions. And I'd note as well that the U.S. government I'm sure I've talked about this, but have let the Russia sanctions lapse within the last couple of days, largely because China was the one who was still buying most of that oil.
In order for the Iranians to maybe capitulate for the United States, does the blockade need to go on for longer? Because before the blockade, and we were just discussing the sanction lift on Iranian crude at sea, the regime brought in hundreds of millions of dollars because they were allowed to now export without the sanctions, so at a much higher premium.
You're spot on, Anne-Marie. Iran has been earning more in the last couple of months. They got more vessels out ahead of the war compared to what they were normally doing. It's pretty volatile oil flows out of Iran, I must admit. And they've been able to sell at much higher prices. Now, the sanctions relief that hasn't yet expired, but has been converted into this military blockade, did not lift any of the sanctions on what Iran could buy, how they could spend their resources. That's one of the reasons they want to be paid in crypto or renminbi or assets that don't touch the U.S. Treasury. But undeniably, Iran's military-led government has been able to support itself, and, it's sitting on more cash now, even as more cash is locked up. Now, that's not going to be enough for rebuilding Iran, but it could be enough for the regime to remain in place. And so I think that's where the U.S. government's view that this could be just a couple more weeks of pain, the timelines might not line up, in my view.
Rachel, good to catch up. Thanks for dropping by. Rachel Ziemba there of CNAS. To Bramo's point earlier on in the programme, it just feels like this market has just moved on completely from this story. We've got crude south of triple digits, the front month of the futures curve we're talking about here on both Brent and WTI. The physical market's still very disrupted, of course. The market's taking comfort from where the back end of the futures curve is trading, or at least further out on the futures curve, which implies crude's going to come back down, if you view the futures curve that way. And the equity market's looking elsewhere, looking hopefully to robust earnings for the year ahead.
The team over at Deutsche Bank just put out the chart of the day. The playbook pays off again. And it's the S&P 500 around geopolitical events since 1939, talking about how fade any kind of geopolitics since 1939. We're still in the geopolitical event. It's just that people are saying, in some ways, it's all clear. It's kind of mission accomplished. People see the off-ramp and they're going to buy on it.
It's not over yet. To your point, still in it.
We still haven't found out really a feasible resolution going forward.
Up next, we'll catch up with Amy Gower of Morgan Stanley with metals rising on renewed Iran optimism. Plus, your high-risk got your morning movers. The bank's in focus this morning from New York City. Good morning. The S&P 500, here's the reset. Wiping out the losses from the war, now positive on the year, an 8th day of gains out of 9 days of trading. The rally continues. Futures up this morning by 1/3 of 1%, call it 0.2% on the S&P 500, within, not 2%, but within 1.5% of all-time highs on the S&P. A 9-day winning streak on the Nasdaq 100, up again. Could be day 10, up again this morning by 0.2%. 0.4%. That's how the stage is set this morning. Let's get you some single names 2 hours away from the opening bell. Your morning movers with Yahira. Hey, Yahira.
Hi, John. Taking you through those bank earnings and how the stocks are reacting. We start with JP Morgan. Its traders blew past expectations with a record quarter, which is something we were watching after that massive Goldman miss yesterday on FIC trading, but it was the guidance that it disappointed investors. Shares are down 0.8%, but they have trimmed earlier losses. Meanwhile, we are also seeing Wells Fargo shares down 2.4% after the firm missed on net interest income and fees, key areas for that bank. Staying on Wall Street, we turn to BlackRock. Those shares up 2% in the pre-market after the company pulled in $130 billion in client inflows, with ETFs accounting for almost all of that. And we end on the airlines. One of the biggest airline deals ever could be on the table. We're reporting that United CEO's Scott Kirby has floated a potential merger with American Airlines, that he's talked to senior government officials about that. So now we are seeing American adding to its earlier gains, up 7.4%. John?
Yahira, thank you. I find this a major flex. It's just a flex. Got a really tough moment for the airlines, given the fuel cost situation, and you've got one name coming out and saying, yeah, we're ready to buy. We're ready to go.
It's a specific flex, too, because remember that the CEO of United used to work as the president of American Airlines. So it's a really interesting moment and an increasing rivalry between the big three.
More still to come on that story. On our radar this morning, the US and Iran weighing further negotiations as President Donald Trump presses ahead with a naval blockade in the Strait of Hormuz. The two countries aiming to extend the 2-week ceasefire before it expires on April 22. Elsewhere, that story. United, the CEO, Scott Kirby, floating a massive merger with rival Americans. Sources telling us here at Bloomberg, Kirby pitched the idea to senior government officials. A deal would require approval from both the DOT and the DOJ. And finally, let's finish on the bank. Shares of JP Morgan and Wells Fargo trading lower in the pre-market. JP Morgan Bank cutting its net interest income forecast for the full year. Wells Fargo posting net interest for the first quarter that missed analyst estimates.
Just to put it into perspective, I feel like a broken record, but $103 billion was the downgrade from 104.5. That was the upgrade from January to February, and then February back to where we are in April, and suddenly we're back to where we were when we began the year. These are wonderful earnings. The question is just how much expectations had gotten elevated heading into this. The fact that you're having a record investment banking, a record markets activity with respect to JP Morgan and Goldman Sachs highlights just how much energy there still is in the capital markets. And that, I think, is going to be the takeaway, even if there is a one-day snap in terms of the performance.
And it comes at a time when I know Jamie Dimon also likes to moonlight as a geopolitical risk analyst. He's talking about all of the risk. And at this moment, they feel like the wall of worry, those bricks continuously stack up. They are still doing so well.
Stock is down by just 0.8%. Let's talk about the shakeout in the commodity market, and not in crude. Gold snapping a 2-day losing streak with inflation concerns easing on renewed optimism for a peace deal with Iran. Amy Gower of Morgan Stanley writing the longer-term effects of current events in the Middle East are more bullish than bearish for metals if they bring more stockpiling. Amy joins us now for more. Amy, good morning.
Morning.
And welcome to New York as well. Let's talk about the degree of disruption you've seen in your space over the last 6 weeks. How have things changed?
Yeah, so look, the big change we've seen is really the aluminium market. This has been the most physically disrupted from the conflict so far. First of all, it was a question of we couldn't ship anything out. The region is about 9% of global aluminium production. Then we started worrying about getting those raw materials in, so the aluminum and bauxite. And then we actually had some strikes on facilities and on energy infrastructure. And so we've lost about 4% of global aluminium production. And bear in mind, in commodities, we care about those very small imbalances. It's the price is set at the margin. So aluminium has been one of the standout performers so far. And what you typically see is when these disruptions happen, you're looking at 12 months to fix them. So that's been the big disrupted one. And then, of course, we've had some changes in these macro factors that have been a big driver for metals. So things like the dollar weakness had been a big tailwind. That reversed briefly, obviously coming back towards weakness again, changes in interest rate expectations. So that has taken a bit of the wind out of the sails for some of the others.
Let's just stick on that line, 12 months to fix. 12 months to fix the production, to get back to where we were pre-war. What does it mean for the demand story over the next year? How do you anticipate that's going to change?
Yeah, look, we anticipate there'll be about a 2 million tonne surplus in the aluminium market, which is a lot of demand to try and destroy. I think what we're seeing at the moment, similar to oil, we've got a very steep backwardation, so a downward slope in the aluminium curve. What that's trying to do is disincentivize holding excess inventory at end users at the moment. So we're sort of trying to incentivize everyone to hold as little as possible for now while we try and figure out where we can get a bit more supply. We might also start to see a bit of switching. So could you see perhaps some substitution towards things like steel in the auto sector? But I think it's going to stay a very, very tight market.
How much have you seen different regions pull up the slack, given the fact that in the Middle East there has been a destruction to facilities and a destruction to supplies? Are you seeing, for example, South America start to ramp up production? Australia, how much do you see sort of a shifting to different parts of the world?
Yeah, look, the challenge with aluminium is it's really all about electricity supply. And if we think about everything that's going on in the world with data centers and AI, the one thing that we're struggling with is electricity supply. The two regions where really you would think you could have a bit of response is China and Indonesia. Now, China is actually capped on its capacity. Potentially there's a room to increase slightly your amperage and get a little bit more out of it, but there's not that much that China can do. And then Indonesia has a good pipeline, but we kind of knew that was coming already. They can't really do much quickly, and again, takes 12 months to fix a smelter, also takes time to ramp one up. And power costs are just becoming very, very difficult. I mean, even in the US, we've had smelters being sold to data centers, even where in the US, you've not just got aluminium prices, but you've got this record Midwest premium. So the all-in price here is about $6,000, and that's still not been enough.
So this sounds really problematic. This sounds like it should be moving markets more. It seems like a shortage. It seems like something that's going to cause inflation. Are you as sanguine as the rest of markets that seem to be just sort of declaring the all clear, mission accomplished?
I think, look, there's clearly an element of positioning and flows here. Aluminium was already a very, very long market coming into this, so I would say it's not like the market was caught short and had to suddenly cover, and I think that explains partly it. Some of this is playing out also in the physical premiums in different regions. So, for example, in Europe, you used to pay about $300 on top of the aluminium price to get metal. You're now paying $600, so that's doubled. In the Midwest as well, keeps rising. Japan premiums. So I think we are seeing it, but I would say the physical realities of this are going to become clear as time goes on.
I mean, this is just the latest shock when it comes to what's going on in the Middle East. A lot of importers were also dealing with the on and off potential of what was going on with Donald Trump's tariff policies. Are you seeing more countries stockpile base metals?
So I think we're seeing more countries definitely talk about it. At the moment, we haven't seen too much in terms of what we could say extra buying, but what we see is, first of all, this started off with the US Project Vault talking about, we need to have stockpiles, we need to make sure we've got security of supply chains. We're now seeing the EU, the UK, Australia, South Korea, everyone's starting to bring up that word stockpiling. And so I think as we've had enough supply shocks now, we had this in COVID, that definitely drove increased inventories at the company level, but this time governments are paying attention too. So I think this is going to be a theme for the next few years that's actually going to be pretty bullish for the complex.
Yeah, how much of a premium is that adding to prices?
So I think this will probably keep your prices well above typically we would say prices should be anchored around cost support or incentive price, what you need to bring on for a new mine. But if you think about inventory building, it's essentially demand. So that allows us to trade at a premium. So for example, in copper, we would say that kind of incentive price is more like $10,000 a ton to bring on a new mine. But we forecast prices staying well above that, sort of $12,000 through the medium term, just to take into account that stockpiling.
Can we finish on gold?
Absolutely.
South of 5K. What's going to happen to demand for gold now, and how has that shifted? How has that changed? We've talked so much about this massive tailwind of central bank buying. Is that still going to be the story, or has that ended?
So I think the central bank buying has been the sort of stable level of gold demand under the surface, although what we did see in March was Turkey selling gold to underpin the lira. In contrast, though, we had China actually buying the most gold they had bought since January 2025, so a bit of a reaction to that pullback in prices. I think the bigger factor that's going to swing around is what the exchange-traded funds are doing. So last year, they bought nearly as much gold as the central banks, having bought zero the year before. So they are the ones that really swing their behavior. That's much more dependent on interest rates. So again, they have been selling. And I think also there was quite a lot of buying that was just related to how well gold was doing. So I think the fact that it has come off, we've sort of reconnected with that real yield story as well. I think maybe that stops a bit of the near-term upside and just keeps it a little bit more to do with fundamentals.
Gold this morning, slightly positive by 0.8%. Just one final question, slightly outside of your remit, but try and indulge me. In this market, particularly in equities, they've taken a lot of comfort from the shape of the futures curve in crude. At the very front, you've got these very elevated prices. The closer you get to the physical spot price, you've got a lift in the price. Further out, you've got a massive decline. That's the backwardation people have been talking about now for weeks, 6 weeks, more than a month. People in equities see that as a market-implied bet on the future price of crude. Is that the right way of looking at things when you look at a futures curve?
Yeah, so look, I think the way we would think about the futures curve is more a reflection of inventories and flows rather than a forecast for the price. And this applies to metals as well. Typically, when you have that downward slope, spot prices higher than futures, that's telling people we need to clear everything out of inventory. We need as much oil as you can give us at the moment. So if anything, that downward slope is usually a bullish signal for commodities rather than a bearish one. Interesting. Amy, it's good to see you. Thanks for being here. Thanks for breaking it down. Amy Gow there of Morgan Stanley on the commodity market. Brent crude and WTI just south of triple digits so far this morning and closing below triple digits for 4 consecutive sessions, just adding to some of that enthusiasm in this equity market. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. NVIDIA is denying a report that it's acquiring a large company that would, quote, reshape the PC landscape. The website Semi-Accurate saying the chip maker has been negotiating a deal for more than a year. The report sparking a rally in both Dell and HP shares. Treasury Secretary Scott Bessent saying banks may soon need to collect citizenship information from their customers. The move could make it more difficult for immigrants and some citizens to open U.S. bank accounts. Bessent saying an executive order mandating the change is in process. And a Blue Owl fund raised $400 million from bond investors, marking the first deal of its kind in over a month. The bonds were issued by Blue Owl Capital and priced to yield 6.5%, with proceeds to be used to repay existing debt. Those shares up 2%. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira in the next hour in about 30 minutes' time. Up next on the program, calculating the impact of war.
If we were going to have an extended $90, $100+ a barrel of oil month after month after month, we would have to, here in the U.S., start factoring that into our calculations. It would start spilling over.
Well, we've done month after month. We're just waiting for the next month, I guess. You know, it's adding up. Sonal Desire Franklin Templeton joins us next from New York City. You're watching Bloomberg TV. Stocks up again, getting used to saying that. Up another 0.2% on the S&P, up 0.4% on the Nasdaq. Lots to talk about in the bond market as well, so let's do it. In fixed income stateside, yields just about unchanged on a 10-year at 4.29. Things haven't been unchanged over the last month. We talked about it in the last hour. The move high you've seen in UK yields through the month of March up by close to 70 basis points, levels we haven't seen since 2008. Well, the buyers have stepped in. With those levels, the Debt Management Office in the UK just issued £15 billion of 10-year bonds at a yield of just a little over 4.91%, the highest since 2008.
So the good news for the United Kingdom is they had a record volume of investor demand coming in to buy said debt offering. Yay! That was the headline earlier today. A little bit of a problem, though, when you take a look at what kind of premium they have to pay up to get that interest, which again goes back to the core question we keep asking. How much fiscal headroom do a lot of these nations have to meet any softness in the economic outlook based on higher energy prices, higher inflation?
And also another dimension, and we talked about it briefly, the degree of demand that will step in. Now we've backed up to these levels. We saw it in Japan, the highest yield since the 1990s through the month of March into April. In the UK since 2008. In Germany, I think, since 2011. And this is why bond investors are seeing this as an opportunity. Now, whether it's the right opportunity, I don't know. Not for me to say. But we've heard that repeatedly over the last month, that with this backup in yields, the buyers would step in.
If somebody wants a relatively risk-free, although you can make that argument, a relatively risk-free portfolio at 5%, well, if you don't have to lever it up, it looks pretty good, especially based on where we were, say, 6, 7, 8 years ago.
The latest out of the bond market so far this morning. Under surveillance this morning, calculating the impact of war.
A lot of it just depends, how long does this go? If we were going to have an extended $90, $100+ a barrel of oil month after month after month, we would have to, here in the U.S. start factoring that into our calculations. It would start spilling over. It'd first go into airlines, anybody who has to drive, and then it would probably pretty quickly start getting into food pricing.
So here's the latest this morning. The Federal Reserve weighing the impact of increasing fuel costs with fresh inflation data due out in less than an hour's time. Sonal Desire Franklin Templeton writing the Fed will stay on hold. It's too early to panic about the damage that high energy prices will do to growth. Sonal joins us now for more. Sonal, welcome to the program. I've got to ask you the question. What kind of damage, if any, do you expect from the higher prices we've seen so far?
So the prices, hi Jonathan, thanks for having me. The price increases we've seen so far in real terms are still 20-25% below what we saw in 2022. What damage did they do? No, I mean, clearly on the margin, having $4 a gallon gas prices is problematic. But you have to remember, since 2019, we've had 27-28% inflation. So in real terms, $4 today just doesn't mean what $4 even 4 years ago meant, let alone $4, say 2007-8.
Is that an argument, Sonal, for higher yields from here?
Yeah. So I would say that as far as yields are concerned, I do think that this at 4.30, this isn't a buying opportunity. I think we are for the US. I hear what you're saying about the UK and parts of Europe. I think that there will be more significant damage over there to GDP growth, and potentially you do have opportunities. However, in the US, I think there is scope for inflation to go higher because there's scope still to get that famous tailwind from consumption that we've been waiting for from the tax refunds. In addition, I think that the budget deficit could go higher, as we start seeing more defense spending. At some point, we'll have to see that. It's hard to say that it's all going to happen this year, but over time, just restocking our military implies a higher budget deficit unless they cut expenditure, which nobody seems to have any desire to do.
So now it seems like heading into this year, people were looking for a yield curve steepener. Then it suddenly became a yield curve flattener. You saw the flattest yield curve going back to 2022 at the end of last month. Now people are gaming out what you're talking about, a Fed that might remain on hold or even cut rates, even as inflationary pressures remain. How much do you expect the yield curve to steepen over the next, say, 6 months?
So since I don't expect the Fed to cut, and I do think long-end yields are probably going to go up, I think that the yield curve can steepen. How far can the long end go? Depending on, I hate saying this, but depending on how long the war lasts, that has inflationary consequences eventually, and it also has certain implications as far as the budget deficit is concerned. So I'd say, could you see 25 basis points more, 30 basis points more of yield curve steepening from here on? Yes, and even more as if markets start pricing out rate cuts.
At what point do government bond yields start crowding out some of the corporate bond issuance, given the fact that the United States and other countries are going to have to sell debt to raise money to pay for some of the expenditures that you were talking about? And given the fact that right now we're seeing a record amount of corporate bond offerings come to market?
Lisa, we are awash in liquidity. If I look at how much we have in the short end in cash and liquidity in the ultra short parts of the bond market, I think we still have an overhang of liquidity from close to soon 20 years of massive QE, which has never significantly been reined in, and budget deficits. We're just awash in liquidity. I don't see that crowding out happening. I mean, rates will be higher, and I think we will see interest in the bond market.
So now, when you look at a higher budget deficit in the United States because the restocking of the military and a higher defense budget, do you have to start pricing that in before the midterm elections this year? Because at minimum, likely, the Republicans are going to lose the House.
Yeah. No, I think that the question of how that deficit increases and the timing of it, I think some of it probably does start showing up as we get closer to midterms. For one thing, we probably won't see the tariff revenues, which were never really budgeted, coming in quite as strongly as was anticipated given the changes which are in place as far as tariffs are concerned. There are a variety of reasons to anticipate the ex-post budget deficit is going to be somewhat higher than the ex-ante one, despite the fact that higher inflation does lead to higher budget revenues mechanically. That happens.
When it comes to tariffs, doesn't the U.S. government have another bill to pay, the refunds?
Well, you know, the bill to pay and the refunds, is it going to take years or is it going to take months? I really don't know, because I have no idea how quickly that will be done or how the logistics of it are actually going to be solved. And nobody's really been able to give me clarity on what the logistics of tariff refunds, how it's going to actually play out.
So no, if I was in line to be the Fed chair, I'm not. If I was, I'd be delaying processing my paperwork because I'd have nothing to do with what's going to happen this summer. How messy, I'm not implying anything, how messy is communication going to be later this summer?
Actually, you know, Jonathan, I think that communication would be rather easy because I think that inflation will probably help any incoming Fed chairman by showing up high. You don't cut rates into that. I did hear there's still a big expectation that somehow rates will be cut because Walsh is coming in and Trump has given him the job. But if inflation picks up, and again, it will, it shows up. Inflation, when we see fuel prices go up, it will show up in inflation. It's a separate question as to whether it's enough to actually have a very detrimental impact on consumption. However, it's going to show up in inflation, and I'm not anticipating a massive slowdown in the labor market. So you put those two together, communication is actually not complicated at all.
Would make it complicated for a man that was employed to cut interest rates, but that, I guess, is a different story. Sonal, it's good to see you. It's good to see you, as always. Sonal Desai there of Franklin Templeton on the future of the Federal Reserve and this bond market. Check out this move, American Airlines in the pre-market. This market's shown that report by us a lot of respect. Stock is up by 9% in the pre-market. That report, if you're just joining us, United Airlines CEO Scott Kirby exploring the potential of tying up with American Airlines. American Airlines up in a pre-market by close to 9%.
Yeah, and United shares also up in pre-market trading. The market is saying, please, this looks like a great deal. Whether or not regulators think the same, highly unlikely, although we shall see, because evidently Scott Kirby talked directly with President Trump about this. Heading into higher oil prices, we're getting reports that the European Union is preparing for shortages in jet fuel in the very near future. How much better of a hand do the strongest players have? They have an incredible upper hand when it comes to maneuvering through this. And Scott Kirby wants to take advantage of that with acquisitions.
It would be a big hurdle to clear for the DOJ and for the Department of Transportation to allow this merger to go through. But this isn't the Biden era where you can't have a Coach handbag tie-up. So potentially there is some runway for a sort of airline deal. And maybe to your point, they're anchoring to the extreme. It's not this one, but this is where they're going to set the debate around. And then they'll say, okay, if you think that's too big and just too many problems for antitrust.
How about JetBlue?
Yeah, how about something smaller?
How about that? America right now, up by 8 to 9%. Can you imagine if that did go through? What that would open up, not just in that industry, but in other industries. Other players who would look at the competition.
Google and Amazon?
My goodness. Beyond that.
It'd be crazy.
Just crazy. Coming up in the next hour, Joe Cassidy of RBC, Alicia Levine of BNY, the Port of LA Executive Director Gene Soroka, and Stephanie Roth of Wolfe Research. The third hour of Bloomberg Surveillance is just around the corner.
It's going to be a lot of stress on the market.
Investors always hit the sidelines when you have uncertainty.
It's risky not to take risks.
The market is being very calm about this whole situation.
There's a lot of other themes that people are going to have to sort of roll their sleeves up on again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures pushing higher by 0.25% on the S&P 500. On the NASDAQ, up by 0.5 on the NASDAQ. A 9-day winning streak. In the commodity market, Brent and WTI pulling back. WTI this morning down by 2%. Brent down by 0.8%. 98 on Brent. 96 on WTI. This headline just crossing the Bloomberg terminal. Iran mulling pausing its Hormuz shipping to avoid derailing talks.
Yeah, this according to a person familiar with the Tehran's deliberations, as reported by Bloomberg News, saying that this maybe signifies this desire to keep talks on the rails to avoid escalation in any form as they continue to have ongoing face-to-face negotiations. A real question here about uranium enrichment as well as reopening the Strait of Hormuz. Not open yet, nonetheless, not escalating the conflict further.
Well, exactly. This says to me that Tehran wants to have these talks, potentially, as Reuters reporting this weekend. We reported that talks are potentially underway, but as soon as maybe Friday and Saturday and Sunday. So basically what they are going to do is hold back on any sort of maritime activity to make sure that there isn't an escalation. So keep things at this moment, the status quo, so the ceasefire holds. That, at this moment, would be viewed as a very pragmatic step for this regime.
That is contributing to the reset we've seen in this equity market, wiping out the losses since the start of the war. The S&P 500 coming into this morning, positive for the year. Supporting that maybe some bank earnings. And the bank earnings so far have been very, very mixed. From JP Morgan, from Goldman Sachs, Citi just crossing moments ago. Citi crossing seconds ago.
Yeah, and coming out with a beat for fixed income currencies and commodity sales and trading, coming in at almost $2 billion versus the estimate of $5.02 billion. Equity sales and trading coming in at $2.08 billion versus the estimate of $1.73 billion. Pretty much across the board, there was a slight miss on the banking side. The CEO, Jane Fraser, coming out and saying services had an outstanding quarter. You're hearing that there is this ongoing right-sizing of Citigroup and that the bank is entering into its final phase of divestitures. But the real takeaway here, capital markets very strong. Expectations were very high. For the most part, most banks are clearing those hurdles. The response in markets, though, has been a little bit more differentiated.
This is the early move in the pre-market. The stock is a little bit higher by more than 1%. Danny Berger's pouring through those numbers. We'll get to Danny in just a moment. To set up the next 60 minutes, we'll catch up with Alicia Levine of BNY Wealth following a morning of bank earnings. The Port of LA Executive Director Gene Soroka joins us as war in Iran weighs on global supply chains. And Stephanie Roth of Wolfe Research breaking down the latest inflation data. The latest earnings then, to wrap them up, we've heard from JP Morgan this morning, from Wells Fargo and Citi just moments ago. Danny has more. Hey, Danny.
Hey, John. And the story is trading very, very strong for Citi, posting $5.2 billion of trading for FICC. That comes just under the high watermark of a record they set in 2020 during COVID, but easily above expectations. Their equity business, which, keep in mind, this is much smaller for Citi, posts a record sum, $2.1 billion of trading. The estimate was for $1.7 billion. This is the first time in Citi history that we have an equity trading figure that's above $2 billion. Lisa did mention this. There is some disappointment coming around their banking revenue. That comes in at just over $1.7 billion. The estimate was for 2.1. But the big takeaways and the reason you are seeing positivity for Citi, this was the highest quarterly revenue in about a decade for Citi, the best return on tangible common equity in 5 years from Citi. And Jane Fraser and the team go on to explain that they are 90% of the way to completing their programs around their back office, the regulatory reporting issues, something that they had really been hit through. So it's this transformation of Citi that Jane Fraser has been undertaking as CEO, and they are getting closer and closer to completing that. In the meantime, notching very strong numbers for trading.
Danny, great coverage this morning. We've seen those strong numbers for trading at JP Morgan as well. Citi up by 2% in the pre-market. Jared Cassidy of RBC is back with us for more. Jared, you had an outperform on JP Morgan, an outperform on Wells Fargo, an outperform on Citi. Let's just sit on Citi. The revamp under Jane Fraser, how impressed have you been so far?
John, very impressive. As you can see from today's numbers, the return on tangible common equity was lifted up to about 13%, as it was just pointed out on your program. This is one of the better numbers we've seen in quite some time, and she's done a very good job in divesting the unprofitable non-U.S. consumer businesses. The last one up is, of course, the IPO for the Mexican subsidiary. They have the anchor investors, so we should see that this year. They have their big investor day coming up in May, John, and I think you're going to hear a lot of positive commentary about the outlook for Citi at that investor day.
I was struck by the commentary that we heard from Jane Fraser, in addition to the positivity that you're expressing and that the results most broadly did seem to demonstrate. She said, we're off to an exceptionally strong start in 2026. How do you pair that with concerns about what's going on with the Middle East, with some of the sort of warning discussions we heard from the CEOs of Goldman Sachs, JP Morgan, and beyond.
Lisa, it's a good point because, the first quarter was a tale of two quarters. When you think about coming into the year, up until the end of February, the quarter was very strong in many of the different areas for Citi and its peers. Then the breakout of hostilities at the end of February increased that volatility, particularly in the capital markets area. So there is still a lot of uncertainty out there, but should the hostilities in the Middle East start to die down and we get this resolved sometime in the second quarter, that points to a very healthy second half of the year for the banks like Citigroup.
You were talking about what's left in terms of the revamp. Jane Fraser said that the bank was about 90% of the way to completing the programs it established to fix back office and regulatory reporting problems as pegged by regulators a number of years ago. How different is the bank today than, say, 5 years ago? And how does that sort of set us up in the current environment?
I think it's very different, Lisa, because obviously you've had a change in leadership compared to 5 years ago. And I think that this leadership, led by Jane Fraser, is very focused on delivering the numbers and holds people accountable within the organization. And that's probably one of the biggest differences. And it's showing up on the bottom line. And so once they finish the complete revamp, as you point out, it's 90% completed. Once they finish it, then it's going to pivot from not a turnaround story, but to now it's a growth story. And this first quarter results really gives them a good jump on that growth story.
Gerard, we know you're super busy this morning, so thanks for making some time for us. Gerard Cassidy there of RBC, breaking down the results from Citi. Citi up on the year by about 8% coming into today, up again this morning by 1.6%. For stocks more broadly, finding a firmer footing of late, with the big banks kicking off first quarter earnings season. Alicia Levine of BNY Wealth joins us now for more. Alicia, good morning. Good to see you.
Good morning.
This market's moved on from events in the Middle East. Do you agree with the direction of travel?
So we do agree with the direction of travel. We obviously remained concerned, but not willing to change our allocations because we felt that ultimately the damage that would be imposed by $120 oil for a long time would not allow this war to continue much longer. And so as a result, we came into this with a pretty strong economy, a good setup with fiscal support, all the refunds coming from the IRS this season right now, the labor market looking like it was turning a little bit. And so you have all the incentives on the corporate side for investing. And so when you put it all together, the view that perhaps the U.S. could have grown at 3% or more this year was the narrative coming into the war. And so maybe you shave some growth off of that, but ultimately with earnings expectations at double digits, on March 1st, now 3% higher than they were, you have a situation where the fundamentals actually got stronger even as we worry about inflation and as we worry about where this conflict could go on the left tail.
Difficult to get your head around that over the last 6 weeks, given everything that's happened, the outlook for earnings actually improved. It didn't deteriorate.
It did not deteriorate. It's really shocking. When we tell clients, look, earnings expectations are actually higher than they were January 1st. It's not just driven by energy. I mean, that's the obvious one, that energy earnings are now positive. They were expected to be negative, but materials and the tech sector. So, the great partner to the S&P forward motion is tech earnings, and it's just, they moved higher. The expectations moved higher. So the other thing that happened or didn't happen is that there have been no downgrades at all. And so that's the thing to keep a look at. We're in the beginning of earnings season. You have to see, are input costs higher? Do we have to shave revenue on the expectations? Because that's what didn't happen. We haven't heard anybody bring earnings estimates down. So that's really the tension here. We're now at 15% expected earnings growth for 2026. Is it realistic? Because the margins are the highest too. I'm not sure that's so realistic, and that's where we would look for any kind of moderating force on this.
So it's been a storm. It's been a month-long storm. It's been a 46-day storm, and a real question of what has changed fundamentally in the outlook going forward as a result of the Iran war. A number of people have pointed to leadership. To your point, the gains have come in profit expectations at big tech, at materials, not necessarily consumer discretionary? How much is this back to where we were at the same time last year when tech just reclaimed its leadership?
Look, we had this conversation a few months ago where I said, look, I think tech can actually move higher into the rest of the year. Everybody's selling software. They're getting out of tech, getting rid of the queues because they see more interesting opportunities in international and more traditional, I call it the dirty industry. So materials and energy and utilities. And in the end, tech has actually done quite well since March 1st because the earnings power are there. And if you're worried about growth and you're worried about inflation, you flee to tech. And I think there's a little bit now of a two-way conversation. Like, are you being paid to take a risk in this sector? I think the answer is yes.
The other thing that people were talking about earlier this year is the broadening out away from the United States to the rest of the world. We had BlackRock, Jean Bovin, come on and say that he liked emerging markets. We had the same kind of commentary earlier this morning from Brian Levitt of Oppenheimer. How much do you expect the dollar to revert back to a weakening trend to allow that type of broadening out geographically?
So I think one of the most shocking things that's happened during the war is the fact that the dollar has not strengthened more. The dollar is essentially 1% higher than it was March 1st. One would have expected that the dollar would have strengthened much more based on the concern of the risk. So then what you have to say is, look, if this is simply a crisis-induced strength in the dollar and ultimately it means there's downward pressure on the dollar, ex-U.S. markets will do quite well. And I think we're in that place where we never thought the dollar was going to collapse this year the way many folks did, but it does seem that it should have been stronger than it was, and it wasn't. So I'd say rest of world looks okay. If you are worried at all about tail risk, then emerging markets and developed international are going to be the areas where you feel it first. You spoke about the bond yields here on the show earlier this morning. Global bond yields have sold up much more than in the U.S., and that is a concern. So I think you a little bit have to be careful about the, is this a trade or is this an allocation for the next 12 months? For the next 12 months, I still prefer to be in the U.S.
Within the U.S., you like industrials?
I do.
Can you just tell us why?
Because you have incentives for, first of all, I think you have to think about this. What's driving the growth here? The AI build-out is remarkable. What's happened to some of these energy providers and industrials is remarkable. You have stocks up 40 to 50% year to date, and that's because there are massive incentives to build from the tax code, but also the end user demand is there. And that story is still intact. That's why PMIs are positive. That's why, the housing manufacturing is positive, because you are having this forward push. What got lost in this conversation is that we're really undergoing an industrial revolution. So we've all become geopolitical strategists for a month, but actually the AI forward push is moving forward. And so we see the reshoring theme and the AI build-out theme as enduring for the next 2 years.
We've certainly seen that in the ISM. Some decent momentum in that data. Alicia, it's good to see you.
Great to see you.
Alicia Levine of BNY Wealth. Constructive and has been throughout this war, and we should give people a nod, tip our hats to the people who have been constructive throughout this war, because there was a lot of risk out there, and this market has reset big time. There's still a lot of risk out there, but this market's basically done a round trip.
And pretty much everyone who has remained bullish has pointed to earnings and earnings expectations that have risen during this period of turmoil, and we haven't seen guidance materially lowered, and I mean materially from where they were earlier.
We haven't seen the cuts, to Alicia's point.
Yeah.
We haven't seen the cuts. Now, are analysts just too slow? They're waiting for the management teams over the next months to do the work for them?
It seems like the actual management teams haven't been guiding them that way either, because you heard from the airlines saying that they're going to maintain guidance even with the potential hit from oil prices. So a real question about whether growth was just expected to be so much higher, and so now the actual outlook is pretty much the same as it was earlier.
Adding to gains this morning, we're up by 0.25% on the S&P, with an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Taking another look at Citi, we are seeing shares up 1.3% after the bank posted a beat on revenue and profits. Citi saw $5.2 billion in fixed sales coming in above estimates, while equities trading crossed the $2 billion mark, pushing the bank to its highest quarterly revenue in a decade. Iran is considering pausing shipments through the Strait of Hormuz to avoid testing a U.S. blockade. Sources telling us here at Bloomberg that Iran could be aiming to avoid an immediate escalation and derailing peace talks. The U.S. and Iran are reportedly sorting out logistics for a second face-to-face meeting. And we are seeing shares of Global Star rising 9% in the pre-market. Amazon agreeing to buy the satellite operator for $90 a share. Amazon is aiming to compete with Elon Musk's SpaceX and its Starlink network. The deal is expected to close next year. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Bit of an update as well on Kevin Walsh. We talked about that in the past 10 minutes or so. Is a hearing underway? Coming up soon.
That's according to Tim Scott, who, of course, is the chairman of the banking committee. So it's important what he says. And he says he's cleared all the hurdles. And now we will go to have a hearing for Kevin Walsh next week.
The latest details from Senator Scott so far this morning. Up next, we'll get you some morning calls. Plus, we'll catch up with the Port of LA Executive Director Gene Soroka as the war in Iran weighs on global supply chains. That's next from New York City this morning. Good morning.
CENTCOM has been charged to stop these vessels. It's not clear that they have a guidance about what to do with them after the fact. This is really a point of leverage that the U.S. government is trying to impose on both Iran and China. The U.S. government's view that this could be just a couple more weeks of pain, the timelines might not line up, in my view.
That was Rachel Ziemba of the Center for New American Security weighing in on the situation a little bit earlier. Your equity market update looks like this. We're positive by 0.3% on the S&P, up by 0.5% on the NASDAQ. In the commodity market, Brent and WTI trading softer this morning. WTI is down by close to 3%. Brent's down by 1.3, 98 and 96 respectively. That's the price action. Let's get you some morning calls. First up, Bank of America lowering its price target on Goldman to $10.50 after it reported earnings, seeing results that are likely to give investors pause. Your second call from UBS upgrading Tesla to neutral, believing shares are currently at a more reasonable level following the sell-off. And finally, Citi raising its price target on Alphabet to $4.05, believing its first quarter results are likely to beat expectations. That name is up at a pre-market by more than 1%. Let's turn back to trade. The war in Iran weighing on shipping as the U.S. blockade of the Strait of Hormuz enters day 2. The Port of Los Angeles Executive Director Gene Soroka writing, it will take months to untangle global supply chains. The economic ripple effects are real. They are growing. Gene joins us now for more. Gene, a good friend of this show, and thanks for making time for us this morning, sir. Let's start with the economic effects, the ripples you're seeing. Where do they start? How have they started, and where are they going from here?
Good morning, John. An adage in our port industry is that for every 1 day of service disruption, it takes about 3 days to catch up. Now we're looking at about 4.5 months with respect to the Strait of Hormuz to get all these ships, container, tanker, bulk, back into normal rotations. Now there may be some fits and starts and some quick answers that could be delivered, but once the strait is open, there is a lot of work to do in the supply chain. We're seeing right now where vessel fuel prices have doubled over the last month and a half, and that carry-on effect to importers and exporters right here in the U.S. is happening today. They probably will simply pass on these costs to the American consumer and buyer.
So, Gene, fuel costs are going up. The length and duration of the trips is getting longer because they've had to reroute a lot of this stuff. We've seen diversions pop up in different places as well. From your perspective, are you expecting congestion as well? How lumpy are some of these arrivals going to be, and how complicated does that make life for you?
Each trade, John, is a little bit different. For now, the 46th day, you're not seeing a lot of traffic move from Asia to the Arabian Gulf. Red Sea and East Africa also disrupted. In the Trans-Pacific trade, the ship transits are fairly normal. We're seeing the regular departures and arrivals from Asia, but it's the ports that we share with those Middle East destinations that are becoming somewhat worrisome. Singapore, Kaohsiung, Shanghai, Korea, and then Japan ports. If this cargo continues to pile up at these locations, it may just simply get in the way of cargo that's more fluid, like that coming to and from the United States. I must say, though, with calls over the weekend and last night, the Asia ports are doing a fantastic job of keeping that cargo separated, so the fluidity of the trades that continue to move remains intact.
Gene, when you see individuals having to change basically some of their supply chain routes because of what is going on, do you see any of this sticking even if the strait opens? We have a little bit more of structural changes going forward.
Anne-Marie, this is always an outcome of disruption. Once cargo finds its way to a cleaner or smoother path, it tends to stay in that way for some time. We've had troubles over the past years with drought conditions in the Panama Canal, the Red Sea security issues leading to drops in Suez crossings by up to 80%. More cargo now moving towards the west coast of the United States in that trans-Pacific trade, where previously it had alternative routes and those that were quite lucrative for shippers going through those canals. More than likely, what we'll see is a reset at some point, because that consuming public in the Middle East is very strong. Albeit only 10% of worldwide container trade, the buying power for furniture, footwear, perishable commodities, and other retail goods will continue to be a primary market for those serving the Middle East.
I know there will be a delay even when the Strait opens, but we haven't even seen the Red Sea get back to normal levels, given what took place in the previous years with the Houthis. When do you think the Strait of Hormuz will actually get back to normal levels after there is a more lasting ceasefire?
That's the biggest question. And I don't think it's going to be a straight line, Anne-Marie. One day we're going to get a message that says all clear. I think this is going to be an iterative process. We're hoping that both sides can get back to the negotiating table to find a way towards some semblance of a truce, and then start having a conversation about the commercial implications and how we restart this engine. Right now, this blockade is for negotiating purposes to try to put some pressure on the system, and especially with the price of oil over $100 a barrel, this is a huge revenue pop for some, and it could be a tremendous cost implication for those that can't get their oil and energy products to market. Probably at the same time, there's some mine sweeping going on in preparation for the day. We can see that strait open up a little bit, but when we've gone from basically 110 ships a day down to just a trickle, it will take some time to get these products moving in and out.
We're all hoping for the best, Gene. Appreciate your time. You're a gentleman. Thank you. The Port of Los Angeles Executive Director, Gene Soroka, on the situation, the congestion in certain ports in Asia and the workarounds those guys have been playing up and trying to work through over the last 6 weeks.
Yeah, a lot of this really goes down to a fundamental question that a lot of people are asking, which is how much is the concept of free passageway on the seas truly in jeopardy or becoming obsolete? And how much does this set a precedent for that versus, say, some of the previous conflicts and what's happened there? And that's really going to be crucial to a lot of the supply chains.
Things have got messy very quickly. Up next on the programme, we'll talk about the data, PPI data set to cross. We'll get reaction from Stephanie Roth of Wolf Research. She's with us to break it down. Plus, the latest from the earnings call with JP Morgan's Jamie Dimon and some comments on there on Kevin Walsh. That conversation up next. Another read on inflation data in just a moment. PPI is just around the corner, seconds away. Mike McKee will break it down for you in just a moment. The scores heading into that. Equity futures positive by a third of 1%, 1 hour away from the open of Bell. We're up 0.6 on the NASDAQ. On the NASDAQ 100, a 9-day winning streak, and it could be 10-day. Phenomenal. Could be a 10-day winning streak on the NASDAQ 100. In the bond market, we're set up as follows. Yields on 10s just about unchanged throughout much of this morning. Let's call it 4:30. With your economic data, Mike McKee has more. Hey, Mike.
Good morning, John. It's a little bit better news than anticipated. PPI on a headline basis up just 0.5%. The expectation was for 1.1%. On a year-over-year basis, that puts us at 4% from 3.4. The expectation was we'd hit 4.6%. The core up just 0.1. The forecast was for 0.4. Last month it was 0.5. And that puts the year-over-year for that at 3.8%. The core ex-food, energy, and trade is up 3.6%. That's a tick up from the last time. In the March rise for final demand prices, 1.6% advance in the index for final demand goods. Prices for final demand services were unchanged. And what's interesting about that is that final demand services were the issue in last month's big rise in terms of what happened. The one thing I want to check here is what happened with the services prices that we anticipated would go up. And that's the main issue here for airline fares and things like that. It doesn't look like that's immediately going to come up. So I'm going to leave that for you guys. But airline fares were supposed to go up. Gasoline prices, of course, going up significantly, and those are major issues. I want to leave you with one other thought, and that is that you have reported that the senator from South Carolina, Tim Scott, who's the chairman of the Banking Committee, says that that Kevin Warsh, the Fed chair designate, will have a hearing next week. I'd point out that on Tuesday, the 21st, Christopher Waller, the Fed governor who was considered for the chairmanship, is giving remarks on how he would change the Fed in the future. It'd be very interesting if the two of them end up on the same day.
Mike McKee, thank you, sir. Appreciate the update. Mike McKee breaking down the PPI data and the future of the Federal Reserve. Just an update on the future of the Federal Reserve. This from Punchbowl just moments ago. The Kevin Warsh's confirmation hearing for Federal Reserve Chair will be next Tuesday, April 21. According to multiple sources with knowledge of the plans, the Senate Banking Committee is planning to notice the hearing later on today with just a month or so left on Jay Powell's term. So things are moving forward, slowly, but moving forward.
Yeah, so he has this hearing. The question is, does the Jay Powell probe get dropped so then Senator Tom Tillis can then vote for Kevin Warsh to get through the hearing and then have a full vote, not in the committee, but actually on the Senate floor? That is going to be the key question, because Kevin Warsh getting a hearing, okay, great, that moves it forward slightly, but unless Tom Tillis decides he's going to vote for it, he could just be stuck in this committee. And we don't know if Tom Tillis is going to vote for it until we know what goes on with the DOJ probe on Jay Powell.
In addition to that, we don't know what Chairman Powell himself will do with regards to his future.
Yeah, whether he'll stay on as a governor even after his term as Fed chair is up. He said he will make that determination at a later point. Unclear what the characters are going into that. Nonetheless, it's even less clear to know what exactly the Fed is going to do with the panoply of potential data as well as events that are coming down the pike. Kevin Warsh might want to hang tight before he has to make the argument to cut rates, given the fact that there's a lot of dissent on the committee and some real pressure coming from the White House.
So we've got two things to do here. We need to talk about the future of the Federal Reserve. We need to start on the economic data. PPI softer than expected, pushed that through the bond market. No big moves here. The US 10-year yield is unchanged so far. In the equity market, still positive by about a third, call it a quarter of 1% higher on the S&P 500. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, good morning. Good to see you.
Good to see you.
Your reaction to that data for the month of March?
Yeah, so the details that matter for core PCE is really what we're looking at for. Airlines were up similar to CPI, 2.8. Physician services were kind of light. Finance wasn't too strong. So our tracking for core PCE for March should look, in the 0.2% range. So when we're thinking ahead, the question though is, are airline fares going to start increasing more materially in the upcoming months? And that's when it's going to become a bigger question. And I think that's what the market kind of told you after CPI is, yeah, okay, we get that the March data were okay, but what happens in the months after that? And that kind of fits with our move that we made somewhat recently, pushing out our Fed cuts from previously 2 cuts this year to now 1, and then we added 1 cut into 27.
What's your base case for inflation? What's the trajectory of things through the summer and into the fall?
Base case is that you'll stay around 3%. We think you'll actually end the year at 3.1, but that, of course, compares to the Fed's 2.7. Our expectation is the Fed's ultimately going to have to revise that up, which then makes it a little bit more difficult for the Fed to be cutting in the next couple months.
That said, doesn't the fact that you're getting less inflationary pressure heading into this period a positive with respect to the Fed's ability to cut rates? I mean, doesn't it sort of take off the table the idea that inflation was heating up in a dramatic way that would force a lot of these producers to raise prices for consumers?
It's certainly a positive sign, but then again, your February core PCE was 0.37, so you're kind of starting at an okay place, not amazing, and core inflation year over year is still, around 3%. So I would say it's an okay spot. It's not as if you were starting from a very low inflationary backdrop. And now you're going to have just a little bit of upward pressure in the next couple of months.
What data actually makes sense to look at right now? Because it seems like the market kind of looked past this, is looking past other factors that have come down the pike. It seems like old data, not relevant, not necessarily going to track. What are you waiting for that will give you a sign of whether we really are in an inflationary kind of upswing or not?
It's going to be the realized inflation data. Today is, another indication, but we probably need to see April and May to get a sense of whether you're really seeing the pass-through in terms of airfares. I think that's probably the cleanest component that feeds into core inflation that is directly tied to the energy shock. So if we don't see stronger airline fares in the next couple of months, I think might feel better about the pass-through. Of course, then that tells you maybe there's a problem for airlines to be able to pass through those costs. But that tells you the inflationary backdrop certainly looks different than 2022.
We need to talk about the future of the Federal Reserve as well. Kevin Walsh making an appearance on the JP Morgan call with Jamie Dimon, not literally, but his name was mentioned. Danny Berger was tracking that. Danny joins us now. Hey, Danny.
Hey, John. I have to say it was extremely brief, Jamie Dimon's comments around this. Basically, a journalist asked, Mr. Dimon, how do you feel about delays to the nomination of Kevin Walsh? And I have to say this question was asked right before Punch Bowl reporting the impending maybe process coming forward. And Jamie Dimon said simply, Kevin, I guess they're on a first-name basis, Kevin is a great candidate. The sooner, the better. And then he ended it there. He also goes on to talk a lot about economic confidence he has despite the war and despite some of the uncertainty going forward, but a very confident Jamie Dimon on the economy and basically just saying, yep, Kevin Walsh, he'd be great, and the sooner the better.
Danny Berger with the latest. Danny, thank you. Looking forward to the programme alongside Matt Miller, kicking off in about 20 minutes' time. It makes the question around Chairman Powell's future, I think, all the more important. I've raised this question over the last month or so since the last meeting with the chairman, when he refused to say that he would leave even if the investigations went away, and even if we had a new chair appointed, he wouldn't rule out staying on as a governor of the board. He seems to be worried about central bank independence, which is curious because so many establishment figures back Kevin Walsh to lead this Federal Reserve.
There's some speculation that Fed Chair Jay Powell was trying to take back a little bit of control or at least push back from what the White House is doing. Whether he will come clear with respect to what he's going to do if Kevin Walsh is nominated remains to be seen. Right now, markets have been incredibly sanguine about the future of the Fed. It's sort of a parlor game for us and for analysts to talk about what this could look like in the lack of certainty. But the conviction in markets that this Fed will anchor inflation, I can't get over that. The fact that that has persisted, even with all of this drama, even with the questions of the politicization of the Federal Reserve, is what I keep coming back to. So I agree with you. I think that there are some real questions here. The market implications, though, I'm not seeing it, which I think is interesting.
What was so interesting about when Jay Powell did that at the podium was that he wasn't actually even asked about that question specifically. It was third on his list. He didn't even need to go there, but felt the need to say that as almost to the White House, I still hold this card. Remember, he is still being investigated in the Federal Reserve by the DOJ. And I think that was a reminder to the White House, I could still make this complicated.
An update from Punch Bowl News. I mentioned it earlier. If you're just joining us, this on Kevin Walsh's confirmation hearing for Federal Reserve Chair will be next Tuesday, April 21. That according to sources with knowledge of the plans. That's according to their reporting. The Senate Banking Committee is planning to notice the hearing later on today with just a month or so left of Chairman Powell's term. Stephanie, inflation expectations. Bank of America had this note this morning, and I thought the headline was catchy, that tankers are anchored and inflation expectations are too. It's a curious moment, isn't it, that inflation expectations have been so well anchored. What's behind that?
Yeah, I mean, I think it's a combination of an expectation that it's not just about one person on the FOMC, and they have proven that they are focused on keeping inflation anchored. And it's been an FOMC over the past couple of years that has been very willing to hike rates in the face of the elevated inflation. And it's not just up to one person's view. And what we've seen so far is an energy shock that ultimately could hurt demand. It's different from where we were in 2022 when inflation expectations started to show signs of potentially becoming unanchored, because today the economy is not the same as it was. Back then, payrolls were running at 600,000. Today, they're, call it 50, 60. Unemployment rate was low and headed lower. Now it's up with, some upward pressure from AI. It's just a very different economic environment. And I genuinely believe if we were to see an oil shock that's more significant than this, we would start to see demand destruction, and the Fed will ultimately be easing as opposed to having to hike.
Based on this reporting, this hearing will take place a week today. What is the argument that Kevin Walsh can make for lowering interest rates at the Federal Reserve? Given everything you've just said, what do you think the argument will be that he'll present?
I think it's going to be all about productivity and AI, and a backdrop where AI is disinflationary, and ultimately that will mean neutral rates are lower in the medium term. And that was the view that the market had held before the Iran shock really hit. And it's his sort of best argument, especially in the face of where inflation is today, where the economy is, and the sort of the potential direction of travel. If you do really have a strong productivity cycle, you don't usually have inflation problems at the same time.
It's incredible how little expectations for earnings in this economy have changed over the last 6 weeks, given this major shock we've seen in the Middle East.
Even from some of the most exposed sectors. And what you're hearing is maintaining, even on the margins, upgrading. Again, how much does this go back to how much momentum there actually was in the U.S. economy ahead of this war in Iran, and how the upside was the potential surprise? Now we're sort of getting back to the expectations maybe at the start of the year.
Stephanie, good to see you. Thanks for being here. Stephanie Roth there of Wolfe Research. Equity still positive by 0.3% on the S&P, with an update on stories worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Recapping the data we just got, producer prices rising 5% in March. It's less than the 1.1% that was estimated, but follows a 0.7% rise in February. Companies are navigating a surge in energy costs tied to the Iran war. Stripping out food and energy, producer prices rising just 0.1% in the month. Iran is considering pausing shipments through the Strait of Hormuz to avoid testing a U.S. blockade. Sources telling us here at Bloomberg that Iran could be aiming to avoid an immediate escalation and derailing peace talks. The U.S. and Iran are reportedly sorting out logistics for a second face-to-face meeting. And Kevin Warsh's confirmation hearing to be the next Fed chair is reportedly scheduled for next Tuesday. Warsh clearing a key hurdle, Senator Tim Scott saying Senator Tom Tillis is now planning to support Warsh. That's your Bloomberg brief. John.
Yahara, thank you. Thank you for the update. Up next on the program, we'll catch up with Eric Friedman of Northern Trust Wealth Management, with stocks trading very close to record highs. Plus, Yahara's back with your morning movers. Amazon shares rising in the pre-market on its latest acquisition. That story up next.
For every 1 day of service disruption, it takes about 3 days to catch up. Now we're looking at about 4.5 months with respect to the Strait of Hormuz to get all these ships, container, tanker, bulk, back into normal rotations. Once the strait is open, there is a lot of work to do in this supply chain.
Real physical disruption, this market's looking through it. That was the Port of Los Angeles Executive Director, Gene Soroka. This market, the gains continue. Up 0.25% on the S&P 500. The run continues on the NASDAQ. 9-day winning streak on the NASDAQ 100, the longest since September 25. You make it day 10, the longest since November 2021. The NASDAQ this morning up by 0.5%. Let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. One of the biggest airline deals ever could be on the table. We're reporting that United CEO Scott Kirby has floated the idea of a potential merger with American, that he's talked to senior government officials about this. So you are seeing American up 8.5% in the pre-market, even though any deal would, of course, face intense antitrust scrutiny. And it's official, Amazon agreeing to buy the satellite firm Globalstar in an $11.6 billion deal as it tries to compete with SpaceX and its massive Starlink network. So you are seeing shares of Globalstar up 11% in the pre-market. The deal is expected to close next year. And we end on Lucid Motors. Those shares up nearly 5% in the pre-market as a struggling EV maker tries to reset, naming a new CEO and locking in $750 million from its biggest backers, Uber and Saudi Arabia's public investment fund. John?
Yahara, thank you. Great work this morning. As always, appreciate it. As we count you down to the up and about, some things to look out for the next 24, 48 hours or so. Coming up tomorrow, results from Bank of America and Morgan Stanley, plus the Fed's Beige Book, another read on how they're thinking about the situation in the global economy. On Thursday, another round of jobless claims and more earnings for you. Netflix results just around the corner. The run we've seen in some of these tech names, phenomenal. 9-day winning streak on the NASDAQ. We're looking at day 10. Eric Friedman of Northern Trust writing the following: we do not expect the Iran conflict to severely impact the corporate profit cycle or credit markets. We remain overweight risk assets relative to bonds. Eric joins us now for more. Eric, welcome to the program. I have lost count of how many times I've asked this question of an equity market bull. What is anchoring that view, given the turbulence we're seeing play out in the Middle East?
I think the biggest things, Jonathan, are twofold. Number one, we still think consumers will remain resilient, not necessarily lower income consumers, but middle income as well as upper income consumers. Those have really been resilient. We think that continues. Also think that CapEx is still a variable that will be durable as well. So those are the two variables that we're probably domestically most bullish about. But I would say part of our opinion has changed with respect to the non-U.S. equity picture. We came into the year a little more excited about things like Japanese reflation, European deficit spending. Those may get somewhat crowded out by how challenged those regions in particular will be to the energy issue. So I think if anything, Jonathan, we're still bullish. Maybe a little more of a relative value opportunity set we're seeing right now. But again, we think CapEx as well as consumer durability in the U.S. likely remains the case.
Eric, can you just stay on that? The vulnerability of what's happening internationally, because the key trades for many at the start of the year, Japan took off, that continued. South Korea just exploded higher. Are those stories under threat, even though they have some connection, particularly the Kospi in South Korea, with the developments in tech in the U.S.?
Yeah, I think that's well put, Jonathan. If you look particularly at the issues with, for example, helium and the various parts of the hydrocarbon cycle that play into technology, those aren't going away. In fact, those have gotten worse. And so, you know, part of the issue is will there be some sort of redirection of both trade as well as will there be some new winners within the technology space that are maybe not as affected within some of those shortages. So again, we have to respect that the direction of travel is a bit different with respect to both technology as well as what may be playing out across some parts of the consumer cycle, in particularly in Europe. That's a significant issue that may be different.
Eric, from February 27th till today, what's changed in your portfolio?
Yeah, the biggest things, Lisa, one is that we've shrunk tracking error, which is a long-winded way of saying that, hey, when the world changes quite a bit, we shrink our exposures, meaning we had a somewhat outside view in terms of an overweight for our tactical clients within non-U.S. equities. We've actually shrunk that. We've retained our bias within real assets. So the biggest thing that we've done is really shrunk that exposure with respect to the non-U.S. equity portion of our portfolio, and we've been more emphasizing the real asset side. That's been something that's been consistent, and we'll probably keep that on for some time.
And now the fun starts where we actually get earnings. We get to hear from different companies. The banks have been first, and JP Morgan came out earlier this morning on the call with analysts. The CFO said consumer spending growth is outpacing last year, talking about how engagement and pipelines remain healthy looking forward, talking about mergers and acquisitions, IPOs, the like. How much do you take a read from some of these earnings in terms of the forward look, if you can put aside the conflict in the Middle East, to get optimistic heading into the rest of 2026?
Lisa, it's critical in terms of what we're seeing with respect to consumer activity, particularly do we see credit change? And when I say credit change, are we seeing an extension of, again, we saw personal savings dip a bit, we saw personal income remain somewhat flattish, but are people extending credit in terms of financial services providers? And also, are we seeing consumers get a bit over their skis, if you will, with respect to putting too much on credit? Now, the data's been somewhat noisy, but in general stable, but that's somewhat backward dated. Again, most of the data we get from the Fed is about 2 or 3 months old. This is a great real-time indicator. When Jeremy Barnum and others talk about what they're seeing across their portfolios and their loan books, that's really important for our work. So making sure that we are seeing some stability with respect to consumer activity. Again, decent spending, but that spending can't just all go on credit because that credit, of course, has to be performing, as you and the team have done a great job of reporting for the last couple of months.
Eric, we spend so much time talking about the Federal Reserve. Just how relevant is the Federal Reserve to your outlook?
I think the biggest shock, if you will, Jonathan, to our glass half full perspective would be an outsized move higher in interest rates. That doesn't seem to be something, at least the front of the curve, we're not as concerned about that. We're more concerned about what some of your other guests have talked about in terms of what happens with budget deficits, what happens with the back end of the curve. We're in year 19 of the 10-year Treasury yield being below 5%. We've become accustomed, if anything, we've become incredibly desensitized to interest rate volatility. So the Fed, with respect to front of the curve, not really a big concern for us. We're more concerned about was there upside risk, if you will, if for example, the administration decides to get very aggressive with pro-growth policies that the bond market rejects. That would be more concerning to us than what the Fed may have to offer on a next couple of meetings basis.
Eric, it's good to see you. It's always good to catch up, sir. Thank you. Eric Friedman there of Northern Trust Wealth Management on the Federal Reserve. The front end of the curve there, you can see it on the screen, 380. Anchored around where Fed funds is right now at about 377, 380. This is a Fed that's not going to do anything anytime soon, as the market is well priced for it at the moment, at least on a 2-year yield. Looking at the situation in the Middle East, just how is the blockade holding up? Is it being tested? We were tracking one particular ship. What's the latest?
Yeah, this was a U.S. sanctioned tanker linked to China, and it seems that it has made a U-turn. So everyone was talking about the fact that this is going to be a huge test for the blockade. Does the blockade allow this sanctioned Chinese vessel through? And it looks like it's a no, and it U-turned, so not being able to make that journey out of the strait.
The potential for escalation avoided, at least for now. On top of what we've seen over the last week, Bramo, the market rally continues. You talked about it earlier. This market's moved on very quickly over the last week. The prospect of more talks encouraging this market to move on even quicker.
The fact that we had a blockade announced on Sunday or Saturday, and that Sunday night people came in, and I thought, wow, it's going to be a bloodbath. No, not at all. Actually, we ended the day higher yesterday. We're really close to where we were. We actually surpassed. We took out all the losses since the war began. Gives you a sense of where people's minds are at. This morning, just adding to that, the fact that there are reports that Iran doesn't want to escalate things. They're going to avoid trying to even have any ships U-turn to just avoid the conflict. And the fact, okay, U-turning, but at least there's nothing violent that's happening as a result of it. So people are looking at this and saying, next, earnings, let's hear it.
Minds are firmly on the future, on the summer. A touch of summer in the air in New York City into the 80s. Later, spring with a splash of summer, right? You know?
I'm actually very angry about this. I would like spring to be spring. I don't want it to be 85 and humid, but you're right. People are just looking to...
I'll take the 85 and humid.
I know.
Yeah, and you're complaining about the aircon. Interesting. Okay. Let's see how comfortable you are. Let's make it 85 and humid in the studio, and we'll see if you're happy with that.
No, but there's a happy medium. It doesn't need to be 64.
Okay, we can continue having this back and forth. Just a moment. I look forward to it. All right. Coming up tomorrow, I really don't. Noel Dixon of State Street joins us, David George of Baird, Phil Camporelli of JP Morgan, and Pooja Sriram of Barclays. From New York City this morning, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Ten years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams, whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
Really on a great path and was well positioned. So we had recovery underway. We were going to increase our projection, most likely. Inflation had been under control, oscillating around our 2% target for almost a year. And unemployment was at rock bottom, and employment participation was still significantly high. And then the war started. And that created a situation of, I think, increased fragmentation. Everybody talks about the asymmetry of the shock, which is one of the largest energy shock that we have ever seen on a global basis. And with that going on, I think that there was a movement of more integration. So you have a fragmented world, which becomes, I think, more fragmented, more fragmentation, and determination to better integrate. So we are at this interesting moment where there is damage caused, there is value lost, there is destruction of that. I don't think that Europe is at the epicenter of that. It's clearly Asia, which is the first victim of the situation in terms of economic losses. And I don't think that we should be forgetting the direct losses of people having died, being injured, being displaced, and the destruction that has taken place that will require reconstruction efforts. And that, I think, is and should be at the front of our mind as we look at the economic consequences.
On the world economy, how much of a drag does it have on GDP forecasts? Again, oil prices fluctuate so much.
You know, the direct impact on GDP is going to be measured by the IMF, the World Bank, the OECD to a lesser extent, because it doesn't have the whole constituency, but all of them are revisiting downward their projection. I think it's, minus 0.3 compared with what they had expected. We are revisiting as well our growth forecast and our inflation forecast. We have published that, as you know, and we have revised inflation to 2.6%, growth to 0.9, and then the evolution is going to be a factor of how long, how deep, how propagated the crisis is. And we central bankers are left with defining the baseline, which is, based on the most accurate information we have, what we think will happen. And because this information that we have is constantly changing, and we have a high degree of unpredictability and uncertainty, we have to work on scenarios, factoring in how high oil and gas and all succeeding and derivatives of those products will be, how long it will last, and how fast the situation will be recovered. And we keep looking at current data as they come in. And thanks to Bloomberg, for instance, this comes in on a very regular basis. And we try to figure out where we are relative to the baseline and where we are relative to the various scenarios that we have laid out.
Yeah, and I think you laid it out as three scenarios: baseline, adverse, and severe.
Yeah, I would call the baseline, and the other two the scenarios.
The scenarios. So where are we now?
We are in between the baseline and the adverse. So we have baseline, adverse, severe. So currently, but when I say currently, you have to look at the price of the barrel, the price of the various categories of fuel, the price of futures, and all of that applied to gas as well, to determine where we are exactly relative to these two. But we are somewhere, I think, in between the baseline and the adverse scenario.
So how quickly can that change from baseline to scenarios?
It changes every day. So the difficulty of us central bankers is that we need to take a medium-term view. This is how we define our target. This price stability that defines our mandate is done by reference to the medium-term results. And at the same time, facts, data, number of ships blocked here, volume of oil extracted varies almost on a daily basis. So we need to do this somehow schizophrenic exercise of keeping our eyes on the medium term and making sure that we deliver on our mandate, but at the same time checking the data almost daily.
So what does it mean for monetary policy? Does the baseline already warrant a hike?
What it means for monetary policy is that we have to be, it means two things. We have to be completely agile and ready to move in the direction that is required. And second, we have to be data dependent, as we have repeatedly said. But it does not predicate, as we speak today, Francine, that we will go in one direction or the other. And it certainly doesn't, determine a rate path that I can confirm today. And any of the colleagues who are confident that it's going to be one way or the other, or don't know, honestly.
Does the ECB have a tight...
But don't forget one thing. The baseline and all our scenarios are designed and formulated with the incorporation of what the market assumes. And no other monetary policy or fiscal policy decision affecting baseline or either of the two scenarios.
Do you think there's a tightening bias?
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity indices built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
At the ECB? No, I think we have a compass which indicates price stability, predicated on financial stability. Those are the two, I wouldn't call them bias. No.
How different is it from the shock in 2022? And how different will your response be?
Well, it's different from 2022 in many ways. If you look back, inflation was completely different. Interest rates were completely different. The shock was a combination of supply and demand. It was a vastly different situation. And I think Europe was affected in a much more significant way than it is at the moment, because we had this sudden stop that came out of the war in the unjustifiable war of Russia against Ukraine, which brought to a halt the delivery of gas. That was very sudden.
I mean, at the time, central banks were blamed for acting too slow. Is there a danger? I mean, how does that impact, again, your thinking this time?
Look, I think we've said very clearly that we would need data to act, but that we would not hesitate to act. I think it really captures well the position that we have. We need the data in order to analyze whether it's see-through, it's going to be short-lived, we will get back to back to the past, if you will, although I don't think that's actually possible. And we need all that. So it's either the see-through, which doesn't require that we take any particular decision, or it's going to be long-lasting, it will peak higher, and it will require action on our part, or it will be somewhere in between, which will then require judgment on the part of the Governing Council to decide whether or not the indirect effect and the risk of secondary effect might de-anchor expectations, which then would require action as well.
So I was at a dinner yesterday with the Treasury Secretary who was saying that actually he thinks this will be short-lived.
But he's a political leader, as well as being a terribly competent person, but he's a political leader. I'm not a political leader anymore. And our job as central banker is to stay in our line, to observe our framework. We have one, thank you very much, and to identify whether or not we are in a situation of short-lived, look-through, or long-lasting act, and possibly decisively, or in between, which requires a very subtle identification of how much, when, in order to make sure that inflation expectations are anchored and we do not get the secondary effect. So that's the job. It's the difficulty of what we have to do at the moment, while at the same time very seriously looking at the medium term and being attentive to the short term.
And so your gut feeling for what we're living through now, you'll act quicker than in 2022?
I don't have a gut feeling. When I I hear the music of this is short-lived, we will go through that, you can see through. First of all, we decide what we have to do. Point number one. Point number two, to explain to the fisherman who cannot go at sea because he cannot pay for his petrol. Or when I think of, the household that doesn't know whether they'll be able to pay for the refilling of the fuel tank. Or whether I think of the guys who have to drive to work and who see the price of oil at the pump going up and up and up. I take the see-through story into account, but this is not something that you can actually explain, which requires, from our perspective, in order to align in the most effective way monetary and fiscal policies, It requires that we have a dialogue with the fiscal policy leaders and ask them to be targeted and temporary, transparent and tailored and all those TTTT when they design support packages or help for the people who are the fisherman, the housekeeper, the household, or the guy who is driving his car.
Given where we are now, what does worst case scenario for growth and inflation look like?
Well, the worst case scenario is war in any event. You know, as former head of the IMF, I have seen successful program being completely wiped out by war. So war is, in any circumstances, the worst outcome. If you talk in strict economic terms and the movement of goods and all that, it's the Strait of Hormuz not being open for shipping and transportation, because you have 20% of gas and oil going through that, as well as the like of ingredients necessary for fertilizers, ingredients necessary for microchips, and what have you, not going through the strait.
So what's the pain threshold for the euro area economy that the ECB would have to act on? Is it inflation at 3-4%, or is it?
Look, we have forecasts for inflation that vary between 2.6, which is the baseline that we have, and a little north of 4%. Based on what I told you earlier, which is see-through, strong, decisive reaction, or somewhere in between, depending on the factors that we see, we will adjust, because we will be agile. But one thing for sure is that we will keep our 2%.
Madame Lagarde, how worried are you about the discrepancy between spot and future oil prices, and so potentially tighter markets that we're pricing in?
I think it's the whole dilemma that we have about short-term and medium-term. And the more anxious and worried economic actors are about the resolution of this crisis, the more pressure there will be on the spot market.
How much do you blame the U.S. administration for what's happening to the European economy?
It's not my job to do, blame, to point finger or to associate this or that with blame. I'm more in the hope section myself, and I very much hope that people can sit at the table, can come to their sense, and understand that it will be in the best interest of the global economy, of the people, that a war settlement is reached, and that not just a ceasefire, and that we can navigate through the straits of the world.
How long?
Which has a ramification with international law, but let's not go there. I'm a reformed lawyer, as you know.
We can go there if you want. I mean, is it something, when you look at the economic fallout, actually, in general, even if there's a truce or if there's lasting peace, how long does that play out for?
I think there are two dimensions to that. One is for shipping to resume under regular, normal conditions. It will take, I don't know whether it's 2 or 3 months. I listen to the experts, and I try to understand how long it takes to fill in the ships again, to move the tankers around and to deliver. I think most of them are saying that it's a 2 or 3 months job for the shipping and the distribution. Production, refinery, that seems to be another matter. And when you look at the Ras Al Khaimah refinery facility in Qatar, they say that it's not months, it's years that we're talking about. Some of the facilities in Saudi, whether it's pipeline, probably shorter, but some of the other facilities will require long-term fixing and adjusting and repairing and setting it up again.
I mean, given all of this, is there too much financial exuberance in markets?
You know what is a little strange is that
Weekend Enkulu is here. Stand a chance to win 15,000 Rand. Enter online and rent a smartphone with PhoneYam and make your long weekend happen. 10 weekly winners. Apply online at phoneyam.co.za. Everything good becomes AM with PhoneYam.
There is a tendency by some to assume that it's business as usual. And I think there is a bit of a dichotomy between those who regard business as usual and those, on the other hand, who are saying, watch out, it's a very significant shock, and we are not about to see the end of that process, because there will be ramifications. There will be impact on the price of processed and unprocessed food. There will be an impact on the supply chain if it lasts longer, and we're not going to see exactly the same disruption as during COVID, but something that will be in between normal and COVID disruption.
But do you worry about financial stability? I mean, there's also private markets.
I always do. I always worry about financial stability and price stability because they are intrinsically interdependent. So, we in the supervision function of the ECB and all supervisors around the world have to be very attentive to financial risks, whether sort of declared and disclosed risks, which hopefully have mitigating factors associated with it. At least that's what the regulation is doing, and the rampant risks, the various black swans that are there.
What worries you the most in all of this?
It's what worries me both in good and bad, and I hope we'll never have the ugly, is the impact of artificial intelligence on our economies and the outcome and the governance of artificial intelligence. And what I mean by that is, what impact will it have on not just on productivity, where our star will go, which obviously matters to us central bankers, but what impact will it have on our societies? How many people will be unemployed? How many people will require retraining, reskilling? Who will pay for that? The whole fiscal equilibrium that will result from the massive transformation that is expected in many corners. That keeps me not awake at night because I try to get some sleep, but it's a big issue. It's a really big issue.
Are governments thinking about that, given they're also dealing with this massive energy crisis?
I've been in government a few years of my life. What is really difficult is to focus on the day-to-day, to mind the next election, to respect your program or the expectations that your voters have, and yet at the same time to anticipate what will be the effect of major breakthrough, innovations, significant developments. And I think that in that category, AI is something that we need to have at the front of our mind because it is moving so fast and because the impact of it can be so disruptive for good or for bad. I think the development we've seen with Anthropic and Mythos is a good example of a responsible company that is suddenly thinking, that could be really good. But if it falls in the wrong hand, it could be really bad. We need to do something about it. I don't think there is a framework. Everybody is keen to have a framework within which to operate. I don't think there is a governance framework that is there to actually mind those things. We need to work on that.
Do you think financial institutions are prepared for?
Well, I think they've been called to meetings in various corners of the world, and I know that we at the ECB are talking to financial institutions to alert them to those risks. Yes.
Madame Lagarde, we also had elections in Hungary over the weekend. What does Orbán's defeat mean for Europe and the world?
I think I'm looking at Peter Magyar victory, which was significant, landslide result. He has 2/3 majority. He can change. This new prime minister can change the constitution, remove, a number of obstacles to both growth and integrity in the governance of that country. And I think that is really to be welcomed. The second thing that it tells me is that Hungary is in the European family, and what I heard recently is that this new Prime Minister, Peter Magyar, is indicating that he would like to see Hungary join the euro area and the forint of Hungary be replaced by the euro, which I think is the natural path of all 27, well, 26 actually, it excludes Denmark, but 26 member states are expected to be part of the family. And we have 21. If Hungary goes through the process of integration, the convergence and all of that, it would be a great achievement and it would coincide with what was expected by the founders.
Do you think that the talks on adoption of the euro by Hungary will happen in your mandate?
Wow.
Capfin is the people for the people who need a personal loan top-up. Yes, sir. You didn't hear it from us. Here's a bit of what Azimbabi wrote. I'm happy so far with the service, and they even top up your loan after successful repayments. Apply online and see why we have given Mzansi over 12.5 million loans. Capfin is a registered credit provider. T's and C's apply. Plan smart. Think Capfin.
You'd have to extend my mandate a little bit, which I think is not in the cards. I'm happy to stay, but no, because convergence requires a number of reforms, some of which I think Hungary is going to consider and hopefully implement. The judicial one is a point in case. And then it requires an adjustment period, which is usually anywhere between 2 and a few more years, depending on which country you look at in terms of other practices. But the convergence process takes a bit of time. You need to align a lot of parameters. You need to have the same legal basis on many aspects. But I'm delighted that he's looking at it with a very positive approach, and he's picking up on that basis, which has not been the case for a long time.
Talking about your mandate, will you see it out? Will you fully finish your mandate?
Look, when there is big clouds on the horizon, the captain does not leave the ship. And this captain is not going to leave the ship because I see clouds.
Biggest cloud?
Well, you know them.
What do you see?
We're all facing the same situation with asymmetry, as I indicated. But when you see, major disruption, the energy supply being reduced, when you see threats to growth, upside risk to inflation, these are serious matters that we have to be attentive to and to keep under control, so that our price stability, our 2% target, is not going to be varied from.
Madame Lagarde, Captain Lagarde, thank you so much for joining us. Thank you.
Thank you again, Madame Lagarde and Francine Lacroix, for that terrific interview. If you could all remain in your seats while Madame Lagarde exits. And again, we appreciate your time. Thank you so much.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Wednesday the 15th, good morning. Let's talk about what's going on. So markets are trying to move on from the war with Iran. Basically, hope is growing that talks will deliver some form of de-escalation. That said, the Strait of Hormuz very much still closed. Shortages are continuing to grow. It is a busy morning for earnings as well. We've got SML on deck, we've got Kering, we've got Hermes. All of these big stocks, Anna, very much in focus this morning.
Yeah, absolutely. As you say, markets are trying to move on, and to some degree successfully moving on, it would seem, from a focus on war in the Middle East. The problem is, if you're long stocks, that doesn't necessarily mean a positive picture for European equity markets, and that has to do with earnings. We'll come to all of those earnings stories that you mentioned, Guy, in a moment. So Euro Stoxx 50 futures down by 0.25%. S&P futures pretty flat, actually seeming to pick up something a little bit more positive in the last 20 minutes or so. Brent crude prices then, just keeping an eye on those because we are still watching the Strait of Hormuz. Pretty flat. Flats are positive this morning, 95.31. The countdown to the opening trade starts right now.
Good Wednesday morning. Yesterday's session was pretty epic in so many ways. You've got this kind of new narrative beginning to develop. The war will be over soon. Talks are going to lead to de-escalation. We can put that in the rear-view mirror. The U.S. economy even with the war hit, is probably strong enough to actually weather the storm and deliver a fairly decent economic outcome. We'll talk about Europe in just a moment, whether or not that is the case there as well. Europe looks a bit different. But the AI story is still on. The AI boom is still booming. Take a look at what is happening in the semi-space. Absolutely epic session yesterday. The NASDAQ surging. Do you believe all of this? Does it hold water? The Strait of Hormuz is still closed. Oil is still elevated. But markets want to move on.
Markets do want to move on, don't they? And let's just go around the world and think a bit more about where the markets are moving on. So we talked in the show yesterday about how the S&P was back to pre-war levels. We now see the same is the case for Taiwan, the Singapore Stock Exchange, the CSI 300. And the fact that some of those are in Asia is interesting, given the exposure of those economies to the products coming out of the Middle East. So that's where we are moving on, it seems. Treasury markets also, what is the role of treasuries? What mode? What's the primary focus for Treasury markets right now? At the beginning of the war, it was all about inflation fears. We had a brief period where we then worried about growth. And now, whatever the driver, we are, it seems, according to some of our colleagues reporting, positioning for increased demand and a drop in yields. In particular, on the 10-year, there's sizable positioning around a drop in yields to 4 to 4.2%, to that kind of range. Doesn't sound as if we're still worrying much about inflation then. So we're trying to move on from that fear as well.
If you listen to the bank CEOs yesterday, the bank CFOs yesterday, they were all telling a very positive picture over the States about what they are seeing. Basically, they've got an economy that they think is resilient enough to weather the shock. And the US consumer seems to still be in fairly good shape. And as a result of which, it's kind of, is it businesses? Are we back to where we were? Is it a new normal?
Right.
Whatever it is, it's still a fairly positive picture because AI is basically Strait of Hormuz versus AI at the moment, as far as I can tell. The AI boom is on. The semiconductor stocks are just going ballistic.
Interesting to think about the US consumer. Deutsche Bank putting out some research talking about how the dollar has given up most of its war gains, and actually thinking about now how the dollar might be weighed on by the consumer story in the States, because the responsiveness of the gas market over there means that actually maybe they're paying more of a consumer price than some of the other places in the world where the price at the pump is more controlled, even if the economy is more exposed. Shall we talk about what's going on with energy prices then and the Strait of Hormuz? Because it is still closed. It is closed by these two blockades that we know about. Although our colleagues reporting that Iran is considering a short-term pause in exports to avoid testing the blockade. And we saw that happening yesterday, with the US having some success in turning back some 6 vessels, including the Rich Starry, which we put a great deal of emphasis on yesterday. Today's Rich Starry is moving in the opposite direction and testing the Iranian reaction function here. This is the Agios Fanurios I, and this is apparently heading to Basra. Yes, heading to Basra to load up on crude, which will then go to Vietnam. So this is very much not an Iranian focused vessel. So the Trump administration has no problem letting it go into the Gulf. Will the Iranians allow it to go in to pick up Iraqi crude and to exit again, crucially?
It's still closed.
Yes.
The shortages are still...
Well, it's still... I mean, we are seeing some traffic through, aren't we?
Well, how many was it before? 130.
130, yes. It's a fraction.
So we are dealing with fractions of what we saw before. So shortages are just building. The longer this thing goes on for, the longer we're going to have a problem for. And I think that is the narrative that we've got competing. You go back to the first conversation we had, tech's doing really well.
Yeah.
Is that enough? Is the US economy enough? Is this... How long before these two things kind of collide again?
Yes.
And the market has to react?
I was reading an interesting comment from Michael Ball on the Markets Live blog, where he was talking about lots of reasons why the market wants to move on from all of the focus on war, but saying that the worst case shortages have just not shown up. And I just wondered if you need to say yet.
Yet, yeah.
Or whether we can call the all clear on that. But given the lags between getting the product out of the ground and around the world, it seems as if there's a lot I don't understand anyway.
Let's talk about earnings. ASML is up a lot this year. Over the last year, ASML has absolutely rocketed. So its stock has been flying, and it's been flying over the last few weeks as well, into this earnings report that we've had this morning. Now, the earnings report this morning is a kind of, you need to look at it two ways. Q2, maybe they're being a little bit more cautious. Full year, in terms of the sales outlook, they're being really quite positive, and they're upping their guidance. Which of these do you focus on? Because the narrative coming out of the company is that actually we're sold out. that we are supply constrained, that we can't deliver what everybody wants. So which of these narratives? I am not surprised that we're taking a little bit of profit this morning, maybe.
Yeah, it does seem as if in Europe's attempts to move on from focusing on the war, we're not finding the positives in the earnings stories this morning, are we? Because as you say, there was one to find in ASML. They're not telling us a huge amount about what's going on in China, and the team talking about how, well, they are saying that they can accommodate a change in export controls around China in the new guidance that they have given. So I suppose that's a bit of a positive. But there isn't a huge amount of mention of China, and maybe that is still an area of concern for markets. We've also got numbers out of Hermes, and I think this is interesting because first quarter sales at constant FX up by 5.6%. Here again, we've got a company disappointing against estimates, and we're not that used to Hermes disappointing. This is a company that Andrea Felsted likes to tell us doesn't face much competition, maybe facing a little bit. And actually, the Middle East stands out here as an impact, saying that the UK, Italy, the Swiss market, Thailand, all hurt by tourism disruption, which I think is fascinating. So this isn't just a Middle East story that stayed in the Middle East in terms of its impact on travel and therefore luxury.
Early Q2 Middle East traffic down, but sales are starting to improve. So again, are we moving on? Are people initially people were shocked by what was happening around them, but then they get back to buying
Couldn't
Birkin
make
handbags.
that trip to Dubai that they'd planned.
Yeah, or maybe if you're in Dubai, you didn't go to the mall because for obvious reasons, and maybe now you're beginning to rethink about what you're doing next. Kering wasn't great either.
Yes, absolutely. And the ADRs initially jumped, but then dropped when people had time to sort of digest what was happening here. But again, there, to echo what Andrea Felsted was saying about LVMH yesterday, some of the underlying drivers not looking too bad, whether it was the North American market or some of the non-Gucci businesses. But then the focus is on Gucci, and it's on the turnaround over at Gucci.
It's a fairly big portion of that business. What have we got coming up on the show? We're going to talk more about what is happening with that luxury space. Yelena Sokolova is a Morningstar senior equity analyst, going to be joining us shortly to talk about all of that. Louise Dudley, Federated Hermes Global Equity Portfolio Manager, will be joining us to talk about the wider picture. Emily Ashford, Standard Chartered's head of energy research, will be joining us a little bit later to look at kind of the Gulf being closed and the ongoing impact that's having into the energy space.
Yeah, absolutely. Let's tell you about some of the other items we have on the agenda for you today. IMF spring meetings, they continue over in DC, so we'll continue to watch that. US earnings, Bank of America and Morgan Stanley will be on deck. We've had numbers. We'll talk about that in a moment. Later, we'll be hearing from the Bank of England's Bailey, the ECB's Schnabel and Villeroy, all speaking in DC. So there's a host of finance ministers and central banking voices set to speak over in Washington. So a lot of that news flow could come later in our European day. Later, we'll hear from Fed speakers, so Michael Barr, Michelle Bowman, 7 o'clock UK time, we'll get the Fed beige book out of the United States. The bank earnings story then has been quite interesting. I'm not sure I took away one clear message yesterday. Maybe you did, Guy. But we had JP Morgan down. This is stock moves. JP Morgan down, Wells Fargo down, Citi up and BlackRock up. So there was, in terms of the stock price reaction, that's not the whole story, but in terms of that, it's quite divided.
The message I took away was trading is fantastic, and if you were a European bank and you were producing these kind of numbers, you'd be taxed a lot. But that's not going to happen over in the States. These guys are making a lot of money out of what we're seeing in terms of the turbulence we're getting on global markets, and it's not kind of gappy turbulence. It's nice volatility apparently, and the US economy is fine. The US consumer's fine. Apparently, everybody's got jobs and they've got wages and they're continuing to spend money. So nothing to see there.
Yeah, not too much of an alarm bell around the US economy or around private credit, because that was going to be an area of focus. The linkages between private credit and Wall Street, well documented, talked about on this program a number of times. And there were some areas of disappointment. So Wells Fargo missing key estimates and no upgrade to guidance. So that seems to be enough to tank that. And JP Morgan dropping, despite the fact they had that record trading revenue up by 20% year on year.
Equity indices built on opinions. That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
You know, quite amazing. The market is quite discerning, isn't it? / fussy.
You've also had a good run. This is it's like ASML this morning. The stock has doubled almost in 12 months. So little kind of drop this morning. We're going to make a lot of noise about it, and European earnings are going to impact the European market open this morning. But ASML's had a really good run. JP Morgan's been has rallied into these numbers, and therefore maybe just at the edge of the margin, maybe you take a little bit of profits.
I'm noticing that Hermès is expected to fall at the start of trade in Paris. So we'll certainly keep what's going on in Paris in mind when it comes to luxury. Interesting that despite seeing this coming for the luxury sector in Paris, we still find room for another leg downwards on some of these earnings reports we're getting. So we'll watch that. We'll also watch the Dutch market, of course, with ASML in mind. And thinking about the banking sector, remember that later today we will have interviews with Ted Pick, the CEO of Morgan Stanley, who will join after the earnings report from that particular Wall Street bank. We'll also be speaking to CS Venkatakrishnan, the Barclays CEO. That conversation at the IMF spring meeting.
Looking forward to all those conversations. What else do you need to know this Wednesday morning? The London Stock Exchange's CEO says the market currently has its largest pipeline of listings in more than 20 years. Speaking to Bloomberg at the HSBC Global Investment Summit, Julia Hoggett said the recent market reforms are attracting domestic and international companies to the UK.
The simple reality is we have the biggest pipeline we've had since 2005. So this reform agenda is bearing fruit. Our lawyers and our bankers are very busy right now in preparing transactions. And those transactions are coming in not just from the UK, but around the world.
Talking of IPOs, Bloomberg understands that Anthropic has received several offers from investors for a new funding round that could value the company at more than $800 billion. The offers would more than double the $350 billion pre-money valuation. Anthropic attracted its $30 billion fundraising. That was just back in February. Bloomberg previously reported the company has discussed a public listing as soon as October. And the US Treasury Secretary Scott Bessent said President Trump's tariffs may be restored by July to levels that were in place before the Supreme Court struck down many of his pre-Supreme Court levies. Speaking at a Wall Street Journal event in Washington, Bessent said the administration is seeking to implement or conduct Section 301 investigations, including probes into other nations' industrial overcapacity and forced labor practices. These, he indicated, could give the US cause to implement new tariffs.
Back to tariffs then. We really are trying to move on, aren't we? Coming up on the programme, Christine Lagarde tells Bloomberg that higher energy costs have pushed the euro area away from the ECB's base case outlook. We will bring you some of that interview later in this programme, coming up very shortly, in fact. Plus, we'll take a look at the stocks to watch at the open, including the luxury sector. Paris in focus there after disappointing results from Hermès and from the Gucci maker Kering. Up next, we will be speaking to Luigi Speranza, Global Head of Markets 360 and Chief Economist at BNP Paribas. So we'll get thoughts there for certain on the Eurozone economy. If you have questions, if you want to get in touch with us, get involved in these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back. 7:16 here in London, and this is the picture on European equity market futures. Globally, the narrative is we're trying to move on from focus on the war in the Middle East. That puts earnings front and centre here in Europe. We haven't yet made up for the ground that's been lost on European stock markets since the start of the war, but we are trying to focus on the earnings stories. That doesn't necessarily mean good things for stocks. CAC futures, I can see, down there by 0.2% or so. So we'll certainly focus on the luxury space and the earnings stories there. Let's think about the impact that we've seen from the war on the Eurozone economy. ECB President Christine Lagarde says reaching a settlement to the war is in the best interest of the global economy. In an exclusive interview with Bloomberg, Lagarde also discussed how the prolonged conflict has weighed on her outlook for growth and inflation.
I have seen successful program being completely wiped out by war. So war is, in any circumstances, the worst outcome. If you talk in strict economic terms and the movement of goods and all that, it's the Strait of Hormuz not being open for shipping and transportation, because you have 20% of gas and oil going through that, as well as the like of ingredients necessary for fertilizers, ingredients necessary for microchips, and what have you. not going through the strait.
So what's the pain threshold for the euro area economy that the ECB would have to act on? Is it inflation at 3-4%, or is it?
Look, we have forecasts for inflation that vary between 2.6, which is the baseline that we have, and a little north of 4%. Based on what I told you earlier, which is see-through, strong, decisive reaction, or somewhere in between, depending on the factors that we see, we will adjust because we will be agile. But one thing for sure is that we will keep our 2%.
Madame Lagarde, how worried are you about the discrepancy between spot and future oil prices, and so potentially tighter markets that we're pricing in?
I think it's the whole dilemma that we have about short term and medium term. And the more anxious and worried economic actors are about the resolution of this crisis, the more pressure there will be on the spot market.
How much do you blame the U.S. administration for what's happening to the European economy?
It's not my job to do, blame, to point finger or to associate this or that with blame. I'm more in the hope section myself, and I very much hope that people can sit at the table, can come to their sense, and understand that it will be in the best interest of the global economy, of the people, that a war settlement is reached, and that not just a ceasefire, and that we can navigate through the straits of the world.
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now, we're in the heart of Egypt, your gateway to Africa and the Middle East.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
ECB President Christine Lagarde speaking exclusively to Bloomberg's Francine Lacqua in Washington. A couple of sort of bits come out of that. One really stands out to me. We will keep our 2%. That is coming from Christine Lagarde. But what has been interesting is the pricing around an ECB hike has definitely faded over the last few days. We've gone from an 80% probability to a 30% probability in terms of market pricing around the next meeting, which is April the 30th. Is that about right? Luigi Speranza, Markets 360 Global Head and Chief Economist at BNP Paribas, joining us around the table to discuss. Good morning.
Good morning.
Nice to see you.
For having me.
Yeah, great.
And to your question about April, our central case at base case is a hike in June.
Right.
I think the ECB comments have been quite consistent. No rush, optionality, and need to see some evidence of second round effects. So higher inflation is not in itself sufficient for a rate hike, and I don't think by April the ECB will have this evidence. But there is also an implicit bias to tighten. We will adjust. And I think inflation will justify rate hikes in the future, so our base case is for June. So in a way, I agree with the market movements here. Markets priced out April, but June is still priced in, and we do agree that that's kind of reasonable base case.
Tricia used to talk about having a single needle in his compass, and that was inflation, and it was 2%, and she's talking about that as well. We will keep our 2%. Isn't there a danger that economic growth, though, becomes a problem? And I appreciate they have a single needle in their compass, and it is inflation. But isn't there a danger that actually the European economy... I was listening to the IMF forecast yesterday, and they are pointing to a sharp slowdown in the European economy.
I think it's more than a risk, actually. I think it's a reasonable base case now that you see a significant slowdown. Higher inflation means also lower growth, and you have sentiment effects, you have delayed investment because tighter monetary conditions, you have a real income issue which will slow consumption. That said, I mean, the probably silver lining is that there was strong momentum pre-crisis. I think this is an important offsetting factor. And so when I put the two things together, I think slowdown, but no recession, is a reasonable base case here. But the slowdown is a fact, I think, and will be increasingly evident in the data. Should this stop the ECB? I think that's the point. And here is a trade-off between short-term and medium-term.
Yeah.
Not acting might mean higher inflation becomes more entrenched, and you have to be even more aggressive in the future, slowing down the economy more. So the ECB has got this trade-off to consider, and I think kind of a reasonable approach is to be resolutive, decisive at the beginning, and the sooner you do, the less you have to do overall.
Luigi, I was talking to the Bundesbank yesterday, and the conversation was around how will things be influenced by recent experience, by the recent behaviour that we've seen from consumers and from central banks in 2020, in 2022. We've had periods of such volatility and high inflation. Do you think that maybe consumers and those who demand higher wages might react more quickly this time around because of that very recent experience?
That's a great point. Let me make 2 points here. One is we are not, it's not similar to 2022. 2022, what we had is an overeating labour market. Now it's probably tight, but not overeating. And inflation was already moving higher. So in a way, the conditions to start with are better. The ECB was neutral, and inflation is at 2%. It was actually going down.
Yeah.
That said, the key point you're making is very valid. There is muscle memory here. And I think, expectations are in some way adaptive. People expect what they've experienced recently. And so the fact that there was an inflation spike, I think increases the probability of this kind of propagation, second round effects. And that's why I think the ECB has a bias to prevent that, acting sooner rather than later, and doing less rather than more. I think that's kind of the key point.
And how quickly do you expect to see these things pass into the economy, on inflation and on growth? We spoke to a guest recently who talked about this coming in 4 waves of inflation. Some people talk about the inflation impulse coming early and is evident in some of the data already, in fact, and the growth hit coming later. How do you view the timing of this?
Yeah, so in terms of inflation, it's immediate, but that's headline inflation. So, I mean, a spike in energy prices can still be seen as a relative movement in prices and one-off. I think the key point, if that translates into higher wage demand, if it translates in higher core prices, and I think we'll see evidence of that over the next 3 to 6 months. And at that point, I think you need to act preventively to avoid that these become more entrenching and, kind of create a persistent shock rather than what it should be a one-off shock.
Should European governments protect European consumers from this energy shock this time round?
I think there is a bit less space than in 2022, and this is part of the story. So they will probably, but not to the same extent. In 2022, the fiscal expansion in response also to COVID was massive. I would not expect that at this stage, which in a way will contribute to lower demand and, help if you want the ECB, because the key problem is that to prevent inflation from becoming entrenched, you need to have slack in the economy. So you need to grow below your potential, and you need to distract some forms of demand.
Yes.
And so that will probably limit the extent of the ECB needs to intervene.
And Luigi, how much do you expect the response from the ECB to contrast with the response from the Fed? Because the market seems, in our attempts to move on, the market seems quite keen to get back to thinking about Kevin Walsh at the Fed and what he might or might not mean, and whether there'll be a downward, at least, inclination.
Yeah, they are in a different situation. I think the starting point, the ECB was a neutral with inflation at 2. The Fed has still a bias to cut rates. Well, formally still has. I think that will disappear with the next meeting, with a move to a more symmetric bias. But I think that's a key difference here. The Fed is still in restrictive territory. And I mentioned also sort of the reaction function. There is probably higher tolerance for higher inflation because the Fed has a dual mandate. So I think there is a difference here. And, the Fed, for us, the base case is no move, a move to symmetrical bias, and a key focus on the labor market. So if the labor market deteriorates for whatever reason, then I think the bias to cut will come back. If the labor market kind of accelerates and the unemployment rate goes down, I think there is scope for rate hikes. Base case, nothing, effectively, for a very prolonged period.
Luigi, thank you very much. Good to see you this morning. Luigi Speranza, Markets 360 Global Head and Chief Economist over at BNP Paribas. Coming up, we'll get back to the earnings stories then. Hermes sales disappoint as the Middle East war disrupts demand, and not just in the Middle East. We'll talk to Yelena Sokolova, Senior Equity Analyst at Morningstar, about all the earnings from the luxury sector. That conversation next. This is Bloomberg.
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Welcome back. This is the opening trade, Wednesday the 15th of April, and 30 minutes from the start of the cash trading session. And we have European equity markets quite divided, actually. If you look at what's going on in the Dutch market and the French market, there's negativity in both of those around ASML and around the luxury story. And that's really the earnings story. And it seems to be weighing on markets today, Guy. Aside from that, the markets do seem to be trying to move on, don't they, from the focus on the Middle East?
European equity markets made decent gains yesterday.
Yeah.
And while you see a little bit of red on the screen this morning, we're basically holding where we were. So we had a really decent recovery yesterday. It looks like we're going to hang on to that. European bonds a bit this morning. EGBs are down kind of circa 2 basis points pretty much across the board. Big move down yesterday in the UK gilt market. We'll see whether that sticks. Obviously, there's a growth/inflation concern that we're working through here in Europe, and it looks like Europe may deliver a different response to what we're going to see over in the United States. And I think that's going to be an interesting theme throughout the rest of this year as the two maybe diverge. But let's get back to some of the corporate news.
Yeah, absolutely. And let's start with the luxury sector. Hermes shares indicated lower this morning after the company reported sales numbers that expanded at a disappointing pace. The Birkin bag maker was hit by the disruption caused by the conflict in the Middle East, like many of its peers within the luxury industry. Yelena Sokolova, Senior Equity Analyst at Morningstar, covers the luxury sector and is with us this morning. Yelena, nice to speak to you. If we start with Hermes then, I mean, does this tell us something useful about the extent of the impact of the Middle East war and how it has been passed through into the luxury sector? Because they're talking here about the Middle East war taking 1.5 percentage points off the first quarter and talking about how tourism was disrupted in the UK, Italy, Switzerland, Thailand. This wasn't just what happens in the Middle East stays in the Middle East story from a luxury perspective.
Yeah, indeed. If you think about kind of the revenue contribution of this region, it's sort of 5 to 10%. But of course, these people also travel, so they impact the travel flows in different countries. And there is also incoming travel flows to these regions, especially in winter, that were obviously also impacted. It's also quite a profitable region for the industry, and it has been quite growing industry, one of sort of a few bright spots in this environment.
Yeah, and I mean, we when the war was in full swing, the market kind of saw this coming and was reducing exposure to some of the luxury goods companies, knowing that there would be exposure to travel and to the domestic consumption in the Middle East. And yet there's still room for these stocks to go lower on the back of these earnings results. Does that surprise you?
I think also what the markets have been looking at is the potential recovery for U.S. and China notably, and that is happening, but it is happening much slower than market participants were anticipating.
Why? Why is it happening more slowly?
I think from one perspective, Chinese demand is still subdued. There is still real estate price weakness. Sort of we were almost out of the woods in terms of real estate prices. Now they turned down again. American demand is significantly stronger. So it is on a recovery trajectory. But again, it's not maybe as buoyant as people were expecting because of all the geopolitical tensions, the markets becoming a little bit more jittery, so that could weigh on the sentiment as well.
Who's got the right product right now? Who's looking good?
I think from kind of the revenue growth perspective, Cucinelli reported results that were still quite solid and accelerating. So they are targeting very, very high net worth consumers. Richemont has been growing also nicely, but of course they will be impacted by the Middle East conflict because just their exposure is higher. So there have been a few bright spots, especially like Hermès recently, but even Hermès is feeling some of the pain, right?
Yes, I mean, you talk about historically the sector facing downturns that last 1 to 2 years. Is there a typical downturn for the luxury sector? Feels like we maybe have a downturn on top of a downturn here because we had pre-existing concerns about China, for example, and to some degree the US as well. And now we have the war in the Middle East. Is it possible to say anything general about how long these downturns last?
Yeah, of course, every situation is different, right? And I think with this situation specifically, of course, luxury is very correlated to the GDP growth. And if there is spillover effects from the Middle East conflict, let's say on the oil prices, inflation, interest rates, the economy, markets, etc., there would be repercussions as well for American consumers, for European consumers, etc., etc. So that could additionally put kind of a lag down on this market, on this recovery that was kind of a little bit fragile to begin with.
What role do luxury stocks play in my portfolio, if I want to put them in there? How do I think about them? I read in your notes this morning, they're kind of the antidote to the AI story. They're the kind of can't be disrupted. Is that how I think about the luxury trade? Is that going to hold up? Or is it, to your point about the relationship with GDP, is the cyclicality going to be something that that is going to be kind of problematic in that trade?
I mean, the cyclicality is part of the nature, but one can say that we are already probably closer to the bottom of the cycle than the top of the cycle, right? So that's typically for long-term investors is a better place to be because the valuations are depressed on top of depressed earnings. Right, so from long-term perspective, I think the sector is looking good. And as you mentioned again, it's not facing kind of the technological obsolescence that many people are concerned about right now in the markets. So from that perspective, I think it's a good hedge sort of for the risk of disruption from either technology or emerging competition, let's say from Chinese competitors.
Elena, I went down a rabbit hole today reading about the 25 sort of boutique manufacturing locations. I don't think manufacturing is quite the right word, is it? That Hermès has in France. Yes, crafting locations that they have. And I was taken by a quote from the executive chairman where he says, "I was joking with a journalist yesterday who asked me how AI will transform Hermès. I told him the strength of Hermès is that we missed almost all the technological revolutions." I mean, and that's to your point, isn't it? And to Guy's question, what kind of resilience can this sector then?
Success means having the right partner, right where it matters most. With 170 years of expertise, we are unlocking opportunities and driving progress across the globe. And now we're in the heart of Egypt, your gateway to Africa and the Middle East.
In a world of seismic change, will your business shape the future or be shaped by it? How will we capture the imagination of tomorrow's consumers? Overcome operational constraints to focus on future growth? And unlock economic and social prosperity through environmental responsibility? With EY Parthenon and EY's full spectrum of services, we're reimagining the enterprise to shape the future with confidence.
Demonstrate at a time when we see a lot of volatility around the AI story, but also a lot of excitement.
Yes, I mean, on the excitement front, I think these companies cater for wealthy people and especially for new wealth, right? So if wealth is being created by AI, they could, of course, benefit because those people would buy the products. But on the other hand side, like something that I'm concerned about longer term is potential displacement of high-wage jobs. like we already see it on the entry level in sectors like tech or finance. These are not like low-paid sectors, right? So if that continues going forward, that kind of reduces the pipeline of new consumers for luxury.
Yes, if the wealth is more concentrated as a result of AI, I don't know how many handbags one person needs. That's a question we're not going to answer around this desk, are we?
Let's park that one. Many more than you think. I've just checked the weather in Florence. A bit grey today. Tomorrow looks a little more sunny. You're going there. You're going to the Kering Investor Day. What does Luca Di Maio need to deliver? What does he stick with them now? How does he fix Gucci? What needs to happen here?
Yeah, I think it's a difficult one because, of course, with designer bets, you kind of you take a bet. It's not, you cannot take small bets and see if they're playing out or not. You take a big one, and it delivers results probably in 1.5 years after the appointment, right? So they still have runway, I would say, to see if it works or not, because not a lot of Demna's products are in the stores. But I would like to hear, what kind of plan B do they have? Like, what do they do exactly if that doesn't work? Because I get the story that they have to improve also the operational performance of the group, reduce debt, etc. But like, the key to the thesis is still reviving the desire around Gucci brand. So there would be questions around that and what their game plan is.
Yelena, thank you very much. Enjoy the trip. Yelena Sokolova, Senior Equity Analyst at Morningstar. And we will be speaking to the CEO of Kering. Catch our interview with Luca Di Maio. That's at 3:30 p.m. London time. That's coming up tomorrow, isn't it? If my eyes read that right. Yeah, Thursday.
What is plan B? There you go. That's the question that we need to be asking. Recession risk, very much on the agenda, though, today.
We have a classic energy price shock unfolding across the world as we speak. That, of course, will create demand destruction. It will cause economies across the world to decelerate. The risk of a recession has increased. And central banks are making some really difficult decisions. This really is a very, very treacherous moment for the world economy.
It's great for trading, though, isn't it? Ken Griffin, Citadel CEO, speaking at the Semaphore World Economy Summit taking place yesterday. This is Bloomberg. Seventy minutes to the start of European equity trading. Euro Stoxx 50 futures are down. They're a little soft. I think we could probably blame ASML. That's a big chunk of that index. And it's looking a little softer going into the open this morning, Anna.
Yeah, absolutely. That and the luxury sector, those two areas of focus for us. As the market tries to think past what has been happening in the Middle East, let's get an update on the Middle East situation, though, because we are still looking out for headlines on that front. Bloomberg has learned that the US and Iran are looking to arrange a second round of peace talks in the coming days, with one proposal to return to Pakistan. Meanwhile, the US is pressing ahead with a naval blockade of Hormuz to curb Iran's oil exports. We've also had an update from President Trump in a Fox Business interview, reiterating that he sees the war as nearing its end.
I think it's close to over, yeah. I mean, I view it as very close to over. You know what? If I pulled up stakes right now, it would take them 20 years to rebuild that country. And we're not finished. We'll see what happens. I think they want to make a deal very badly.
President Trump then suggesting that the Iranians want to make a deal. Let's get an update then from the Middle East. Our Bloomberg Horizons anchor, Jumana Basechi, is with us, of course, from Dubai. So another day where we're focused on the possibility, Jumana, of renewed talks, possibly coming in the next days.
That's right, and even President Trump has said it himself. He's spoken to multiple journalists over the course of the last 24 hours, suggesting that the next 2 days could be pivotal in terms of getting those second round of negotiations across the line. He even said the next 2 days will be amazing to an ABC journalist. And also, he sat down with Fox Business as well. You were just playing a little bit of the interview there, suggesting that the war may be close to the finish line. Now, of course, this is just President Trump himself. And I will also remind everybody that the Iranian side haven't actually confirmed anything. They haven't said anything. There are no new updates since the Iranian President Pezeshkian yesterday said that they were inclined to continue with negotiations so long as it's done within, quote unquote, the international framework of law. But we did report yesterday, these are our own colleagues at Bloomberg, that Iranian officials are considering halting shipments through the Strait of Hormuz over the next couple of days. They don't want to provoke or test the U.S. naval blockade that's in place in anticipation potentially of those second round of talks. But again, no confirmation from the Iranian side that they are going ahead, but plenty of discussion about where they could be held. Islamabad seems to be once again at the forefront of potential locations, but other locations, as we understand, are also throwing their name into the mix. Switzerland saying that they're happy to host as well. And then it just comes back to the essential issues, the principles of prior rounds of negotiations between U.S. and Iran. Obviously, not just about the Strait of Hormuz and the unconditional full reopening of the Strait of Hormuz, but that all-important nuclear file, and whether really you can realistically expect the two sides to come together out of one more meeting over, the status of enrichment, that highly enriched stockpile that they're sitting on. In prior cases, i.e. in JCPOA, the former nuclear deal, it took years to get these types of agreements across the line. So there's a lot at stake still. I expect we'll hear more in the next 24 hours.
Jemana, great stuff. Thank you very much indeed. Jemana Basetchi in Dubai. From a market point of view, we've moved on. We're done. We've moved on. We can get back to trading the AI theme and everything else that we were trading beforehand. Neil Campling sent me a nice note this morning from our markets desk saying we're in kind of inverse panic. We've gone from oversold to overbought very quickly. There's been a short squeeze. The CTAs are in the market and buying big time. But are we nearing the limits of that, and where do we go from here if we are reaching the limits of that? Let's try and find out. Markets, the MLive team have got a lot of thoughts on all of this, so let's figure that all out in 3 minutes. Its editor is Mark Cudmore, and he joins us now. Mark, what do you make of it all?
Equity indices built on opinions? That's the old way. The new way is Bloomberg Equity Indices, built using transparent, rules-based methodologies that are more responsive to changes in the markets, powered by 450 billion daily data points, and backed by research from hundreds of global experts, delivering benchmarks driven by the markets, not opinions. Bloomberg Equity Indices. Get evolved benchmarks for today's equity markets.
Yeah, I'm going to disappoint you, Guy. I think you summed it up absolutely perfectly there. First of all, that investors are trading as if the war is effectively over. And I think that is the correct approach from a macro investor point of view. Obviously, war is terrible. There's terrible things that happen in the region. It could continue to be really, really tough for the region for a long period of time. But, I think from an investment point of view, and I'm probably talking about markets here, not talking about the humanitarian side, that the rest of the world ultimately doesn't care if it's not going to kind of really blow up or escalate again. They just want to see that there's progress being made. They don't care the intricacies of what's negotiating a deal. They just want to know this is not going to get worse and we're on a path to recovery. So that's why we're investing in trading positive. Now, I think the second bit you kind of raised there is, we're trading as if the war is effectively over, but does that mean we can trade as if we can ignore it? I think what's still in debate is, how bad are those lingering impacts, stagflationary impulse going to be? That's still really up for debate. Markets are kind of trading that, hey, actually, it turns out that the Strait of Hormuz is, closed for 2 months, as it might end up being by the time, we get some real traffic going through here. Maybe the world is fine. Now, up until 2 months ago, we were told that the Strait of Hormuz was closed for more than 5 days or, maybe even 2 weeks. It was going to be catastrophic for the world economy. Now, that clearly is not the case, but is the truth somewhere in the middle, or is the truth really that actually the Strait of Hormuz doesn't matter half as much as hyped? I'm in the camp that it's somewhere in the middle. I'm in the camp that, the supply chain disruptions that we're going to see are going to have a lingering impact for months. Now, the next question is, if you believe that, is where's that impact going to fall? And I think it might fall quite selectively. It's not going to hold back global indexes, but it's going to hurt certain sectors and certain countries worse. And I think that's the bit that people are really trying to analyze at the moment.
Yeah, I wonder then, is it right to be saying that the shortages have not, shortages have just not shown up, or that shortages haven't shown up yet, Mark? And I wonder if we start to get further signs of, on that particular front, of shortages still yet to come, that could be something that reduces risk appetite, perhaps.
Yeah, very much. I think that is that dynamic, and we're having that debate very actively. And again, I think the answer is, like all these situations, it's probably a little bit more nuanced in terms of that there are certain sectors where the shortages are real but have not shown up dramatically yet, and they'll still impact. But in a bigger, broader sense, I think that maybe the impact won't be as large. And that's when I go back to I think that we're going to be trading the impacts of the supply chain disruption for months. But I don't think it's going to be the dominant theme. Now, will it even be a very major theme or just a minor subtext in certain sectors? That's the bit we're trying to work out. There's a chance that we might already be moving to a world by next week where really we're just back to trading the AI theme and what you think of the kind of the winners and losers from that and the kind of steps. And I have to say, I'm increasingly going towards that camp, but I'll stay open-minded for now while we continue to do more analysis.
Yeah, and the earnings stories, of course, will keep on coming, Mark, which will help with that pivot. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get up-to-date analysis, insight, Mark and the team available to you. MLIV Go is the function on the Bloomberg terminal. Now let's get your stocks to watch. Chloe Melly has a rundown. And thinking of AI, let's start with the tech sector, Chloe.
Good morning, Anna. Indeed, we are starting with Europe's most valuable company this morning, ASML, which raised its forecast for full-year sales. But at the same time, the forecast for the second quarter sales actually came in a little lighter than expected. So we'll see what investors actually decide to focus on this morning. But as you said, AI is obviously a big theme, and the CEO said that the demand there was really solidifying, with customers accelerating those investments in AI. And of course, we've seen ASML shares do really, really well with that big jump starting about 5 years ago, and now hitting those record highs. But we'll see if today's results were actually enough to sustain that performance this morning. Moving on to luxury, and we had two big names reporting. So Kering last night reporting with Gucci sales falling more than expected, and then also this morning Hermes came in with results, and there the sales also disappointed, which is actually quite rare for Hermes, which tends to beat estimates. And so we'll see how the market reacts to that this morning. Both of those companies were really hit by the war in the Middle East, which has really hurt demand and growth in those Middle Eastern hubs and elsewhere for those companies. LVMH said the same thing yesterday and got hit quite bad in terms of the shares. So we'll see if that weakness extends today for Kering and Hermes. And finally, Spanish banks are also in focus. BBVA was downgraded and CaixaBank upgraded by Barclays, and the analysts have said that in an environment of higher rates, of lower growth, of higher inflation that is created by the Middle East, the investors' focus is going to be on kind of earnings visibility, on simplicity, and less so on that reliance on the benign macro backdrop, which is what the analysts have said. And therefore, they now prefer those more sort of defensive names like CaixaBank. So we'll see how both of those lenders today react to those rating changes.
Okay, Chloe, thank you. Chloe Melly, we'll be back later with a look at how those stocks are performing. And Guy, it's interesting that the luxury sector down year to date and set to drop further on the earnings story. ASML very much stronger year to date, but still we're expecting a bit of weakness. The earnings story negative, it would seem, at least in the moment.
ASML over the last few days has been absolutely surging. You've seen this semiconductor story developing on both all around the world. You've seen it in the United States, you've seen it in Asia, to a certain extent here in Europe. ASML has been the biggest beneficiary of that. So the stock has been rocketing higher. So any kind of at the margin miss, and we're talking about Q2 here on the full year outlook, the market's going to go, yeah, well, it's just a good opportunity to maybe take a few chips off the table, maybe.
Yeah, it seems so, because there were positives in there. There very much were positives around the full year guidance and the Q2 guidance, a bit of a negative distraction maybe from that. But we'll keep an eye on ASML, we'll keep an eye on the luxury sector. Overall, though, so we've been telling this story about how markets want to move on from war in the Middle East, and that does seem to be, certainly that was the case yesterday. European stocks doing really well, the Asia session doing well today, US stocks did well yesterday. US futures are flat now, looking for a new direction, it would seem. And you wonder where the banking story, is there going to be room for that to cut through more meaningfully?
So you've had a short squeeze, which has been substantial. You've had the CTAs coming back into the market. They were massively underpositioned, and now they've had to basically correct that, and the buying has been really substantial. Again, if you look at the volume numbers and you look at kind of what is happening here, the volume is actually reasonably muted, which suggests that there's been key buyers that have been in this market that have been pushing it to the upside. Are we reaching the limits of the CTA buying? How much more is there still to come throughout the rest of this week? Is the short squeeze now largely done? Have we unwound that position? Have we gone from a sort of under-owned to overbought quite quickly.
Yes, and are we still vulnerable to headlines out of the Middle East? Because we might be doing our best to move on and trying very hard to do that, but we'll see whether that's sustained if we get further news flow. And we're still waiting for confirmation of when these follow-up ceasefire talks are going to be. Could they be in the next couple of days? We'll wait for confirmation there. Coming up on the opening trade, we will bring you the start of the European trading day. Futures are pretty mixed this morning. This is Bloomberg.
Wednesday morning, good morning. How are you doing? A couple of minutes to go until the start of cash equity trading here in Europe. Let's give you a little bit of context. Talk about yesterday. Yesterday, really solid session, particularly over in the United States. The S&P, the Nasdaq, both rallying really strongly. The Dow, a little bit of a laggard. The energy story there, maybe a little bit of a break being put on that average. So this was the session yesterday. Europe priced in most of the gains. The US ticked up a little bit, but basically the back end half of the session in the States yesterday was certainly a little tighter. So we've got a little bit to price in on the upside. The problem with this morning, and let's show you some European futures, is that basically what we've got is a few earnings, a few heavyweight earnings that may actually just take enough out of the European markets this morning to kind of compensate for that upside that we got out of the States yesterday. So Eurostoxx 50 futures are down. ASML is a big chunk of that. CAC futures are down. The luxury sector is a big chunk of that. The Amsterdam market is down. ASML is a big chunk of that. So basically you're seeing the earnings story out, sort of balancing out maybe a little bit of the upside we had to price in out of the United States. US futures are also fairly flat, but at the moment what we have is a market that's going to drift a little bit softer after a strong day yesterday here in Europe, Anna.
Yeah, absolutely. Let's get a bit more on some of those stocks and sectors in focus then. The luxury space, certainly. Kering could be weaker. We got a Gucci comparable sales drop of 8%. That was worse than the 4% anticipated. Watching Hermes in that sector as well. Really interesting detail on the Middle East and the extent to which that has taken a chunk out of tourism sales. ASML also very much in focus, raising its full year sales guidance, but will the market focus a little on the Q2 guidance? Insurers also in focus. Aegon is selling its UK arm to Standard Life for £2 billion. Helvetia, also some news there. Others within that sector as well. Guy.
Okay. Here we go. Let's show you some markets. Let's give you an idea of what is going on. We think we're going to be a little bit softer. The FTSE may do a little bit better, but certainly some of the continental markets, like the AEX and the CAC, could be under a little bit of pressure. So the FTSE's out of the gate fairly flat. We are up by 0.1%. I expect the CAC maybe to open a little bit softer. We put the AEX on the board this morning just to get an ASML early read. The expectation there is it's going to go down, but just be aware of the context. Get the one-year board up and just look at the rally that we've seen, particularly in that stock over the last few weeks, months, but particularly over the last few days as well. So at the moment, we're not getting clear indications. Clearly, nothing is happening in Germany. It is out early. The AEX is flat. We're expecting it to go a little bit softer. The IBEX is doing absolutely nothing. So basically, what we are doing this morning is holding the gains of yesterday. Where does the next catalyst come from? We've had this huge move from one side of the boat to the other side of the boat, from risk off to risk on. Is that now satisfied? Have the CTAs bought enough? Have the shorts been squeezed enough? Is that move over? And if so, what comes next, Anna, I think is going to be critical. And will that be the earnings season?
Yes, and we're not getting a huge amount of direction as the market asks itself all those important questions. So Stock 600, as you say, really very flat this morning, not seeing a move there. The CAC 40 is not yet open, and I see that we're halted on Hermes. So we're certainly keeping an eye on that one. Kering has opened and it's down by 5.6%. So there's a negative take on the Kering numbers. That's not a surprise given what the ADRs did in the States yesterday. Looking for the move in Hermes at the start of trade then. No surprise that even without the Hermes move, consumer products and services, which includes the luxury sector, is the worst performing across Europe. We see some of the Swiss names going lower on the back of that. So even though we've had LVMH already, it seems that there's further downside for that sector. We are seeing about a third of sectors in negative territory, 2/3 to the upside. There's still room for autos and parts to gain and be the best performer. There's no earnings there, and they maybe are part of that other theme, which is about markets trying to move on from being completely obsessed with what's going on in the Middle East. Oil prices are incredibly stable this morning, Guy.
Incredible, yeah. ASML is also incredibly stable. Can I just point that one out?
Yes.
ASML is not doing anything at the moment.
Yeah.
It is in and out of positive and negative territory. We were expecting a much more negative read on that. This is a stock that's rallied really quite significantly. Is the market ignoring the Q2 kind of outlook shortfall and focusing therefore maybe on the full year story and seeing that as a better sort of metric going forward. In terms of the kind of the bigger, you're seeing a move into pharma this morning, which I think is interesting. Bit of safety maybe coming through there. Luxury, as you say, like Richemont, LVMH, Kering, all under pressure this morning.
I thought it was interesting in the ASML numbers that they did say that they thought that they could handle any changes in the restrictions on the business they can do in China within the guidance that they have now put out. So I don't know whether that gives the market any comfort. But yeah, ASML flat to negative right now, still waiting on Hermes, and we will get an opening price on that one as soon as it is no longer halted. Let us get some analysis now of these markets. Louise Dudley, Global Equities Portfolio Manager over at Federated Hermes, is with us. And Louise, I'll wait for Hermes to open up so that we can talk about the earnings stories. So let's focus on the wider markets and what's happening here. The attempts to move on from thinking about only what's going on in the Middle East from a markets perspective. European stocks haven't caught up with where they were pre-war, but other regions seem to be doing a better job of that. Are we right to try and look through what is still a blockade in the Strait of Hormuz?
I think we've been a bit surprised with the US move that things have gone so risk-on so rapidly. It does seem a bit extreme, particularly ahead of earnings. I think we were kind of going into earnings thinking, valuations are off, therefore the potential for upside where companies do deliver and maybe do confirm their kind of positive forward guidance. Now, particularly in the US, where things have moved up again, now we're saying, okay, well, could they deliver into that valuations where things were before, whereas things actually are a bit weaker generally, and particularly in terms of kind of interest rates. That's a kind of a binary indicator that has changed. That's something that's going to impact a lot of companies. That said, in Europe, what we have seen from some of the industrials that have already reported, they've actually reported quite well, and in particular, some strength out of China. So maybe looking towards ASML and their China move, maybe it's not as bad as we thought, and actually China actually has been getting on, and actually from a kind of a conflict perspective, China, relative to some of the other economies, particularly in Europe, is able to overcome some of those kind of near-term price impacts on energy.
So that sort of weaves together the impact of the war and what we're starting to hear from corporates. So let's think about that, because we do have an opening price on Hermes now, down by 11%, nearly 12% in fact, this morning. So real negativity around that company, and this is a sector that's already been beaten up. We kind of saw this coming. We knew that there would be an impact of the war on the luxury sector, and yet it's still under pressure. What do we read into that earnings story?
Yeah, I think it's a case that, people will react to the negative numbers. And I think, there's always some optimism around LVMH in terms of Asia that offset. Certainly for the larger businesses that are more diversified globally, generally they are looking to other regions to offset if there is particular weakness from the Middle East. Obviously, for the luxury segment, Middle East is so significant then it's obviously come through pretty negatively and expected to maybe persist as well, I guess.
That is the biggest downside move in Hermes since 2010.
That is a long time ago.
So we haven't seen a move like this in this particular stock, which has been the one with the halo in the luxury sector. It hasn't had the volatility. It's had the long waiting list. 2010, October 2010.
And when we talked about LVMH earlier this week, we talked to Andrea Felsted, and she was already seeing chinks in the armour of Hermes, talking about how this had been a business that you could almost not compete with because the waiting list was so long. But now she was sensing that maybe there was some more competition coming through. I mean, maybe that early to tell that story, but maybe that's in the back of the market's mind this morning.
There's a lot of unwinding potential, therefore, you could argue around that stock. Yelena was talking about this being the anti-AI trade, so that gives me the segue to talk about the AI trade. Can I just go back? Can I ignore the war and just go back to trading AI? Because that's what the market seems to be doing right now. We're back to the semiconductor indexes are absolutely rocketing higher in the United States. Everybody just wants to get back to that narrative.
Yeah, I think certainly it's an area of the market that's showing some of the best, most kind of consistent growth. And that is a story that is continuing. And obviously a lot of that is US-centric. So to a certain extent, it is somewhat isolated from the crisis.
And Asia-centric as well. Like you look at what's happening in Korea, Taiwan, etc. Those stocks have been, again, rocketing. Europe feels like it's being left out right now.
Yeah, definitely. And I think, we're kind of seeing, Korea, Taiwan, those numbers have been quite solid and people are feeling more optimistic again. I think that's also part of the kind of risk on, particularly for Korea. type trade. And, you know, I think our expectation actually, so we do have an overweight in terms of Korea, and we do expect that that is a region that is going to continue to do well off the back of, you know, the constrained supply that we have at the moment within that kind of AI trade.
Let's think about the AI opportunities a little more then. And infrastructure is a very associated opportunity, and you talk about that in your notes, Louise, as being an area of focus. Data centers, grids, materials, the wider AI supply chain. Where in that supply chain do you find most exciting at this point?
To be honest, we are quite diversified. I think that's one of the things that's quite important, is that we don't really know who are going to be the key winners in terms of individual models and things like that. And so at the moment, it is a case of like build for whoever, to a certain extent. You know, there's certainly obviously lots of money yet to be spent. So yeah, we would kind of err on the side of diversification within that bucket. It's also part of the broadening trend as well. At the point that obviously you've got the concentration at the top end of the market at the start of the year, everyone wants to talk about broadening. I think that is coming back into focus, and certainly that's where we're positioned as well.
How do you feel about rate hikes?
So at the moment, obviously, things have maybe come down to flat, as it were. And I think, you know,
the ECB's priced for hikes, like potentially, like maybe in June, but not April. But do I avoid Europe if the ECB hikes rates? Do I buy the US if the Fed doesn't?
I think that's an underlying story in the sense that there's obviously differentials there, but I think because there's difference in terms of growth rates and valuations as well, I think the interest rate story is different. I think the dynamics within the US in terms of the change of the chair and things like that, I think is going to play into a lot more of the concern around what's going to happen there, and whether things get pressured, and that will upset the market if that does happen. I think in Europe, things feel a bit more stable, and there'll be more rational, you know, outlook around what will need to happen, and therefore be less of a surprise, perhaps.
Yeah, I wonder how the AI, spending on the AI and the cybersecurity spaces are linked, because at one point it seemed as if companies were maybe prioritising AI R&D development spend and not maybe cyber. But then since we've had recent releases and a lot of warnings about cyber risks created by the power of some of these AI tools, how much do we need to focus on cybersecurity then, Louise? Is that a sector that we could see a step change in demand for?
Yeah, certainly that's what we think, and that's where we're seeing actually opportunities, that those are areas that are potentially vulnerable, and that is a kind of a necessary spend for businesses at the point that companies can slow down some of their AI innovation potentially if they need to. Cyber is not an area that they can do that, and they have ongoing contracts, and there'll be ongoing kind of price increases that come with that. There's also a huge backlog in terms of demand for people wanting those services, and now with the geopolitical space as it is, there is even more risk, and I think different businesses being targeted and being aware of how important that is going to continue to persist as a trend.
Louise, nice to see you. Thank you very much for coming to see us. Louise Dudley, Global Equities Portfolio Manager, joining us from Federated Hermes. Let's take a look at what the market's doing this morning. What is LVMH doing on the back of Hermes? What is ASML doing? ASML is now up by 0.5%. Choppy start. It's been down a bit, been up a bit, but we are now up. We're looking through maybe Q2. You are seeing the luxury space under a little bit of pressure. So let's get some more detail on what is happening with those luxury names. Chloe's here with just that.
Good morning, Guy. Indeed, as you just mentioned, this luxury sector is red across the board this morning. We had some disappointing results from both Hermes and Kering that flagged really the impact of the war in the Middle East on those sales. And so this is really dragging down, those disappointing results, dragging down the rest of that luxury sector this morning, with LVMH and Christian Dior also in the red. And it's really dimming the hopes of a luxury rebound anytime soon. And now that recovery definitely looks a little bit further away. Moving on to Stellantis, which is up. It's in the green this morning after reporting shipments of significant rise in shipments in the first quarter, and that was led in particular by a good performance in North America. So that'll be really taken as a sign that the turnaround, the ongoing turnaround for Stellantis is working, and the refocus on the US market is definitely taking shape. And so we are up about 3.5% for Stellantis this morning. It's also a good day today for the house builder Barrett Redrow. It said that we could expect some construction cost inflation inflation from those higher energy costs to come in a little bit later, around 2027, but that the impact will actually be quite limited in 2026. So that is seen as quite reassuring. It maintained its guidance, and therefore we're up about 2.5%. And finally, Extron, which is a supplier of chip-making equipment, is also up this morning after raising its sales forecast. Quite interesting in the context of its much bigger peer, ASML, also raising its full-year sales forecast, but not getting as strong of a reaction from the market. But for Extron, we are up more than 10% this morning.
Chloe, thank you. Chloe Melly, with the important detail that I missed around the auto sector. So I was thinking there was no news, and there was news. And that is part of the reason why we're seeing strength coming through then, as Chloe was saying, in the Stellantis story, and that may be lifting the rest of the market. So Stellantis up by more than 3%. But we are still trading these two themes, aren't we? Trying to move on from the war, but also the earnings story front and centre.
Yeah, and energy is reasonably mixed this morning. Brent is actually just a little tick higher, but not by much. We're kind of flat there, but we're still up by circa 40%. Up by nearly 55% year to date. So kind of that story's there. Metals are up a little bit. So that inflation story is not going away.
Yeah.
But the market just doesn't want to think about it.
It's a weird day when you've got healthcare and autos as the best performing sectors. That's quite the pair. Coming up on the programme, we'll get more details on ASML, which faces a major blow in China as new US legislation threatens to block tool sales and servicing existing equipment in its top market. We'll get the context there. This is Bloomberg. Welcome back to the opening trade. 17 minutes into a European earnings session that is trying hard to move past a focus on war in the Middle East, but finding the earnings story is standing somewhat in its way of going higher. So European equity markets are pretty flat this morning. US equity market futures are flat to negative right now. This is a look then at a fairly flat market overall. The Dutch market, though, is not flat. The Dutch market is negative, and we have a negative picture for ASML and the shares there.
Do we? It's up.
Oh, that happened quick.
Well, it was negative, then it went up by around 0.5%. Now we're back to being up around, let's call it 0.1%.
Okay, there you go. It's on the screen now.
Flat. Let's call it flat. We are neither up nor down in terms of what we're seeing with ASML this morning. It's raised its full-year sales forecast. That's, of course, on surging AI spending. Q2, maybe a more cautious approach. Charlotte Hughes-Morgan joins us from Amsterdam. What's the market can't make up its mind on what the takeaway is here, but we're kind of flat after a decent rally over the last few days. So what is the takeaway from these numbers?
It's a good question. Yeah, we're seeing quite a muted response from the share price in Amsterdam this morning, which is quite extraordinary, I think, when you think actually that, they upped their full year net sales guidance. They now expect 36 billion euros to 40 billion euros. I think it really speaks to how much optimism was already baked in. I mean, ASML share price has already risen around 40% since the beginning of this year. We've had customers like TSMC, SK Hynix, Samsung all commit to these huge capex spending pledges. They're pouring money into this AI infrastructure. There's so much money going into data centers. We've had all these commitments already. So perhaps there is an element of ASML shares have already risen so much. So actually, even raising their full-year guidance has not had as much of an impact as we'd expect. I mean, the message from ASML is very clear. They're saying AI demand for these AI chips is outstripping supply. They say we are working with customers to ramp up our own assembly capacity, but really, this is the story about the AI boom. It continues unabated.
Okay, and what about the China story as part of this then, Charlotte? Good morning, because we've heard from the company a little bit about that, but not a huge amount. And I think that the Dutch Prime Minister has a meeting planned with the US government to talk about export curbs, US export curbs that are affecting the ASML business.
Yeah, I mean, this is really interesting for ASML. And as you said, there's not a huge amount from management in the statement alongside results. And no doubt analysts will be asking questions later on in the day. What they do say is that this updated full-year guidance, the 36 billion to 40 billion euros, kind of accounts for any potential outcomes of these, potential further export controls. So obviously, the US legislation is in its early stages. There's a lot of conversations to happen before we see implementation. I mean, something to note from this set of results is that actually net system sales to China were 19% of ASML's total net system sales. That's down from 36% in the last quarter. So actually, we're seeing the number of systems sold to the country falling this quarter, and I think it's also important to reiterate that actually ASML is already under quite tight export restrictions to China. They've never been able to sell their most advanced lithography machines to the country, and so further tightening these controls will certainly have an impact on revenue for their older generation of machines. It's definitely something that is important and that ASML will be working on. And as you said, Dutch Prime Minister went to the US and said he'd spoken to the Trump administration about these export controls this week. So it's definitely something the market is watching, but we did see a drop-off in those in the number of systems ASML sold to China this quarter.
What else is management saying? It all seems to be on track at the moment. China's a bit of a kind of sort of difficult one to read. They're not giving us some of the key KPIs that we used to get. So what are we learning from management this morning? What are they telling us other than the kind of the big picture story?
I think something that is important, and I expect we'll see this later, is that can supply meet demand? I expect we'll see analysts digging into this later. ASML saying we expect to be able to deliver enough capacity in 2026 and next year. But actually, I think with the demand kind of at the rate that it's going, I think there'll be some questions, that management will likely expand on. How are they going to ramp up capacity in time? I mean, ASML machines take years to make. They're extremely expensive. How are they going to match that demand story? And management have said, we're working with clients. We're comfortable. We won't be a bottleneck. But I think that will be something the market will watch. And obviously, we'll also be looking out for, their comments on macro events as well. There was no mention of Iran and of the shipping constraints. So that'll be something we'll dig into later. But I think, as I said, the main message here is that AI infrastructure story is kind of still booming. It's still going through the roof, and ASML is reaping the rewards of that.
Yeah, a lot of the commentary was pretty positive, wasn't it, from the management around that bigger picture. Charlotte, thank you. Bloomberg's Charlotte Hughes-Morgan joining us there from Amsterdam. Now, Bloomberg has learned that PIMCO bought $400 million of bonds issued by a Blue Owl Capital private credit fund. The purchase is a vote of confidence, then, perhaps, for the industry that's recently been battered by record redemption requests and deepening concerns over valuations, liquidity and transparency. For more, let's bring in Sinead Cruz, senior editor of Bloomberg's Going Private newsletter. She's had a busy time of it recently. Sinead, good to speak to you. So what's been happening in private credit then? Should we focus on this Blue Owl story? Is that the right way to view this, a vote of confidence?
Well, yeah, let's look at it as a vote of confidence. These are two, we've seen two examples of private credit funds that have been under severe strain in recent months, getting some love out of the public debt market. So we saw, obviously, Blue Owl selling this chunk of bonds to PIMCO, demonstrating continued sustained institutional appetite in the asset class. We still have a lot of retail money trapped behind the gates. That could still lead to some problems for some of these credit funds. And but maybe, just maybe, we might be seeing a change in sentiment towards these vehicles.
Some people are pretty positive still about what is happening. I was listening to all of the Wall Street CEOs talking about it yesterday. Jamie Dimon's comments really stood out. Let's take a listen to what he had to say.
There will be a credit cycle one day, and I think when there's a credit cycle, losses will be worse than people expect relative to the scenario. I don't think it's systemic. It almost can't be systemic at that size relative to anything else. But, when recessions happen and values go down and people refi at higher rates, there'll be stress and strain in the system.
There will be a credit cycle at some point. But for now, I have to say, Jamie sounds quite positive. He's not worried.
Yeah, most of Wall Street, in fact, are pretty sanguine about their private credit exposures. They do represent, let's remember, tiny percentages of their overall lending.
Yep.
Wells Fargo yesterday said that they had just over $36 billion out of a $210 billion portfolio of lending to non-bank financials. So private credit is tiny. However, it is still causing some concern among some major watchdogs and authorities out there. Earlier this week, we saw Andrew Bailey, chair of the Financial Stability Board, and obviously Bank of England governor, saying that he's worried still about how the opacity in this marketplace could infect and inflame sentiment. And if that happens, all we need is another macro shock to knock the confidence and again trigger a doom loop of concern about these assets.
Just briefly then, Sinead, I mean, is more transparency what we need? I mean, there's private in the title for a reason.
Yeah. Look, disclosures, transparency will always help to calm and reassure investors. Just whether or not we'll get that and at what kind of standard is still to be seen.
Okay, Sinead, thank you very much. Sinead Cruz, editor of Bloomberg's Going Private newsletter, which is published twice a week. You can head to bloomberg.com/newsletters to subscribe. There you go, information on your screen about that. I mean, maybe we get to go back to talking about private credit now, and we get to talk about AI and all the other things we talked about in January and February. I'm finding it difficult to remember what we talked about in January and February.
I think you just nailed it.
Those things.
AI and private credit.
Gold, a lot.
There was a lot of gold. Gold seems to have definitely faded off the agenda, but AI seems to be back.
And the dollar has rethought recent gains, so that's in keeping with a move back to January, February, isn't it? 8:26 here in London. When we come back, we will focus back in on the energy markets. Is it too early to sound the all clear? We still have closure of the Strait of Hormuz. Well, almost. I mean, some vessels are now getting through, but blockades on both sides still in place. We'll be joined by Emily Ashford, head of energy research at Standard Chartered Bank, to discuss the latest on the Middle East. That's next. This is Bloomberg. Welcome back, everybody. This is the opening trade, the middle of the week, and this is where we are, 30 minutes into today's session. We are entirely flat on the Stock 600, but that really does hide some really interesting developments. There's a couple of themes that we're trading around here. One is trying to move on from what's been a huge focus on the Middle East, rightly, over the last 6 weeks or so. The other is factoring in some earnings stories, and you see both of these demonstrated here on this board. The FTSE and the DAX trying their best to move on. Not a huge amount of earnings stories coming out of those markets today. The CAC 40, though, weighed down by certainly what we're hearing out of the luxury sector, and that does link back to Iran. But the CAC 40 down by 0.6%. Hermes in particular, one of the big fallers there. Guy, that's the overall picture on markets. Not really telling the interesting stories beneath, but there are some.
There are. This is a market it's fairly balanced this morning. So 319 up, 258 sort of down. Reasonably balanced, let's call it that. But what is interesting once again is the volume picture. Very focused volume in terms of the buying over the last few days, which tells you a lot about what is maybe happening here in terms of the repositioning this market is doing and who is doing it. Is it the CTAs? Is it these short squeeze that we've been talking about? Is that what has been driving this repositioning? Is fundamental money actually convinced that this rally has legs? And I question that, judging by some of the notes that I'm reading at the moment. Let's talk about what we're seeing in terms of some of the leaders and the laggards. What we are getting this morning is a positive picture out of Rio. The metals market still looks fairly solid at the moment. Novo, the farmers are really on the front foot this morning, which again I think is really interesting in terms of where markets are repositioning to. Extron out with numbers, and that stock is definitely being rewarded very strongly, up by 13.1%. The downside, Anna's already mentioned it, the luxury space is under significant pressure. You can see it from Burberry down 3% to Kering, which is down by 8.5%, to Hermes, which is down by 12%. You haven't seen a move like this for nearly 20 years in Hermes. You haven't seen this for such a long time. Hermes feels like maybe the incredible run that it's had is beginning to run out of steam, Anna.
Guy, let's get up to date with some of the other stories that we are covering then this morning. Vice President J.D. Vance has pushed back on the Pope's criticism of the war in Iran. Last week, Pope Leo said anyone who is a disciple of Christ, the Prince of Peace, is never on the side of those who once wielded the sword and today drop bombs. Vance, who himself is a Catholic, said that the pontiff should be, quote, careful with his words. Bloomberg understands Anthropic has received several offers from investors for a new funding round that could value it at more than $800 billion or higher. The offers would more than double the $350 billion pre-money valuation that Anthropic had attached to its $30 billion fundraising in February. Bloomberg previously reported the company has discussed a public listing as soon as October. And US Treasury Secretary Scott Bessent says President Trump's tariffs may be restored by July to the levels in place before the Supreme Court struck down many of his levies. Speaking at a Wall Street Journal event in Washington, Bessent said the administration is seeking to implement or conduct Section 301 investigations, including probes into other nations' industrial overcapacity and forced labor practice. These, he indicated, could give the U.S. cause to implement new tariffs.
Okay. Let's get back and talk about what is happening in reaction to all of this and oil prices. Let's take a look at what is happening here. So oil prices currently are up a little bit. You've got the US contract up a little bit more. Brent is on the move this morning. But relative to recent moves, we are seeing something that is reasonably stable. Elsewhere, markets are definitely trying to move on. Can the oil market move on? And what is happening, particularly at the front end and at prompt delivery? The US and Iran apparently seeking further ceasefire talks, though I haven't actually heard much from Iran on that front over the last few days. The blockage in the Strait of Hormuz is continuing and continues to impede energy supplies. Emily Ashford, head of energy research at Standard Chartered, joining us now to discuss. Emily, the rest of the financial markets seem to want to move on from this war. Is the oil market moving on from this war and this blockade?
Not quite yet, Guy. We've seen a slight lull in bombardment from both sides, and we have this cautious and fragile ceasefire that's remaining in place. And I think despite the failure of the first round of talks to generate a notable shift in position for either side, even just getting those two parties in the same room is an achievement. We're taking a bit of comfort from the idea that we could see further talks in the coming days before this 2-week ceasefire expires. There are still several negotiating points, which I think both sides are at odds. The most critical to the energy market, as you mentioned, is the opening of the Strait of Hormuz. And that means opening with no tariffs, no naval escorts, no mines, and no risks to vessels. And I think the market is still a little confused over the logistics of this new secondary US blockade and really its strategic motive, because tightening energy supplies even further, well, that will mean higher prices for both crude and refined products. And that correlation between US gasoline prices and then the domestic backlash that we've seen to the conflict has been clear for the past several weeks. But in terms of the Strait of Hormuz, at the moment, what the market is doing is we are all watching individual vessels on marine tracking apps. One yesterday that appeared to transit and then turned back. And then we had a headline that Iran was said to be considering a pause in its own transits, which would then remove the transit of Iranian crude as well, and an extra 1.5 to 1.8 million barrels a day from global supply. And then this morning we've had another news story that a tanker has entered the strait and made it to Iranian waters. But I would say on balance, it's a slight optimism about further talks that is really keeping the market sitting around $95 for Brent at the moment.
Emily, if I want a barrel of oil now, how much is it going to cost me?
That's a very good question. We have seen a disconnect between the physical market for barrels, if we look at, say, dated Brent, for example, and then the financial market. And I think that might be one of the reasons why the physical market is still in panic, but the financial market shows a little bit more caution, I think, cautious optimism. If we're looking at barrels, if you wanted to obtain a barrel in the market, and one of the questions that I've been asked a lot recently has been about alternate sources of supply. And we saw a headline yesterday from President Trump talking about increasing UK oil production and the North Sea. There seems to be a little bit of confusion as to where barrels can be brought online very quickly. Most of that is really just from strategic reserves, and where we will see a gradual increase over time, because obviously higher prices does tend to lead to higher production outside the Gulf. But if you really want to obtain a barrel of oil at the moment, your best bet is probably going and looking from a barrel coming from a strategic reserve.
Emily, good morning. Can we say that we won't see shortages of anything in Europe related to the Strait of Hormuz in the energy arena? Will we see any shortages going into the summer, even if we do see gradual reopening of the strait?
Yeah, the only balance that we have to tighter supply is to reduce demand. So that is becoming increasingly evident. The IEA published a report yesterday suggesting that the Q2 demand drop will need to be on the scale of the COVID-related drop that we had in 2020. So we have tight crude supplies, tight feedstock supplies, and that means that we're seeing refiners, petrochemical producers curtailing their operating rates, particularly in Asia. And then on the other side, we're seeing flight cancellations, reducing jet demand. And remember that it was jet that saw the most acute price rises. And then governments have two ways that they can then reduce demand, either policies to reduce consumption or mechanisms to shield consumers from those wholesale prices. And to date, at least 43 countries have announced those measures. But really, only the opening of the strait is going to prevent the most acute effects of energy supply loss and price escalation from spreading globally and then impacting the global economy.
I mean, that sounds like a huge ask, Emily, to reduce demand on the scale that we saw in COVID. Is that really what anybody is expecting? Or do we end up in a place where we just see some increase in exports from the Strait of Hormuz and then demand does not need to fall that far? Because that sounds pretty devastating.
Well, we've got a huge logistical lag that will be associated with this as well. When we finally have the strait opening, vessels will be in the wrong locations. We've had shut-in supply from Gulf producers as well, so even getting that back on stream is going to take a long time. The idea that once the conflict ends, we will see a rapid return to normality, I think is wrong. And also, I think we're going to see a change in market behavior as well. There will be two key themes, in my view, energy security and optionality. So a longer term pivot in focus towards resource nationalism, maybe even hoarding. And that isn't just the replenishment of strategic reserves, but a new wave of stock building of both crude and refined products. And I think the conflict has also exposed the absence of optionality from both the upstream to the downstream. So I think we're going to see alternate offtake routes being explored. Most Gulf producers are unlikely to ever want to give Iran this much control over both global supply and the price of energy ever again, or to be exposed so significantly to just one single choke point.
Yep, it's going to take a while to fix that, maybe, though. Just on the strategic reserve front, how much is left? Like if I want to barrel now, you said earlier I have to go to a strategic reserve. How much more can those reserves be drawn down without causing structural problems to the storage facilities, particularly in the United States? Yeah. If I want to rebuild them, presumably there's going to be extra demand afterwards as well. Just talk me through the kind of the process that is underway at the moment, and when that process kind of runs out of road.
Yeah, gradual withdrawals from strategic reserves. So we're not going to see 400 million barrels just put on the market on one day. And different reserves have different drawdown rates, the most rapid being the Strategic Petroleum Reserve. But other countries have more constrained rates there. And as you said, there are structural issues. So you can only withdraw a certain amount, particularly from the SPR, before you have to maintain an operational minimum level, or get an act of Congress as well to it is at that point. So I think removing any further from the SPR once we see that drawn down is limited. The one big reserve, which is opaque and we're not entirely sure how much is in it or how much is being drawn down, is China's reserves, estimated about 1.2 to 1.4 million barrels there. So China itself has been relatively well insulated from this whole situation with its strategic reserves. But that is the best repository of spare barrels in the market at the moment.
Yes, and so there's then some doubt as to whether the effect of this will be that China puts pressure on Iran or not. We will watch that one. I wonder, you mentioned earlier, Emily, that everybody in the industry is watching these various vessels and how much progress they make. We heard from the Americans yesterday that they said they successfully turned back 6 who'd been trying to leave the Strait. We're today watching the Xauusd Fanurios the first, which is not sanctioned. It's not Iran bound. It's heading to Basra, we understand. Is this the kind of thing that we should be watching to see the Iranian reaction function? Because if the Iranians don't seem to take any action against these vessels, and they can get in through Iranian waters, as they seem to be attempting to do, and crucially out again, that has to be a good positive sign, I suppose.
Yeah, I agree. I think there are a couple of risks to obviously this escalation with the blockade and two critical ones for this. The deployment of more military vessels in the Strait, I think, obviously increases the operational risk of an incident that could even broaden maritime tensions outside the Gulf. And the second is whether or not vessels can transit. We still have potentially inspections or associated rise in freight and insurance costs. So watching this one vessel this morning that has gone into the Gulf, perhaps the US blockade doesn't see that as an export of Iranian crude, and so that is maybe why it's been allowed through. I doubt it's been able to get through covertly. The amount of focus on that area will be extreme at the moment. So yes, you're right. Maybe this is another thing that's giving the market a little bit of optimism that is not quite every single vessel being stopped and that increased risk that we could see some sort of incident escalating again.
Yes, so the Xauusd seems to be Iraq-bound, and you referenced there, Emily, another vessel that the Iranians have said managed to get into their waters, but we will, yes, watch how it behaves and whether it manages to get out again. Emily Ashford, Head of Energy Research at Standard Chartered, thank you very much for your time this morning. 8:44 here in London. Coming up, a mixed bag for Wall Street banks as JP Morgan and Citi post record quarterly results. But Wells Fargo misses. We will look back and then forwards when it comes to the US banking story. This is Bloomberg.
Very resilient, through the last month. It's still up year on year every week. People are certainly spending more on gas than they were, before the conflict started earlier in March. But if you look in aggregate, it's about 3% of spend.
The Wells CFO speaking to us yesterday. We're in the midst now, firmly in the midst of US bank reporting. Wells, a little bit of a wobble, you could argue, maybe yesterday. What is happening with the consumer? They're probably much more exposed than maybe some of the other banks. But the basic picture coming out of the US banking sector continues to be fairly solid. In some ways, kind of quarter on quarter, there's a bit of volatility in there. JPM, there's bits of that business that look kind of okay. There's bits that look fantastic. I look at trading, look at what is happening there. Bella Farr, who leads our finance coverage here in London, joins us now. So pretty positive for JPM, pretty positive for Citi. We'll come on to Wells in just a moment. But trading's really good.
Yeah.
And really good.
It's kind of ridiculously good. I mean, you saw, I think JP Morgan had record equities trading. They had, their second best FICC trading quarter, and they had record trading across the board. So clearly, I don't need to remind you that a lot has happened over the last 3 months through the end of March. Yeah. But that volatility definitely worked in their favor, right? They were able to reap the rewards from it for sure.
Yes, and we certainly saw that at some of those banks that did pretty well. Even the ones whose share prices maybe didn't reward that. We saw some incredible trading figures. What happened to Wells Fargo then? Something different, a different story entirely, it seemed, for the markets.
Yeah, so Wells Fargo missed estimates on both net interest income and non-interest income, right? So two key metrics that obviously analysts are always looking at, and especially for Wells Fargo that had kind of a key restriction from the US lifted last year. So analysts are eyeing growth, right? And I think the question for Wells is, can they prolong this in the can they prolong this if volatility continues? If the US consumer, starts to feel more pain at the gas pump, like you heard from the CFO earlier, Will they be able to, sustain net interest income, or are they going to, be hurt by the fact that they are just not spending as much?
Yeah, it was interesting. The loan story coming out of JPM I thought was quite interesting as well, but we'll come back to that maybe a little bit later. B of A's out later, Morgan Stanley's out a little bit later. Does the theme continue?
Yeah, so I'll start with Morgan Stanley. Definitely expecting at least equities trading to be in line with the rest of the banks. I think it would be kind of a shock if something went awry there. But I think there will definitely be questions around private credit, which is something that all of the banks were asked about. I think, I was blogging JP Morgan's earnings yesterday. I think they were asked 3 or 4 times, maybe 5.
Yep.
So I think, but in terms of trading revenue, I don't think that they're expecting records on Morgan Stanley too. With Bank of America, they are expected a 6.5% rise in net interest income, which will be a big kind of boon for the bank. Again, I think all the questions will be around the consumer in the long term and whether they start pulling back on spending, or they start to their other parts of their businesses start to feel some of the hurt.
The doom and gloom that's coming out of things like you mentioned, things like that, kind of actually become a reality. Actually, I think we're getting retail sales coming up, so maybe we'll get a better read on the consumer out of the US over the next few days. Aside from the banks, Bella, nice to see you. Thanks for stopping by to see us. Bella Farr, who leads our finance coverage here in London. Let's talk about some of the European banks. The CEO of Commerzbank says she has had talks with UniCredit about a deal. This after the Italian bank announced the takeover bid, of course, for the German lender. But Bettina Orlopp says the companies are still at odds over what the right valuation actually is.
We have constructive dialogues, at least from our perspective, since the beginning of the journey, so since September 2024, because UniCredit is an investor, an important investor, now the largest investor also, and we take that into account. So we had every quarter, we had bilaterals between the two institutions where we actually answered all questions UniCredit had, and we did not take up any feedback when it comes to our own strategy or to potential collaboration or something like that. And we always stated that we would be open for a dialogue when we see potential terms, potential ideas of a business combination agreement. And what happened after the announcement of the takeover offer is that we had some talks, some interactions about a potential business combination agreement. But for the time being, it's very clear that our opinions differ quite a lot, starting with the valuation of the two companies and to the banks and the exchange ratio. And there are also some disagreement, I would say, about the potential future business model.
That was Bettina Orlopp, CEO of Commerzbank, of course, talking about the different views on the value of that business provided by her management and that of UniCredit. Let's look at some of the events that are on the horizon for today's trading day. The IMF meetings carry on over in Washington. We have the bank earnings story out of the US that we've already discussed. The Bank of England's Bailey, the ECB's Schnabel, and other ECB voices will be speaking. There's basically a lot of focus in Washington of, I don't know what the collective noun for all of those finance professionals is, but there's lots of them in Washington this week.
I could have thoughts on that.
Yes, central bankers and finance ministers. We'll also hear from the Fed, of course, and it's the Fed's beige book. Let us think about what comes up next.
It's tax day, apparently, in America, which apparently is generally quite a negative day for equities, but yesterday was amazingly strong. Apparently, we've moved past the war, back to AI. That's fantastic. Can it last? Well, let's try and find out. Scarlett's here. Can it last?
I mean, today, as you say, is a more negative day. This is work done by my colleague Simon White, and he looked at returns across every day, and today is, on average, the worst day of the year for the S&P. Now, generally, I wouldn't put a lot of weight behind seasonality unless there's a reason, but there's a very good reason for it in the fact that it's U.S. tax day. So people take out of the money out of the market to pay their taxes off. So that's more of a negative signal, but I think sentiment on average is quite positive still.
Well, yeah, and sentiment is quite positive because the market seems to be trying. The European story this morning seems to be we're trying on the one hand to look past what's going on in Iran. We have Brent almost entirely flat at 94.75. And yet the earnings story isn't helping us make move to the upside because of some of the luxury names. I mean, how are you summing up where we are in markets right now then, Skylar?
Yeah, it's really interesting because I think the market is just kind of pushing out negativity in terms of, yes, some of the earnings haven't been great today. And I think, markets can definitely look through into optimism if they're meant to be a resolution, and so the earnings aren't as bad maybe 2 quarters out. But if you actually look at first quarter and second quarter earnings, you might not see the negativity from higher energy prices in the first quarter. So first quarter Eurostoxx EPS expectations are pretty flat, and 2Q's actually been revised up. And there are two things when you look at a sector level happening kind of under the surface. The first is there's definitely more optimism priced into energy than negativity that's been priced elsewhere. So energy is meant to be very strong EPS upgrades and since the Iran war began. And then the second impact is much of the impact that's actually being priced, even if not to the levels that I think is necessary, is in the second quarter, not the first quarter. So travel, for example, you've seen strong upgrades for first quarter EPS, but second quarter EPS is where you've seen the downgrade. So it may be that we have to wait till the second quarter earnings season to see that stagflationary impact.
Skylar, thank you very much. Skylar Montgomery-Coney from the Bloomberg Markets Live team. And that said, Guy, US futures flat to negative. So looking for another driver for the markets conversation, it would seem, over in the States.
Yeah, we've got to pay the tax bill first. So maybe that's
it.
Why.
Nobody wants to do anything today.
No, just pay the taxes, move on, and kind of... Then we'll figure out what happens next.
Listen to what some bank bosses have to say later, which will certainly be part of the conversation. And there'll be plenty of messaging coming from those IMF spring meetings as well. Kristalina Georgieva will be joining, of course, from the IMF. We'll also be hearing from Joachim Nagel over at the Bundesbank. So, of course, lots of conversations to come from the IMF events over in Washington. That is it for the opening trade. I'll be back with the Pulse shortly. This is Bloomberg.
Ten years ago, Illuma Capital set out with one goal: to help people like you build a legacy for tomorrow. Through personalized strategies and unwavering dedication, we've been instrumental in helping our clients achieve their financial dreams, whether it's securing retirement, growing wealth, or planning for the unexpected. For a decade, we've been trusted to guide your financial journey. Expertise and care. Visit illuma.co.za today. Illuma Capital is a licensed FSP. T's and C's apply.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. The tech-fueled risk rally heads into a 9th day on US-Iran talks optimism. China's CSI 300 becomes the latest index to recoup its post-war losses. And ECB President Christine Lagarde says higher energy costs have pushed the euro area away from the bank's base case outlook. But she tells us it's not yet enough to raise rates. Plus, earnings in focus. US banks report record trading revenue, but sales tumble over at Gucci. We'll bring you the latest numbers from ASML in just a moment. Well, a very good morning. Welcome to Wednesday. This is the picture in markets this morning. You've got that risk-on appetite catching on in Asia today. We already saw it on Wall Street yesterday. The S&P closing near a record. The Nasdaq notching a 10th day of gains. Hence the disparity between Asia and the two sides of the Atlantic this morning. Of course, the peace and the talks are somewhat volatile. So this rally is set to be tested and futures pretty flat in Europe and the US. Flip the board over, though, to the cross-asset picture. And if we take a look at where oil's at this morning, we are still below $100 a barrel on Brent, even if we are up 0.8%. 95.56 is where we trade right now. The Bloomberg Dollar Spot Index pretty flat, and the 10-year yield completely unchanged, holding on to gains at 4.24. Now, in terms of the risk events on the docket for today, as the geopolitical backdrop calms down somewhat, we have the breathing space to focus more on earnings. And out of Wall Street, we've got Morgan Stanley and Bank of America reporting. We also, on the macro front, have the Fed's Beige Book, and we've got a raft of central bank speakers, including the Bank of England Governor Andrew Bailey and the ECB President Christine Lagarde. It's going to be a busy one. Let's set you up for the day ahead. Well, Welcome to the programme, everybody. We begin this morning with earnings out of the Netherlands from the chip equipment maker ASML. They see full-year net sales in a range of 36 billion euros to 40 billion euros, so pretty much in line with the estimate they had seen, 34 to 39 billion euros. In terms of second quarter net sales, they're looking at 8.4 billion euros to 9 billion euros. The estimate was for 9.07 billion euros. So again, pretty much in line, just slightly missing estimates on second quarter net sales forecast there. And we'll wait for commentary from ASML, of course, because these numbers come off the back of the US government tabling those additional restrictions on exports of chip-making tools to China, and that could curb sales to China even further. But the stock up 41% so far this year. You can see the 1 year, the 12-year month chart, they're up 112%. And this is, of course, Europe's biggest company, so do expect to see a reaction at the market open. We also have tech stocks pushing markets in Asia higher this morning. Let's get an update now from Min Min Lo in Hong Kong. Min Min, what's happening where you are?
Hey, Lizzie, suddenly oil tracing back to about $95 a barrel. That has pushed the momentum higher in Asia. After a strong close yesterday, we are seeing a second day of gains. You take a look at the CSI 300, we are just 2 points away. 4,710 is about the level to watch. That was where we were trading back on February 28 at the start of the war. We briefly breached above that earlier this morning, but we've come off session highs now, very close to that level. The TAIEX was already at a record high yesterday, today extending gains as well. The Kospi pushing above 6,100. And again, investors seem to be brushing past some of these negative headlines, right? Because we did have the BOK governor nominee today speaking and warning of the inflation risk of the global growth slowdown. We had import prices for Korea coming in, seeing the biggest jump since 1998. And yeah, you look at how equity traders are trading, it looks like they are just trading as if we are already at the end of the war. You flip the board and take a look at what is driving those flows, and it's really been the momentum trade, right? The big tech names, the Samsungs, SK hynix, and TSMCs, because we did have those preliminary first quarter sales numbers seeing record highs. I mean, you talk about the Nasdaq notching a 10 straight day of gains. That's something very rare, right? The last time we saw that was in 2021. You look at some of these Korean and Taiwanese ETFs seeing a steep climb here in the last couple of weeks. And also some of the quantum-linked stocks in Asia seeing huge jumps. Bottom of your screen, you can see, we'll bring that up shortly, some of the Korean quantum names seeing 30% jump today on the back of NVIDIA, unveiling this open source AI model that's supposed to accelerate quantum computing progress. Last thing, just to show you how investors are really looking beyond the war, you take a look at how VIX has collapsed to pretty much close to pre-war levels now, and it looks like investors are really looking at this risk of the singular oil shock not really spilling over into the tertiary impact of stagflation and growth risk in Asia.
Okay, Min Min Lo in Hong Kong, we appreciate the dive into Asian markets there. Thank you very much. Meanwhile, the Chicago Fed president says that the rise in energy prices caused by the Iran war may result in interest rate cuts being pushed back. But speaking at the Semaphore World Economy Summit, Austin Goolsbee also said that consumers still seem to be spending.
For whatever reason, people's consumer sentiment is very tied to the price of gasoline. Will that translate into they actually stop spending? If so, then there would be a danger of a stagflationary recession. So far, you haven't seen that. The consumer just keeps chugging along.
Let's bring in Bloomberg MLive strategist Mark Cranfield for more now. Mark, caution on cuts there from Goolsbee, but it looks like bond traders are positioning for gains on treasuries that could see 10-year yields sliding towards 4%. Good morning.
Hi, good morning. Yes, I mean, the curve steepened quite a bit when we had the most extremes of the oil price changes. Then the investors were pricing in for a longer period of inflation, and we had the long end of the curve, the yields going up much more. They're starting to come out slightly. It's going to be much more sticky for the short end rates. If you look across the G10 spectrum where traders are pricing, nobody is expecting any interest rate cuts in the near term. In fact, in some cases, they're starting to price in for more interest rate hikes. We've got the potential for the ECB, maybe the Bank of England, they may do that. But Reserve Bank of Australia already have done so. And as far as the Fed is concerned, traders are not seeing any changes in the near term. So that suggests that short-term rates are going to be pretty sticky. If there's going to be any movement at all, as you say, potential for longer-term yields to come down a little bit further in the Treasury curve. But that's also very dependent upon the fact that oil still needs to continue to fall. It's down in the 90s now. Maybe it can come down into the 80s. Then it will certainly help bond yields. But as long as we have that big premium in oil prices because of the military action that we've seen in Iran, as long as that stays, it's going to be very hard for yields to come down very far. It's a marginal move. That's why people are much more interested in the equity market for the time being.
Well, on that point, Mark, how much can stock traders focus now on earnings, given that the geopolitical backdrop seems to be brightening somewhat?
Well, exactly. They seem to be much more comfortable. The equity investors especially have got used to being able to trade tariffs. Now they're getting used to trading higher commodity prices. And the fact is that the major companies are still making plenty of money. Just look what's happened this week with the big banks in the United States. Already some blockbuster earnings by the big names, JP Morgan, Goldman Sachs, particularly from their trading revenues. We've got a couple more banks coming today, as you noticed earlier. They're probably going to produce decent results as well. Within the next couple of weeks, we've got most of the big tech companies in the US coming on stream. What you saw from ASML there suggests we're going to get pretty decent numbers out of the big names, the Apples, the Metas, the Amazons. They're going to come at least in line, showing they can still make plenty of money despite the disruptions we've seen in other parts of the asset classes. So equities, once again, are beginning to look pretty good. They don't need to worry too much about yields. Yields are in a relatively small range. That is not going to hurt sentiment in the equity market. And as long as we don't go back into an all-out war in Iran, people will be comfortable moving their money back in equities, and it's likely this earnings season is going to reinforce the fact that US markets are still a very good place. That may spill over to Europe as well. But at least as far as the big cap stocks are concerned, people are pretty comfortable, and it doesn't look as though we're going to derail the rally in those anytime soon.
Mark, appreciate the preview. That's Bloomberg M Live strategist Mark Cranfield. Well, diving into the geopolitics now, Bloomberg has learned that the US and Iran are looking to arrange a second round of peace talks in the coming days, with one proposal to return to Pakistan. Meanwhile, the US is pressing ahead with a naval blockade of Hormuz to curb Iran's oil exports. In a Fox Business interview, Trump reiterated that he sees the war as nearing its end.
I think it's close to over, yeah. I mean, I view it as very close to over. You know what? If I pulled up stakes right now, it would take them 20 years to rebuild that country. And we're not finished. We'll see what happens. I think they want to make a deal very badly.
For the latest for the Middle East, I'm joined now by Bloomberg Horizons anchor Jumana Basetchi in Dubai. Jumana, how optimistic should markets be about a second round of talks? How far apart are the two sides still, even if there is optimism that at least it seems we're going to get another round of talks?
Yeah, well, President Trump has been speaking to various journalists over the last couple of days, indicating that there is a very high likelihood that a second round of discussions do take place. He hinted that it could happen as soon as this week, in the next couple of days, still in Islamabad. And we know that there has been a big push from the mediators, including Pakistan, to get this over the line. And we just played a little bit of his interview there with Fox, where he also indicated that the war is very close to being over. So once again, is signaling, at least from the US's side, that they are ready to start winding things down. Now, the Iranian side has been quite quiet, I will say. We had comments from the president, Pezeshkian, yesterday suggesting that they would be willing to return back to the negotiations table under, quote unquote, an international framework of law. He was not involved, obviously, in the first round of discussions. But the fact that they are playing it low-key possibly could be interpreted as a positive signal. And then also, just to bolster that, yesterday we had a Bloomberg scoop from one of our colleagues suggesting that Iran were considering halting shipments going through the Strait of Hormuz because they didn't want to test the U.S. naval blockade. And if that is the situation, then perhaps they are actually laying down the foundation to go into these talks and continue with them in Islamabad. So I suspect we'll get more color in the next 24 hours. The clock is ticking. Remember that ceasefire expires on April 22nd.
And Germana, what was the mood music out of the Lebanon-Israel talks in Washington yesterday?
Well, there's been a concerted effort to divide the two channels, so to speak. So to have the Iran-US discussions happen in parallel with the discussions that are taking place or have taken place between Israel and Lebanon directly. It was a historic moment because this is the first time that the two sides actually do come together, even at ambassadorial level, spearheaded by the US since 1993. The readout suggests that there was some overlap. The Israeli ambassador seemed to suggest that it was a very constructive meeting. He even hailed it as a victory, that the two sides are aligned on the desire to disarm Hezbollah. The Lebanon side put out a slightly more muted readout, saying that they would like to see a ceasefire being implemented first. The return of displaced civilians, there were over 1 million displaced civilians, as we've been reporting, and concrete steps to address the humanitarian crisis in the country in order to be able to move on to the next round of discussions. And I should just say that while Israel have held back from further strikes on Beirut and other parts of the country, there is still an ongoing battle in the southern part of Lebanon that is still ongoing. There's no ceasefire in place. And the Lebanese position is that in order to continue these discussions, you have to first introduce the ceasefire, and then you can move on to the next phase. And of course, the other big question from all of this is Hezbollah and how they would react. And so far, they have said that they will reject any of the outcomes that come through from these conversations. So a positive first step, but again, I think expectations of this leading to something more long-lasting are quite low at this point.
Germana, thank you very much. That's been both Germana Basecci in Dubai. Well, we have oil ticking higher today after yesterday's slump as the US and Iran look to arrange that second round of peace talks amid this blockade of the Strait of Hormuz. Bloomberg's oil and shipping reporter Waylon Sun joins us now for more on that front. Waylon, what's the latest intel on how the US naval blockade is playing out?
Thanks, Lizzie. So it seems to be holding up pretty well. It's calmer than expected. And just to refresh people's minds, just a few months ago, we saw the US trying to blockade Venezuela, where they were seizing tankers and chasing tankers into the ocean. We do not see that happening here. We hear the US Navy saying that they turned back 6 ships yesterday. And now we see one of them actually sailing back through Hormuz. I mean, it's a retracing of its steps, but it shows that it's not a hostile kind of blockade so far. And in response, we still do see traffic going through the Strait of Hormuz, including one empty supertanker that is heading into the Persian Gulf, apparently to pick up a cargo of crude from Iraq. So far, the blockade appears to be holding up well. So it's putting a flaw to the sentiment, and I guess this gives Iran and the US room for negotiation should they have a ceasefire talks later this week.
Okay, so setting up that meeting potentially happening in Islamabad. Bloomberg's oil and shipping reporter Waylon Sun, thank you very much. Well, still ahead, we will consider the economic impact of all of this. Josie Anderson, the European economist at Nomura, will join us to discuss the IMF's downgrade to global growth. But first, US banks report at least $100 billion of private credit exposure, along with some record revenue numbers. We'll get you more details on those Wall Street earnings next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:18 a.m. here in London. I just want to recap some of those lines that we got from ASML earlier in the programme. Breaking earnings out of the Netherlands. They've raised their full-year sales forecast as AI investments fuel demand for their chip-making machines. They now say that net sales will be between 36 billion euros and 40 billion euros this year. That's compared to a previous range of 34 billion to 39 billion euros. We've heard from the CEO, Christophe Fouquet, saying that demand for chips is outpacing supply. So in response, their customers are accelerating their capacity expansion plans for 2026 and beyond, supported by long-term agreements with customers. And when it comes to the results, the outlook, we are a little bit light on the second quarter net sales forecast, but ASML also raising the outlook for the full year. Now, interestingly, ASML is no longer revealing new orders for the quarter because that figure can be volatile and can bounce the stock price around. But investors do usually prefer more numbers when they can get them. So this is a different kind of format from ASML, but significant nonetheless. Europe's most valuable company reporting here. Well, turning to some other earnings, this time out of Wall Street, we had JP Morgan shares closing lower after traders posted their highest ever quarterly revenue for the first 3 months of the year. The US bank took in $11.6 billion in trading revenue for the period, up 20% from a year ago. JP Morgan also lowered its full-year net interest income guidance to about $103 billion and disclosed that the bank has about $50 billion in private credit exposure.
There will be a credit cycle one day, and I think when there's a credit cycle, losses will be worse than people expect relative to the scenario. I don't think it's systemic. It almost can't be systemic at that size relative to anything else. But, you know, when recessions happen and values go down and people refi at higher rates, there'll be stress and strain in the system.
Now, meanwhile, we had shares of Citigroup closing higher after traders rode a wave of volatility to push the bank to its highest quarterly revenue in a decade. Its fixed income unit generated $5.2 billion of revenue, while its equities business reported a record $2.1 billion. But CEO Jane Fraser warns that an extended war in Iran risks blunting deal activity.
The impact of the Middle East conflict is hitting Asia and Europe harder than countries such as the US and Brazil, which are more insulated from energy shocks. Clearly, the longer this goes on, the more pronounced the second or third order impacts are going to be around the world. And inflation is now a greater risk to growth and will likely cause central banks to lean towards more restrictive monetary policies.
Now, of course, we also have Morgan Stanley reporting today, and Bloomberg's Lisa Abramovitz will be speaking exclusively with CEO Ted Pick later on. So don't miss that interview. It'll be on at 3:30 p.m. London time. Well, turning now from bank earnings to luxury earnings, Gucci sales have fallen as the war in the Middle East hit demand, with revenue tumbling 8% on a comparable basis during the first quarter. This as the troubled Kering brand more broadly tries to mount a comeback under new leadership. For more, let's speak now to Deborah Aitken, Bloomberg Intelligence senior analyst for global luxury goods. So I wonder what you made of these latest results from Kering, Deborah, and crucially, when we'll know whether Demna can last at Gucci as creative director.
So the -8 from Gucci was disappointment. We were looking at more repair. It is showing a little bit of sequential improvement versus 4Q. But there needs to be more done on product. So for Demna, we see more of his products start to feed through from February when the product initially came out, but it will be quarter by quarter with shows in April with more collaborations and more pieces, I think, by the end of the year. So that's the Gucci side. And certainly the Capital Markets Day on Thursday, it will be big focus on Gucci. Aside from that, other big brands, so Gucci has moved into fashion and leather goods as a division. They've pushed all of the brands together. I think that gives them more of a hierarchy, but also they still allow you to see what's happening separately at Gucci. So we do have solid growth from the other brands, and the company is saying that the big brands outside of Alexander McQueen, which we know is in transition mode, but the company is saying that by year end they expect Gucci year on year to also be in growth and be margin accretive. And that's the same for the other brands. So there's a lot going on strategy, execution, focus on clients. They need to do more with Gucci in Asia for sure. So we'll wait to see that coming through. But elsewhere, there are big divisions growing, like jewellery up 22%, eyewear up 7%. So they've helped to really also offset. If we look at Kering overall, flat growth. LVMH the day before was plus 1%. So there's quite a mix of what's going on there.
All right, Deborah, thank you for that analysis. We'll also, of course, have Hermes results out later on, but for now, that's our Bloomberg Intelligence senior analyst for global luxury goods, Deborah Aitken. And we'll be speaking with the CEO of Kering. Catch that interview with Luca De Meo at 3:30 p.m. London time. Coming up, though, President Xi warns the world is beset by turmoil as he meets the Russian foreign minister in Beijing. Details next. This is Bloomberg. Now to some other top stories we're following this morning. Chinese President Xi Jinping has held talks with the Russian Foreign Minister Sergei Lavrov in Beijing, with officials saying that the two countries are seeking closer strategic coordination. President Xi warned of global turmoil as he met a succession of world leaders.
The world is beset by turmoil and the international order is in disarray. How a country treats the international law and order reflects its worldview, its values, its vision of order, and its sense of responsibility.
Meanwhile, US Treasury Secretary Scott Bessent has warned that China's trade surpluses threaten global economic stability. At an Institute of International Finance event in Washington, he said that the world cannot take a China with a $1 trillion surplus. And Bloomberg has learned that US prosecutors made a surprise visit to the Federal Reserve's offices in Washington yesterday amid the Justice Department's investigation into Chair Jerome Powell and a renovation project at the central bank. 3 officials from the DOJ attempted to enter the construction site but were denied entry on the basis of safety and other clearance protocols. Well, those are some of our top stories this morning. Coming up on Daybreak Europe, we'll discuss the IMF downgrade to the global economy with Josie Anderson, European economist over at Nomura. That's next. This is Bloomberg. Heads into a 9th day on US-Iran talks optimism. China's CSI 300 becomes the latest index to recoup its post-war losses. ECB President Christine Lagarde says higher energy costs have pushed the euro area away from the bank's base case outlook. But, she tells us, it's not yet enough to raise rates. Plus, Europe's most valuable company raises its full-year sales forecast as AI spending demand fuels demand for ASML's chip-making machines. Well, a very good morning if you're just joining us. 6:30 a.m. here in London. This is a snapshot of markets this morning. You can see that